Good morning, ladies and gentlemen, colleagues and friends, and also to everyone following us online. Welcome to Lisbon, and welcome to this conference dedicated to the 10th anniversary of the Single Resolution Mechanism. We are delighted to host you here at Banco de Portugal to reflect on the first decade of the SRM and also to look forward to the challenge ahead.
Thank you for joining us today. We have a long day ahead of us, but one we trust will be both rewarding and enjoyable. To begin with, please join us welcoming the Governor of Banco de Portugal, Professor Mário Centeno, for the opening address.
Thank you.
Good morning all, and thank you for coming. Welcome to Lisbon, to Banco of Portugal. This is a great moment that we are celebrating here today. It is certainly one of these landmarks for Europe in our quest for risk reduction. We spent many years, for very good reasons, reducing risk, mitigating, controlling, creating backstops to protect us from risks, trying to circumvent the impact that the materialization of risks could have in our economies, and certainly the steps towards strengthening the resolution mechanisms, functions, institutional settings in Europe is part of that. So, distinguished guests, colleagues and friends, good morning. It is with great honor that Banco de Portugal hosts this conference, marking the 10th anniversary of the Single Resolution Mechanism. In fact, the achievements of the Single Resolution Mechanism in the last decade cannot go unnoticed. A whole new framework was established with the creation of the Single Resolution Board, the central resolution authority within the banking union, as well as the Single Resolution Fund, which is now capitalized, well capitalized, with around 80 billion euros and is fully mutualized. Resolution plans have been prepared for all institutions, setting out the preferred strategies in case of failure, something that we don't want to happen. The appropriate loss-absorbing capacity has been built up for about every bank, while other dimensions of resolvability are also showing significant progress. And most importantly, the system was put to the test in 2 real-life resolution cases and showed the ability to act swiftly and efficiently. It was able to preserve financial stability and protect taxpayers' money. During this period, the banking sector also became more stable and resilient. Banks in the banking union are better capitalized than they were a decade ago. This makes the resolution authorities' task easier. Their balance sheets are overall stronger and healthier. Non-performing exposures have declined, while the increased loss-absorbing capacity makes them more capable of withstanding more severe shocks. We are very far from the 5% NPL that in the discussion of the backstop by the ESM of the Single Resolution Fund was discussed and put in all decisions that we took by then in Brussels. This progress is particularly noticeable in Portugal, and this is very pleasant to underline and notice. There are good reasons for you to be here. We are one of the countries that experienced the most and the hardest the reason why resolution mechanisms are so important. But in the past 10 years, Common Equity Tier 1 of our banks, the ratio has increased from 12.4% to 17.9%. NPL ratio has fallen from a peak of, imagine, 17.9% to 2.3%. Profitability as measured by the return on assets has improved from 0.1 to 1.4%, and all banks became compliant with the applicable minimum requirement for own funds and eligible liabilities, the MREL requirements. These achievements are the reflection of a collaborative undertaking. First, among EU member states, which have agreed on a single framework for supervision and resolution in the banking union, reflected in the solid institutional framework that is now in place. Second, and no less importantly, it is also the result of the work carried out within the single supervisory mechanism and the single resolution mechanism, as well as the efforts of banks themselves, of course. At its core, the banking union is a project of integration and trust. There is no integration without trust. We, in Europe, must move away from solely concern with risk reduction to a more mature and advanced status of risk management. It is not always simple to do this in Europe. But trust among member states, trust between authorities, trust in institutions, and trust from citizens that our financial system can withstand crisis without jeopardizing stability or fairness is of the essence. This project was born out of a collective awareness on the need for deeper integration in response to the severe financial and sovereign debt crisis that tested Europe so deeply. At the same time, we learned the hard way that financial fragility cannot be dealt with in isolation. The first decade of this European project has lived up to its promises, and the single resolution mechanism has proven to be a cornerstone of stability and confidence in the banking union. It is, however, essential to keep in mind that the past decade has also brought new challenges. From the pandemic to geopolitical shocks, from cyber risk to the expanding frontier of finance, with the emergence of digital assets and new market players. As I have been repeatedly saying, financial stability cannot be taken for granted, especially in the current times of uncertainty. The European banking sector and banking activity remains to a large extent fragmented, which is certainly a reflection of the fact that the banking union is an unfinished project. To that end, we need to go deeper in trust. We need stronger common institutions, supervisors capable of acting consistently across borders, and resolution authorities able to intervene decisively irrespective of national borders. We need to move forward and pool efforts to continue with the banking union and develop the EU capital markets. These are essential for a competitive and integrated financial system, as well as to channel Europeans' high savings into productive investment in Europe. We cannot do that against our nature. We cannot claim for stability and a very gradual and conscious way forward, and at the same time try to find disruption and ways that will not materialize into what Europe is. Europe has been, in the last 5 years, the greatest pillar and supplier of stability in the world. This has a lot to do with these institutions that we celebrate here today. This is because we take them seriously. This is because we use them more and more to provide stability to our economies. We cannot, in a general equilibrium sense, want to move in other directions and think that we will not be jeopardizing some of what we have conquered lately. Of course, there are things that must be completed. I already mentioned the banking union, and there are pillars of the banking union that are not yet completed. Of course, we must ratify, all countries, the reform of the ESM treaty that provides the Single Resolution Fund with an extra backstop. We need to do that. We need to continue that way. But we need to find that in an European way. And we do not need to be ashamed of being European, on the contrary. So I'm certain that today's discussion will bring to light both sides of this picture. On the one hand, the significant progress already achieved. On the other hand, the work that still lies ahead of us, and it is a lot. The agenda for today is ambitious. It promises a comprehensive overview of the essential elements that make up the single resolution mechanism and to reflect on the way forward through the voices of those who know this field best and who will greatly enrich our understanding and debate. I would like to take a moment to acknowledge the breadth of expertise represented in today's program, bringing together perspectives from European and national authorities, international organizations, academia, the legal field, and public policy. This diversity will enrich our discussions and will help draw valuable lessons. This conference is, above all, an opportunity for dialogue, an opportunity to strengthen our collective understanding and reinforce our shared commitment to financial stability. Financial stability was probably the greatest sign of success of Europe in the last decade. Europe, in the context of a severe, probably the most severe economic crisis we had in the last more than 1 century, and then the challenge of monetary policy having to respond to inflation in double digits, financial stability was always there. There were no risks of fragmentation whatsoever raised, on the contrary to what happened in 2008, and then more even so in 2011, 2012. So this time, we did better. The first 10 years of the single resolution mechanism have shown what Europe can achieve when it acts together. With determination and vision, some of those sitting in this room are to be credited with this. Thank you, Elisa. The next 10 years must be guided by the same ambition. I wish you all a very fruitful and stimulating conference. Thank you for coming to Lisbon, and enjoy. Thanks.
Thank you very much, Mr. Governor, for these inspiring initial words. I think the tone is set. It is now our honor to introduce our first keynote speaker of the day, Mr. Dominique Laborex, Chair of the Single Resolution Board. Mr. Dominique Laborex has been leading the SRB since 2023 and is in charge of the management and the work of the board, both in its plenary and executive session, and also represents the SRB towards international stakeholders, including the Resolution Steering Group of the Financial Stability Board, for which he has been recently appointed chair.
Exactly. And before taking up his current role as chair of the SRB, Mr. Laborec served as Secretary General of the French Prudential Supervisory Authority, the ACPR, in charge of supervisory for banks and insurance undertakings. Between 2015 and 2019, he was one of the founding members of the Single Resolution Board. Notably, he was responsible for resolution planning and preparation of decisions for banking groups in 6 European countries, including Portugal. Please join us welcoming Mr. Dominique Laborec to our stage.
Many thanks, ladies and gentlemen, for welcoming me today here at Banco de Portugal, and a special thank to Governor Mario Centeno for organizing this conference, which is obviously particularly topical. I'm very happy to be here to celebrate 10 years of a single resolution mechanism together here in Lisbon. Why? Because it was just said, it's also a little bit a part of my personal life, which is here. When I joined the board for my first mandate between 15 and 19, I was in charge, among other things, of the Portuguese banking sector. And I can tell you that it's definitely a good remembrance. We had a lot to do at that time, and I had a number of interactions with a number of you. I recognize some faces here, and it's definitely something which is near to my heart. Coming together to celebrate a decade of the single resolution mechanism in an event organized by the Portuguese National Resolution Authority really goes to show how far we've come since the great financial crisis. This morning, I'd like to reflect on some of these transformative achievements that have paved this decade-long journey of the single resolution mechanism, but also to offer some very short views on the challenges still ahead. Let me start by what Mario said a minute ago. We have built a robust resolution framework from the ground up. Nowadays, the single resolution mechanism stands strong as the second pillar of the banking union, ensuring that failing banks can be resolved effectively with minimal or no impact on taxpayers and the broader economy, because the aim is to preserve financial stability, as already said. But let me remind you that the resolution framework and the authorities in charge of implementing this new framework were 10 years ago only ideas on a piece of paper with very theoretical concepts that many doubted could be put in place. Back then, this even set us apart from the first pillar of the banking union, which was largely modeled after existing systems with existing regulations. And this is the key difference. At the same time, we had to develop a completely new approach with new authorities. In Banco de Portugal, you were among those who started to implement the resolution teams for very good reasons, a bit earlier than the others, but it was not the case in the majority of the European countries, and we started from scratch, implementing and developing the framework at the same time. The idea was that we could move away from government interventions and bank bailouts, which had proven extremely costly for taxpayers during the great financial crisis. And we thought that we could deal with banking crisis at the European level in a better, orderly way without relying anymore on any public financial support. The establishment of a single resolution mechanism made up of, as you said, Mario, the Single Resolution Board and the NRAs, the National Resolution Authorities, achieved it. In only a few years, the SRM successfully resolved several banks without using one single euro of taxpayers' money. Let me repeat this each and every time I have the occasion to do it. The successful resolution of Banco Popular in 2017 was certainly a major achievement. I know that Here, when we analyze the decision of Banco Popular with this subsidiary in Portugal, there were some, let's say, reactions. But at the end, let's start by the end. Financial stability, was it preserved? Yes. Taxpayers' money, any injection of public money? No. So the goal, the intrinsic goal of the single resolution mechanism and of the resolution framework were respected. And I think we can be proud of this important decision we took. There is another one, obviously, more recent in 2022, and here the same. Financial stability was preserved and no euro was spent by the taxpayer. The first decade effectively saw the Single Resolution Board and the NRAs putting flesh on the bones of this framework, ensuring that resolution would become a credible option in a crisis scenario. I'd like to come back to one of the transformative achievements over the last decade, and you've mentioned some of them already, Mario, but let me come back to the key elements we should all keep in mind. You mentioned the Single Resolution Fund, and definitely this is an important step, which is financed by contributions from the banking sector, not the taxpayers, and acts as an emergency fund in crisis. It reached its target level after 8 years, as the legislation asked us to do, and now it represents between 80 and 81 billion euros. It's a real buffer which brings confidence in the system, in the capacity we have to inject this money if need be in a crisis scenario. I can tell you that this is something which matters a lot when we discuss with international investors. They recognize that there is this buffer, ex-ante funded, which is immediately available. And when you look at the size of our banking sector, it's a lot of money for a number of our banks. For the big monsters, if I may say so, the GSIBs, it's not enough. But for the majority of our mid-sized, big-sized banks, it can be enough to find the additional element we could need in a crisis scenario. And this goes also in parallel with the building of the famous MREL, loss absorbing capacity, minimum requirement on eligible liabilities. If I can say proudly that this Single Resolution Fund is a buffer, it's because in parallel, each and every bank earmarked for resolution has built its MREL stack year after year. And now we can say that everybody under an MREL target within the banking union is exactly respecting this target. So it's a great achievement. Remember, Mario, you were heading the Euro group at that time. You remember the endless discussion, yes but no. You mentioned risk reduction. I remember very well these topics around risk reduction. Is this enough? Is this we are not sure that MREL will be built. Let's wait to see if it's possible. It was possible. We did it, the bankers did it. Let's recognize it was an effort, but at the same time, let's recognize that all the studies tell us that there was no impact on the lending capacity of the banking sector to the economy. So it was done without a negative impact on our economies. There is another area which I would like to insist upon. We have definitely built a set of policies, again from scratch, which translated the level 1 text into operational guidance for banks. It's safe to say that today our policy framework has now reached a good level of maturity. Obviously, even if there are some bits and pieces still needed to be added. And I have in mind, for instance, the combination of tools, which could be a way forward for us. And finally, we should not forget that the Single Resolution Board grew from a startup-like structure. When we started in 2015, we were exactly the 6 board members at that time, plus a dozen of persons rented by the European Commission. And today we are more than 500 staff members, including the consultants, etc. And the NRAs have which started from 0 in general, now have reached around 350 staff members all around the banking union, the 21 countries of the banking union. So these achievements are concrete evidence of the SRM's contribution to financial stability in Europe. as we now enter into a second phase of a more mature single resolution mechanism. Also, this is the reason why we have launched this new strategy, 2028, Vision 2028. It's worth recalling this first phase, and it was not a walk in the park, frankly. All these achievements are the fruit of hard work from dedicated staff all over Europe, who invested a lot of time and effort into building something truly exceptional. More or less, all our decisions were challenged in front of the courts, in front of our appeal panel. And, all in all, up to now, we've been reinforced by the case law, meaning that the decisions we took were sound and safe. I suppose you will discuss this in the second panel, so I will not insist on that one. But important to know that we had the blessing from the courts about the decision we took on the most critical decisions. I would like to insist in my second development about the collaboration and engagement with national resolution authorities. You said it very well, Mario, no financial stability without trust. And that's true that, as we all know, after the great financial crisis, there was this famous sentence by Mervyn King saying, at that time governor of the Bank of England, saying, well, banks are global in life, but national in death. And so this was this tension, happy to let them develop abroad, but when it comes to the crisis moment, it's for me to step in. So the single resolution mechanism, made up, again, SLB and NRAs, was set up to address the challenges posed by this disparity, to provide for strong, centralized, and independent decision-making that overcomes the pitfalls of uncoordinated action and regulatory arbitrage by banks. There are clear benefits to the system. On the one hand, this system, with the SRB at the center, ensures that planning for resolution and decisions are carried out in a consistent way and in coordination with the relevant national resolution authorities, which can prove particularly important for resolving institutions operating across borders. On the other hand, a decentralized structure also means that you can draw on the valuable knowledge of the local banking sector and in-depth expertise only the NRAs possess. Within this mechanism, Portugal, this central bank as a resolution authority, has always had a special relationship with resolution, not only because Portugal was one of the first member states in the EU to adopt a resolution framework, but it was also one of the first to be faced with two resolution cases, BESH in 2014 and BANIF in 2015. Just before the SRM entered into force. This experience, of course, set Banco de Portugal apart from other NRAs. Banco de Portugal entered the SRM with a deep understanding of bank resolution and its implications for the broader economy. This was also felt by our staff in Brussels from the very beginning, during exchanges with Portuguese banks and Portuguese authorities. Resolution has always been a very tangible and credible option in a crisis that did not affect only the others, but could also concern them. This mindset definitely shaped the Portuguese approach to resolution. Over the years, the single resolution mechanism has greatly benefited from Banco de Portugal's wealth of expertise, especially on transfer strategies and bridge banks. It's an excellent example of how experience from NRAs can reinforce the mechanism as a whole and help foster a European approach to resolution planning and decision-making, drawing on best practices. It's also based on experiences like this one that we designed the Vision 2028 for the SRM. This new strategy, adopted at the beginning of 2024, puts the cooperation between the SRB and the NRAs at the heart, and we are continuously finding ways to increase this collaboration with, for example, integrated colleagues from the NRAs into working groups at staff level where they participate in shaping our policies We are also currently working on finding new ICT solutions to increase information sharing to the next level within the Single Resolution Mechanism. Before moving to my next point, let me stress that the success of the Single Resolution Mechanism, of course, does not rest on a close cooperation with the NRAs alone. Obviously, we collaborate very closely inside the SRM at all levels, but we also closely cooperate with other institutions. I was here in June with Claudia Busch for the country visit, as we call it, and obviously I would like to insist on this excellent cooperation we have with the SSM, the first pillar of the banking union, but also with other authorities outside Europe, outside the banking union, outside Europe, at the international level, because at the end of the day, it's very simple. Financial stability is a common good which does not stop at any border. And so we need to work all together for preserving this financial stability. Let me go quickly to another achievement which is perhaps not sufficiently underlined, but I take the opportunity of this conference to say it as simply as that. I was saying to José before starting my speech that finally a part of our job is not known. All the resolution planning phase, is not known. We, the journalists, like speaking about the Single Resolution Mechanism when there is a crisis, but not in peaceful times, while in reality the majority of our work is exactly during peaceful times. And so I would like to insist in 2 minutes about the work which is conducted within what we call the internal resolution teams, which is the comparable notion to GSTs for the first pillar of the banking union. Over the last decade, staff from the SRB and the NRAs have developed resolution plans for all the banks in the banking union. This means more than 120 resolution plans. These plans cover many dimensions, from strategies, the resolution strategies, to MREL, this loss-absorbing capacity, and to other dimensions like the measure of liquidity needs in resolution. And obviously, I cannot forget that also part of the job of the national resolution authorities is exactly about developing the less significant institution resolution plans and liquidation plans. And it's also a big part of our collective job. Resolution planning is now taking a different form as we shift our focus to the operationalization of banks' resolvability capabilities. Sorry for this jargon, resolvability capabilities, but you understand what it means. The banks should be ready, whatever the circumstances are. I can tell you that ITs, these internal resolution teams, are very busy these days with the finalization of their bank's priority letters and multi-annual testing programs, which will provide banks with an overview of the tests they will need to perform over a 3-year period. Developing and assessing these tests for the banks has been a very time-intensive exercise, but I'm confident that they will contribute to improving banks' resolvability across all dimensions of what we call the expectations for banks which were issued in 2020. Let me also add here that these bank-led tests will be complemented by deep dives and on-site inspections, which will be carried out by the SRB and the national resolution authorities. The second important strand of our work to ensure readiness are our own readiness. And the simulation exercises and dry runs we perform on ourselves mean that we want to test our protocols and processes within the SRM and with third parties. For a resolution to be successful in a structure like the Single Resolution Mechanism, cooperation needs to work seamlessly. This is why, over the last years, the national resolution authorities, supported by our crisis preparedness and management unit, have been developing national handbooks which lay out the procedures to be followed in a crisis. In parallel, the SRB has been organizing crisis days where the NRAs can participate. These simulate the runway to resolution and are meant to enhance crisis preparedness across the mechanism. Let me also mention that we participate in a number of simulation exercises beyond the single resolution mechanism. So we are part of the cyber dry run of the SSM as an example, and we have also international exercises like the TPLE, where we join forces with the US and UK authorities to test stylized scenarios. At the end of the day, these achievements are less visible, obviously, than the crisis decisions we have taken, but they have contributed to gradually building up the credibility of the crisis management framework in the EU and earning the citizens and markets' trust. You said it, Mario, better than I can say it. During the last years, financial stability was preserved in Europe, and there is certainly a good rationale for this. But I would not like to finish without mentioning that obviously the journey is not finished. It's an endless journey, if I may say so, because things are evolving quickly. And I would like to mention only there briefly three things to finish here. One, you told us already, Mario, that despite all our efforts, our framework is not yet complete. CMDI is a progress, true, very welcome, but liquidity and resolution, or EDIS, are still missing. Second, we should not be complacent, and our achievements do not preclude the possibility that we cannot face the next crises, which are going faster and faster using the influence of social media or building on let's say not new, but these risks which are evolving quickly, like the cyber war, for instance, just as an example. SVB is the perfect example in 2023 in the US of something which was not anticipated and for which our framework is not necessarily the best developed one for tackling this type of crisis. Third element I would like to mention in the current debate on the hot topic called simplification. Let's define what simplification means, but I'm from time to time a bit puzzled by the lack of ambition for less fragmentation and more banking union. This should be the first way for simplifying our framework. A stronger banking union would simplify our life everywhere between all the members of the banking union. Careful not to deregulate, it was said by a number of participants everywhere in Europe. I think we all agree on that. But also careful to miss the real ambition. And the real ambition, you said it very well, Mario, is if we want to really simplify the framework, let's work for more Europe than for less Europe. That's the time to conclude. Sorry for being so long. We've managed to successfully build a functioning framework for resolution from scratch, and we can be proud of that. This does not mean that the journey is over, as I just said. Crisis management, by nature, is always messy. Don't expect a resolution decision without any hiccup. This will not happen, never, ever. And we will see this during all the panels, I'm sure. Why? Because there are still a lot to do, still a lot to discover, and because the next crisis will be different from the previous one, by essence. So that's why we need to continue our work, step by step, firmly, and with a lot of confidence in our capacity to be able to face the next crisis to come if we take the good direction and good decisions. We are really committed to that at the single resolution mechanism after these 10 years, and I think that this is something which should be particularly underlined today in this conference. Before closing, I would like, just for a moment, because I've seen that there is a tribute later on, but I would like to say a few words about somebody who is really near to my heart, Luis Silva Moraes, who served as the vice chair of the appeal panel until his passing last September, just 1 year ago in reality. He served on the appeal panel since its very beginning in 2015, becoming its vice chair in 2018. He played an instrumental role in shaping the appeal panel's decisions in new and complex areas of the single resolution mechanism legal framework, making a deep and lasting contribution to financial stability in Europe. Above all, he was a true gentleman and a pleasure to work with. So I wanted to send him a message today, and I'm sure a number of you are sharing my views here. I hope that today's conference will lead to interesting discussions. I know it will be the case. You know, we have so distinguished panelists. And I would be pleased not to celebrate what we have done well, but also to discuss what we can improve in the next 10 years of a single resolution mechanism. And I'm sure that these panels will bring us a lot of good ideas. Thank you for your attention.
Thank you, Mr. Laborrex, for your inspiring words. We now move on to our first panel of the day. Panel 1 will discuss banking resolution as a pillar to financial stability, the role of the SRM in the banking union.
This session will be moderated by Mr. Jesus Saurina from Banco de España, former board member of the Single Resolution Board, a position he held from 2020 to 2025. Before its mandate at the SRB, Mr. Saurina was Director General at Banco de España, responsible for financial stability, regulation and resolution, as well as being a member of its Executive Board and Governing Council. Mr. Jesus Saurina was also a board member of the Spanish Resolution Authority, FROB, as well as of the Spanish Deposit Guarantee Fund. Joining him on the stage, we have our distinguished panelists, Ms. Elisa Ferreira, Mr. Pedro Machado, and Mr. Mark Dobler. Let us welcome them to the stage.
Nice to see you. Nice to see you. Good morning to everybody. Let me start by thanking Banco de Portugal for this kind invitation. It's really a pleasure and an honor to be here moderating this panel made of distinguished panelists. The objective of this first panel is to take a stock of the progress made in the framework, in the resolution, and the contribution of resolution to financial stability. I think that if we think 10, 15 years ago, there was no resolution framework, there was no way to deal collectively with banking crisis. Now we have a framework. I think that it's fair to recognize, and the current chair of the SRB has done the progress made by banks in building up MREL. And this is not a small achievement, because the SRB has in his remit banks that have more than 2 trillion total assets, so they can easily go to the market and raise the MREL. But it also has banks with 2 billion total assets, 1,000 times smaller. And all of them fulfill these MREL requirements. I think that this is really an achievement of the banks and of the SRB. It's also an achievement that the SRB has more than 20 billion, around 20 billion at the SRF, so that significant amount of gunpowder to deal with resolution of banks under his or her remit. Also, I think it's reasonable and fair to recognize the progress in resolvability, the progress in resolution plans, in the operationalization of the resolution plans, and as Dominic said, the development of transfer strategies that this country and this NRA has a lot of experience and has contributed significantly to SRM work. But I think that it's also reasonable to acknowledge that there are some challenges ahead. I think that we need to be humble on what we have achieved in light of what is still lacking. We still lack the third pillar of the banking union. The governor and Dominic mentioned risk reduction, but we are still waiting for the risk sharing. The risk sharing part is only partial, and I think that this is a challenge that I'm sure the panelists will touch upon. And also it's very important, and Dominic has mentioned, the close relationship between resolution authorities and supervisor authorities. And this is day-to-day work to move in business as usual banks into a direction jointly, and there is a lot of effort and has been a lot of effort in this direction, but also to work together in a crisis, because it is not that you are a supervisor, the bank is failing or likely to fail, you pass to the SRB and then the SRB deal with the bank. No, the bank will come to the supervisors if resolution is successful, or as all of us expect. This is also to acknowledge the progress on resolution of banks. The SRB, or the SRM, has provided financial stability, has delivered financial stability to Spain, to Portugal, to Slovenia, and to Croatia. And I think that this is a big achievement without using, as the chair said, taxpayers' money, because the 80 billion, this is not yet touched, and this is private money. So let me talk about housekeeping matters. Basically, you will have 15 minutes to talk, and then I have some questions from myself and some questions from the audience. And now it comes the most difficult part for me is to introduce the speakers, and it's really the most challenging thing because it's such a distinguished panel. I'll start with Elisa. I mean, I can only say unfair things because in this house, which has been your house, but let me try. You are an economist, PhD by University of Reading. You've been Minister of the Environment from 95 to 99. So 30 years ago, you were already minister, which is really impressive. Minister for Planning from 99 to 2001. You've been member of the European Parliament for the Socialist Party from 2004 to 2016. So 12 years, and not particularly easy years. It were the years of the crisis. Really impressive. Since 2017, you've been vice governor of the Bank of Portugal, and last but not least, 2019, European Commissioner for Cohesion and Reforms, a post that you held until December 2024. So it is not only about your curriculum, is that you were at the right place at the right time. So it's really impressive, and it's an honor, of course, to have you here. Then we have Pedro, former colleague at the SRB, friend of mine as well, a lawyer that started in the private sector. Then you moved to the ECB, principal legal counsel, 2001, 2006, legal advisor here at Banco de Portugal, 2006, 2011, 2 years head of cabinet of the Minister of State and Finance, and particularly timely and interesting period, challenging period. You were also 13-14 Deputy Director Prudential Supervision here at Banco de Portugal, then another stint at the private sector, Associate Partner Price Waterhouse Coopers, Then you became Chief Legal Counsel, Director and Legal Services, Banco de Portugal from 2017 to 2020. Then 5 years as board member at the SRB, and now ECB representative at the supervisory board. Again, you have also the ability to be in the most interesting places at the most interesting time, which provides a health of experience, but probably also some sleepless nights, and this is, I guess, much appreciated. And last but not least, Mark Dobler, you've recently led the assessment of the euro area under the IMF's FSAP program. You had the team in the Monetary and Capital Markets Department in the IMF, responsible for dealing with and preparing for financial crisis. So for those that are not familiar with the IMF, MCM are the guys that sort out problems. Right? So it's not an obscure department. No, these are hands-on guys. Mark's guys sort out problems. You help to implement key reforms in the UK bank resolution regime, and you have a lot of hands-on experience. You joined the IMF from the Bank of England in 2010. You have authored papers on resolution, so you are an expert on the matters that we are going to discuss, and you represent also the IMF Financial Stability Board's resolution steering group. So with these three experience on practical matters panelists, I think it's time for me to stop and to start with Elisa, please.
Stay here.
I mean, as you wish, you can go there, or
okay.
You wish.
Well, thank you very much. Thank you very much, first of all, for inviting me to be here again. I feel very happy to be here. And I would like just to salute everybody in the room in the name of the Vice Governor. Luis, an old friend here. Also all the members of the Single Resolution Mechanism in Dominique Lavorret, and old colleagues that, and I feel really very honored and very at home here now. And I think it's, Jesus, thank you very much for the introduction, also the members of the panel. I think, in fact, it's important to go back, and from old CV that you were so kind to read, you could have avoided dates, but anyway, I think from this CV, what I will refer to will be my personal experience during the, two periods. The one when I was a member of the European Parliament, so between 2004 and 2016, and during that period I was a spokesperson for the second biggest group. In spite of being an independent member, I never joined the party, but I was working with the center-left. And then the period where I had the pleasure to come here to the Bank of Portugal, and I was actually doing supervision, so I integrated the supervisory board in Frankfurt. So what I can share is these two periods, and I would start by saying that, in fact, I agree with everybody, the governor and Dominique, who mentioned that this has been a great success, a great European success. But I will not go any further, because in the recent years I've been doing something else completely different. And so I think what I can share with you is this specific experience, and I hope it will be useful. I'll try to touch upon, so for the sake of time, first of all, some of what I consider to be big achievements, but for this I've got to situate yourselves, particularly the younger people, on what was the spirit at the time when all these things started, 10 years ago. then the details that even at that time were, from my point of view, personal point of view, remained a bit unsolved. Then the past experience, lessons learned from experience, and then I'll make some final comments. What was the spirit when I joined the European Parliament, and I was working with the ECON group, so Economic and Monetary Affairs, and the Parliament is a co-legislator, so we share the responsibility for legislation on the European legal texts. So we went through two different periods, difficult periods. The period of the financial crisis after the Lehman Brothers insolvency, and then the period in 2011 and 2012 where the sovereign debt crisis exploded. And a lot of legislation was done, and I was the spokesperson for the second biggest group in the parliament. So I was personally engaged into all this work that was done at that time. Just to situate you, at that period, there was still a prevailing philosophy that we supervisors, regulators should not intervene in the market too much. The market was considered to be capable of looking after itself, in a nutshell. We were still in the follow-up of the Graham-Leach-Bailey Act that cancelled, so to speak, or changed structurally the Glass-Steagall Act that separated businesses, and this had a big influence in the international market. Of course, the Basel Committee was the only source of inspiration in what comes to regulating and asking for a minimum of control on banking sector. Alexander Lamfalussy had been asked in 2001 to think about supervision, but from an internal market point of view, because there was free movement of capital, and so some coordination between the different supervisors and regulators should take place. But this spirit completely changed after 2008 with the financial crisis and the bust of the bankruptcy of Lehman Brothers and everything that came along. And at that time, then Monsieur de la Rosière was asked really to readdress the issue of supervision, and we participated in a lot of discussions, and Jacques de la Rosière published this first report exactly in 2009, asking for, recommended a strengthened supervision and to set a coherent, and I'm quoting, a coherent and workable regulatory framework for crisis management in the EU. And in the follow-up of that, the Commission issued a paper in 2009, and then the Parliament, and I happened to be the rapporteur, produced one of these rules asking the Commission to act exactly to decide how we should manage a crisis in a bank, particularly if it was cross-border. Why? Because of the crisis, and from the crisis there was an overall conclusion that there had been insufficient and inefficient regulation and supervision, excessive leverage and risk-taking, complexity, lack of transparency, asymmetric information, that the consequences for the European Union, and not only the European Union, had been an excessive bill on governments and taxpayers, and on top of everything, belonging to the European Union didn't make that difference from a positive side. On the contrary, there were lots of restrictions and constraints, and so there was the need to readdress this issue. And national protectionism and the violation of and distortions of competition were evident. So the objectives centered on financial stability, controlling internal contagion, managing cross-border, managing too big to fail, minimize the cost to taxpayers, and protect depositors. At that time, Europe and the United States, they were moving into the control of the impact of the crisis a bit together, and we were looking at each other. And in the United States, there was this Frank-Dodd Act that created 5 pillars of intervention. And in the European Union, we tried to mirror it with regulation. So it was IIFMD, CRD4, after CRD3, a new supervisory architecture with ESRB, EBA, ESMA, EIOPA, so all these institutions, and a framework for crisis management of systemic institutions. And the Parliament, in that report, asked for, I'll go through it very quickly just for you to see, and this was 2010, a single common rule book, a supervision with teeth, a toolbox for intervention, a crisis management rule, allocating costs of failure to shareholders primarily, harmonization of insolvency laws, a resolution unit. At that time it was thought that it would be in EBA, a branch of EBA, a special regime for systemic cross-border banks, a pan-European stability fund financed ex-ante by banks to facilitate orderly resolvability, protection of taxpayers and depositors. This was a request of the Parliament to the Commission, but of course there was an absolute lack of mutual trust. There were different national structures. We remember the twin peaks that some countries had, others had other systems, and completely different insolvency laws. So it was very, very difficult to start it, but nevertheless, the collective effort managed to progress. And I took some plenary intervention of February 2014, so 4 years later. I was mentioning the momentum. There was a momentum. The strong supervision would take place during that year, with the entry into force in November of 2014. We were asking for a single guarantee of deposits to go quickly. And the question was, BRRD, so the Banking Recovery and Resolution Directive, had been approved by Parliament in December 2013. So the two basic questions were, if you have a supervisor with teeth, and we had created it, I went quickly through it, if the supervisor thinks that the bank is not viable anymore, what does he do with the bank? So we could not live with different resolution units with completely different criteria across Europe. So a single resolution mechanism was desperately needed. The second aspect is the BRRD, because the BRRD, and I'll address very briefly the BRRD later on, the BRRD had been approved, and the idea was, okay, so how are you going to implement it? Through individual national units. If that is the case, then it won't work anymore as a European kind of system. So, having said this, we moved forward. The SRM, the single supervisor mechanism, entered into force in 2014. And here I stopped to make, okay, there was progress, and I call it the devil is in the details. So, what details do I want to refer to? First of all, when we looked at the United States, the first thing that the United States had created already back there, I mean now, one century ago almost, after the 2000 and after the 1929 crisis, was in fact the FDIC, to guarantee deposits. And it was useful again during the crisis, where the level was increased of the coverage of covered deposits to $250,000, and at the same time with a credit line directly to the Federal Reserve. And this was why it worked so easily in America. From the three pillars of banking union, single supervision went on, single resolution was in the process of being implemented, but the third pillar remained, and what we call political appetite was going down and down on this. BRRD became, this is my second topic, the instrument to manage a failing bank. In the United States, they had a toolbox. In Europe, we used BRRD, and BRRD, of course, bail-in was a very appealing idea. And I remember in the Parliament, this Article 32 for three little eyes was really very discussed. What I'm referring to is this request for a bank to be resolved to bail in 8% of total liabilities and own funds as a minimum and a limit in the intervention of 5%. Why this was approved in the Parliament? First of all, because it is very complex for normal politicians to understand what they are talking about. So in a nutshell, in a very simplistic way, it was not everybody has to have a lot of knowledge in economics or understand the details of it. But the left said, yes, let's internalize the costs. And it's very good. The highest the number, the percentage, the best. Because this means that the ones that gain when the market is positive, then pay when it is going down. And the left, so this was the idea from the left. Yes, the owners of the business have got to pay. From the right side of the Parliament, it was the idea that asking for extra MREL would really revitalize the financial sector. And this would be, a gain for everybody because it gives a lot of risk perception and it would be very stimulating for the market. Another detail, moving into another subject, was the timing. Because more or less at the same time, all these things were put into action. And this created a little problem. Another aspect that I find critical from that time is the fact that the Commission decided in this spirit of internalizing costs in the unit, in the entity, to introduce strict limits to the use of the national DGS. So as the joint deposit guarantee scheme was kind of being put aside, at the same time there were limits that were not strictly legal, but an interpretation that using the national DGS was a state aid. And so it would have to be compliant with all these requirements for state aid. The last topic was the lack of a robust backstop. We managed to create the fund. I can tell you, and Celia is there, and she remembers, Celia Reis, she probably remembers that special night we spent negotiating the creation, the contributions for the fund. It was very complex. I even had a personal, Sylvie Goulart and myself, we had a personal meeting with the Minister of Finance of Germany, Mr. Schäuble, exactly to explain why, with compartments, but it was created and it went on. So, in spite of all these complexities and difficulties, I also recovered a note from an article from December 2014, when I was saying this is a great week because the Parliament has just decided on the contributions of banks for the Resolution Fund and the confirmation of the members of the Single Resolution Board. And here I have Elke Cunning as president, and then the members, and of course Dominique Labouret as a member of the board. Practical experience, and I was not in this area when the cases that you mentioned, Bez and Banif, happened. My colleagues were here and they may address it. I'll just refer to the ones that I saw happening, and I'll refer, if I can, to four short cases. May I? I've got to stop. Yeah, stop.
I cannot stop you. Yeah, I forgot. My reputation is at stake. But please address this.
I'll just mention it very simply.
Please.
Okay. So I'll refer to four cases that deserved from where I take lessons. The first one is exactly the success story of Banco de Portugal. Banco Popular was obviously a success story. But what would have happened if a buyer was not on the corner, a strong buyer to buy the bank? What I refer to is that Portugal at that time had a subsidiary. This subsidiary here, had no problem whatsoever. It was not imbalanced, it was sound. but it was managed as an integral part of the bank and under the single supervisory mechanism. Then the bank was resolved. And it's not just a theoretical issue, that this subsidiary could have been split in the sale, and if that was the case, this subsidiary would have to be wound down under Portuguese payment of the covered deposits and senior debt. And this would have been an incredible blow into the financial situation of the country. So this was an issue that deserved a lot of concern. The second one is the fact that the second case, the orderly wind down of the Veneto banks, that was supervised and resolved at the European level, then it was sent to insolvency. And being sent to insolvency, this means that the country has got to manage the bank. And a resolution on the basis, for instance, of transfer of deposits using the DGS, national DGS, at that time was not allowed. And so this ends up with another aspect that can be a very strong blow in the equilibrium of the macro-prudential situation. A third topic, a third case, just to mention financial stability. In these two cases, the last financial stability was, in fact, in the hands of the host member state. So when we talk about consolidation, this cannot occur if these problems are not solved. But going very, very quickly on the situation of requests of MREL and the timing, it happened that with the crisis in Portugal, a lot of banks had a very big stock of NPLs from the global economic crisis, and when they were looked at by the supervisor, they were asked to reinforce their MREL and to go to the market and reinforce their capital. So this is a sign of fragility that is given to the market by the supervisor. And this immediately translated into a higher cost of the issuing of this bank in order to comply with the recommendation. So the problem was solved with longer-term plans for the correction of the NPL. But to go through SREP or stress tests and to identify the bank of having to reinforce its capital sometimes ends up in a kind of a circular, aggravated problem. The last topic is middle-sized banks, because at that time, Fernando Rastoy and the BIS were analyzing this issue, because if a middle-sized bank, deposit-taking, very traditional bank, goes into a problem, then the resolvability of that bank is extremely difficult, because either the bank completely changes its profile and goes and has a lot of bail-inables and a lot of junior debt, or goes to comply with the 8% at that time, goes to comply with the 8% requirement, may really affect senior debt or even go through deposits. The alternative of insolvency is extremely, extremely costly for the country. So I think these four aspects are the ones that I would like to share with you. I hope they are solved now. I know that one of them isn't, and this is the guarantee of deposits, which is really a big elephant in the room that then has connotations with everything else. And thank you for your tolerance, but I finish with this message. I think at this stage, it is important that when practitioners and supervisors address these issues, that we prepare before the next crisis comes. But this has got to be treated in a very technical platform. It's not just, now the puzzle is too complex for you just to subject to the political debate, the missing elements in a puzzle. And the puzzle is so well constructed already that the missing of a single piece may really destroy the whole structure. And this is what I guess I wanted to share with you from this past experience. Because in all these cases, we were successful. Sometimes we were lucky also, or we had some wiseness. But I think we should fill the gaps because one missing stone in a dam may destroy the whole structure. And so I think it's really time for us, when it is not yet raining, to prepare for rainy days. Thank you very much. And I'm sorry.
Thank you. Thank you very much, Elisa, for sharing your wisdom. Despite being 12 years independent member of the European Parliament, you still have good speaking skills, plus the passion of good politicians. So, gentlemen, I will not be that nice with you. Please stick to your 15 minutes as agreed. Please, Pedro, the floor is yours.
Thank you. So good morning, everybody. First of all, it's really a pleasure being back home, and I want to not only thank the Banco de Portugal for having invited me, and in particular Luis and João, but also to praise the resolution department for having, I think, pulled up a very good high level and high quality seminar to give praise to these 10 years. I think this is a festive event. Should not be, of course, as we heard from Dominique, not a complacent event, but definitely one that we should also take stock and also be proud of what has been achieved. And this is basically going to be my central argument of what I want to share with you. It's basically to say that I think it is fair to acknowledge that the SRM, and I stress here this, the word mechanism, so the Single Resolution Board together with the national resolution authorities has become a central cornerstone also of financial stability together, of course, with the SSM. And this is substantiated and evidenced in various dimensions that I'll briefly touch upon. The first dimension that I want to trust upon is that the SRB and together with the national resolution authorities have delivered on what was its core mission, what was being expected in the first 10 years. The first 10 years were supposed to rely on two main sort of deliverables. The first being the resolution plans to be in force. And the resolution plans have a very important component, which is, of course, the MREL targets, and the fact that we have been able to achieve across the system the MREL targets that were foreseen, that were set by the SRB for each of the banks, the significant institutions, in addition to the cross-border LSIs, the less significant institutions, which also fall under the direct remit of the SRB. I think having achieved this, we should start, and going back to the starting point that Elisa so well described, it was not evident for sure in 2014, 15, 16, 17, 18 that this would have been achieved by 24. I think today we have a very marginal shortfall in terms of what is the MREL targets, but this is because some banks benefit from either transition period or because they have been onboarded later on, because there is also the situation that some banks have been onboarded in the meanwhile became significant institutions. So this is the first, I think, token that we have to take in terms of what has been achieved, but also that the resolution plans do not exhaust themselves into the MREL. So resolution plans entail a very comprehensive and granular overview information on what is the bank that we are dealing with, and what is necessary to do if a resolution has to be implemented. So I think this is one of one major achievement that should not be at all considered to be sort of that was supposing to be a given at the start of this journey. The second, of course, is the build-up of the Single Resolution Fund. We heard here from Dominique that now it is at the level of 80 billion. It has been built over these years, and it is fair to acknowledge that it is a very considerable backstop. Is not a backstop maybe that is not for sure going to be sufficient in resolution cases, in particular as regards the largest banks that we have, but, and I'll come to that in a minute, but it clearly covers already or can benefit a significant array of banks that fall under the SRB remit, both in terms of in financing of the resolution scheme or for liquidity, to act as a liquidity backstop. So I think these are two major achievements that have been and that should really not be forgotten at this stage when we take stock of these 10 years. But then I would also like to say that, and this is the sort of the other dimension, is that the system has been tested. The system has been tested. We have already heard about Banco Popular. Banco Popular is a case, the first test that the SRM was put through in terms of applying, implementing a resolution scheme, was a very challenging one because there you could not even talk about a resolution weekend. It was from during the week in a very fast-burning crisis. Like this thing, I mean, Banco Popular had been deteriorated slowly, and then when the crisis hit, it was very fast. And it was from, I think, a Tuesday to a Wednesday that had to be set, with the complexity of the subsidiary in Portugal, which fortunately was handled, I think, in a sound way to really preserve that we would have, through the resolution of Banco Popular, also a financial stability issue in this country. So I think this is it. But then there was the Sberbank case. Sberbank was, and here let me also praise here the work of my friend Jesus. Jesus was in charge at the SRB at the time of this bank. And this was a case that was very challenging because for the first time we had a bank that was impacted by the entry into force of financial sanctions. And it was really a tremendously fast crisis that unfolded. I mean, you know, maybe you remember that 3.5 years ago, the invasion of Russia of Ukraine happened on a Thursday. The bank went insolvent on Friday, but in some countries, particularly in the country in the Czech Republic, the bank did not even manage to go until the end of the day. So it had to close its operations by midday because of the swiftness of the bank run that took place on that. And that required not only to execute a resolution that had two parts. One was the liquidation of the holding, the parent company in Austria, and then the implementation of the sale of business of the two subsidiaries in Croatia and Slovenia, which, as you might imagine, is not properly the most easygoing process to try to sell at the same time two subsidiaries over that period, for the first time the implementation or the adoption of a moratorium scheme. So it was applied to give 2 extra days for the resolution scheme, for the sale to be achieved, because of course there is the need in these processes also to comply with principles of EU competition law, in particular as regards the transparency and the fairness of the sale process. So this, I think, if you allow me, this has been a bit what, in a nutshell, and I'm really summing up because this is the outcome of many years of work of many people across the system that have been devoting the best of their skills, capabilities and time to deliver on this. It is also true to acknowledge, and I think we are going to hear in the next panels, where I will not delve too much I will not delve into that question, but that it was also put to a test before courts. And I think it's important to acknowledge that overall, I think we have to take a very positive balance about the litigation, and in particular when it comes to the resolution cases, I think it is fair to acknowledge that they have been quite successful in terms of its outcome. So I think the fact that it was also subject to judicial scrutiny is also an important dimension, because at the end, resolution is also about complying also with the rule of law, something that now is very, as you know, very topical in terms of our public discussions. So I would say that the SRM at the end not only has had this ability of these 10 years to deliver in a meaningful way on its mission, but also that it also avoided, or at least introduced, what was also supposed to be achieved when it was initially fought, to avoid that the taxpayers' money is mobilized, to avoid moral hazard. And so I think these dimensions are very critical in terms of the achievements that have been. And I think it's also fair to acknowledge that there is clearly has been a case of built up from scratch, and we have to always to remind that resolution hardly existed in member states until we had the sovereign crisis in Europe, where we started acting as Portugal did in 12, but then the momentum, the political momentum was generated to come up with the BRD and later on with the SRM. So it was it's a system not like supervision that has decades of experience and of practices and also of failures, because it's important to learn with failures, but that has decades also in particular of experience, that this resolution was built from scratch, and I think this is reflected in this. However, I want to strike here a dimension that sometimes is not totally perceived, is that these two pillars, the supervisory pillar and the resolution pillar of the banking union, do not operate in isolation. I want to, in this regard, to stress the idea of the continuum that should exist between supervision and resolution. So it's not that both entities or both systems are working, as was mentioned before, that supervisor said, now you have handled these crisis cases, and then resolution after dealing with that just gives it back. And what does this continuum in particular mean? First, it means that crisis management is also a dimension that supervisors address. So it's not that supervisors are not oblivious or do not follow what the SRM produces. So the resolution plans are sent for consultation, the draft resolution plans there is a constant dialogue between the teams, in particular the IRT, so the internal resolution teams, and the joint supervisory teams, and crisis management is also part of the normal the operation of the SSM. There is a team dedicated to crisis management, which of course follows these topics and acts as interface. And this is really a sort of very close dialogue that happens. And I can tell you, because I've been dealing with this over until recently, and I can tell you that this is really a dialogue that is really sort of going on. But conversely, resolution authorities have also to be mindful that, in particular, the SRM, the SRB, that the requirements and decisions can, of course, then affect the ability of banks after in the post-resolution. And this is a dimension that is important. If you don't foresee sufficient, adequate levels, for instance, of recapitalization, then of course you are jeopardizing the continuity of the bank after resolution, just to give a very simple example. But this to say that and to demonstrate that really there is a very dynamic interactive process here between both pillars. And the other dimension, of course, goes without saying, is this continuous exchange of information, which is very crucial between both parts. Together with coordination, and this is reflected in the participation of certain exercises like dry runs, which of course are very relevant to identify where gaps, where improvements might have to be introduced in the sort of dialogue, in the sort of cooperation between both authorities. And then of course we have the part on recovery planning. Recovery planning is followed by the supervisors, is scrutinized by the supervisors, is drafted by the banks, but then is scrutinized by the supervisors, and there is a kind of a sort of a dynamic intersection with resolution plans. Eventually, if the recovery plan is activated and is still able to reverse the situation of the bank before it fails, of course, then resolution will not kick in. But if it doesn't happen so, this is also one of the conditions that the SRB observes when it wants to implement a resolution. Namely, it will observe that any sort of measure from a supervisory point of view is not any more fit for reversing the deterioration of the financial situation of the bank, and hence resolution kicks in, of course subject also to analyzing whether there is any private market solution. But this is a bit the tandem under which both entities operate, and which is very crucial. So I think that this part on the continuum is really, I think, what also explains why one has to assess financial stability within this broader landscape of the two pillars interacting. Unfortunately, we don't have yet the third pillar, but this is what is a bit what I would call the pillars of financial stability in Europe. Now, this is, I think,
now, Pedro, please, it's time to.
And I wrap up with the looking ahead, and before you. And I know that you can be particularly draconian. So I will just spend 2 minutes just to flag some of the things that I think we still have to look ahead, because the building is far from being perfect. I think we have still some missing pieces. One has already been mentioned by Dominique. I will not explore that, but I think it's a very crucial topic, which is this topic on liquidity and resolution. Maybe we can then go through this under the discussion, but just to say that resolution shall we call Credit Suisse? So a sale of Credit Suisse was required to have more or less approximately 200 billion of guarantees in place to ensure liquidity. So I think this gives the dimension of an institution that the balance sheet of 600 billion, about the size that is needed for addressing the issue of liquidity in resolution. I would also flag the question of CMDI. CMDI is a very core piece, but I think it has been very much diluted. Okay, it's better than to have the CMDI, but still to address this question of the mid-sized banks that are not able to fulfill the 8% TLOF when they have to access to the single resolution fund is crucial. Is a crucial piece that the DGS, that the national DGS can bridge the gap. Although under the political agreement, I think there have been too much conditions imposed for that mechanism to be activated. But still, I think, as I said, it is better than nothing that we have this in place. And then I would just finalizing by saying that we have new emerging risks that are very challenging for both supervision and resolution. I'm thinking particularly of all the risks that come together with digitalization. Of course, the cyber risks are a case in point. Cyber risks today can, as we saw with a small bank in the Netherlands, lead the bank to be cyber risks together with digitalization. Sorry, that's what I meant. Can also mean that the bank can fail just because it is cut from its critical IT services. In this case, was a bank that was cut from the cloud services, and because of that, it had to go into insolvency. Also, so digitalization is, of course, a very sort of central piece in terms of the transformation of the business model of banks, of its enhanced profitability, but also brings it with risks, both from the side of the volatility of deposits in extreme scenarios, to cyber risks that clearly are very much are very topical in terms of its monitoring and to the way a bank can resist to them. So I think all in all, I would just want at the end to really think that we have achieved, and we have to be proud of what has been achieved over these 10 years. But of course, we, as always, really cannot be complacent in terms of the broader landscape, and we have also to be mindful of the shortcomings that we have still in the system. Thank you very much.
Thank you very much. So, Mark, I'm in your hands. I mean, you see that I cannot monitor time, but I'm really keen of listening to you, because you have the view of the outsider, if I may, or the helicopter view that can help us a lot. So the floor is yours, please.
Thank you very much, Chair. I think we're standing up here so you can't catch our eye, but I'll try and be quick. I think it's a great pleasure to be here with such esteemed speakers and panelists. The timing of the conference is obviously fortuitous with 10 years of the SRM, but also because the IMF has just finished its assessment of the euro area financial system through the euro area FSAP, which we went to our board, published our findings in July this summer. So the key findings and recommendations that I'm talking about today are all in the public domain, and they're available online in a lot more detail. I do think that I have the joy working at the IMF and speaking here today, but also in the day-to-day work of being an independent, I wouldn't say we're impartial, through many years of experience of working in crisis cases, crisis countries, we're very strong proponents of effective resolution regimes. We've seen the economic losses, the fiscal costs that come from financial crises, from bank failures that aren't managed well, and from the costs involved in bailing out failed banks and shareholders. So independent, but certainly not impartial. This is a subject very dear to our heart. So I wanted to say, I think I'm going to align very closely with some of the points that have been made. I will come on to some of the fundamental challenges that have been discussed, some of them being picked up, and some of the things that we would recommend going forward we would like to see addressed. But I think the SRM got off to an excellent start, and certainly from the outside. I think on the inside it was a more complex. It was obviously every resolution case is very stressful, especially quick burn failure. But the resolution of Banco Popular was a significant and early test of the single resolution mechanism, which I think it passed with flying colours. The SRB with the FOB in Spain protected depositors, preserved financial stability, and did so without incurring government losses in this failure of a systemic and cross-border bank. That was a huge achievement. The bank's losses were entirely borne by the shareholders and the investors in the capital instruments, other investors. And the transaction, the resolution followed a bail-in followed by a whole bank sale. And it's that transfer of ownership which I think is important, and I'll come back to. And every use of resolution powers is going to be subject to legal challenges. Resolution powers cut across property rights. They'll always be subject to legal challenges, and the Banco Popular was subject to significant challenges through which it passed and proved robust. So those, I think, was a key early start and very positive development. The aim of resolution is to preserve financial stability and do it in a way that minimizes the risk to government fiscal risk. But there were some important early lessons, and I'm not sure they were entirely taken on board at that time. The first of them would be the importance of adequate liquidity in resolution. Pedro touched on it, I'll come back to it. But this was a bank that was sold to another bank which had deep and liquid pockets, and those liquid pockets were needed to stabilize the balance sheet, the deposit base of that bank. The other was the flexibility in resolution planning. This was a bail-in, but importantly, it was a bail-in followed by a transfer. It was a sale. So I draw parallels with the case, which I'm going to call a resolution in Credit Suisse. I know the Swiss authorities call it something else. The importance of having sufficient liquidity in leading up to and through resolution is critical. And sometimes a standalone bail-in strategy may not be sufficient on its own to stabilize the deposit base. So a transfer power, the ability to use transfer powers, I think is something that we perhaps should have taken more notice of back in the resolution of Banco Popular in 2017. So, good start. Then we subsequently saw, I think we mentioned the Venetian banks, we subsequently saw what I would call sizable banks that were resolved outside of the single resolution mechanism. They were resolved in the national liquidation stroke parallel resolution regimes that we have in many of the member states. And I think part of that relates to the design structure that was set up in the BRRD and obviously at the heart of the SRM, about the flexibility that we have in the SRM. We seemingly have more flexibility in the national regimes and less than in the SRM, which I'll come back to. So as I mentioned, the Euro area recently was completed. We found that this is an assessment of systemic risk in the financial system of the Euro area. We look at the prudential framework, banking supervision, non-bank financial supervision, and a key part is the financial safety net, the bank resolution regime, deposit insurance schemes, and emergency liquidity assistance. We had, I think, very positive findings. We found a significantly strengthened prudential framework. I mean, the SSM has done a really positive job in leveling the playing field, in upping the quality of supervision, the intrusiveness of supervision, the quality of risk management in the banking system, the significant improvement in the capital and liquidity that was mentioned that European banks have. All the things that we touched on and focused on as very strong positives. What we did find, however, was that national fragmentation still continues to hinder the integrated, deeper, more diversified financial system that I think the euro area needs and deserves. Coming back to the prudential framework, we found the SSM and the SRM, the SRB and the NRAs have become well established as institutions. They've improved their cooperation with each other and with the national authorities, and along with other financial safety net participants. The European courts have been largely supportive of the banking union in its decision making. Most importantly, which was mentioned, the system has proved resilient through major shocks. We've had Brexit, we had COVID, we had the Ukraine war, interest rate normalization with the rise in inflation, and the potential risk or shocks that were caused by the bank failures in Switzerland and in the US in 2023. That is very impressive. Another key achievement, which has been mentioned several times, and Pedro and others have had a big hand in completing, is the build-up of MREL. The build-up in MREL has provided a significant buffer, and we've seen that the banks and the Single Resolution Board have invested significantly in their resolution preparedness, which I think is paying dividends. But this brings me on to my slightly more critical angle from the independent assessment that we have at the IMF, and we see that there are still structural challenges that remain within the Single Resolution Mechanism. Most notably on the access to the use of the Single Resolution Fund and the use of other public funds, and the 8% requirement and the 5% limit that Elisa mentioned. We also see the absence of the European Deposit Insurance Scheme as a key missing part, a key pillar of the regime, as well as the failure to date to ratify the ESM backstop for the Single Resolution Fund, which we strongly recommend is pursued. The third key challenge, I think, was mentioned, is access to liquidity and resolution. So I think the Credit Suisse failure perhaps is the clearest example. You mentioned the amount of money the Swiss National Bank had to provide leading up to and through that resolution. We look at the capacity of the SRF, the 80 billion there, and even if we add in the ESM backstop, were it ratified, that takes us to about 150 billion euros. That's still less than the liquidity that the Swiss National Bank needed of Credit Suisse, and it's actually less than the Federal Reserve gave to the FDIC in the US to deal with their regional banks that failed in 2023. I think the euro area has something like 17 banks larger than Credit Suisse. So liquidity in resolution is a key finding. I think there is a concern in our mind that this continued reliance, these missing blocks and the inflexibility in the SRM, if I look at how I would design a resolution regime from first principles, I would look to a regime that allowed more flexibility on its loss-absorbing rules for more complex, more systemic banks. And I fear in the European regime we have less flexibility for the more complex, bigger banks within the Single Resolution Mechanism. We have more flexibility for the other banks that can, one way or another, be resolved at the national level. They're not subject to the 8% of those 5% rules. I think that doesn't help in giving people confidence about level playing field. I think there's issues around risk sharing, and tendency to maybe have more so-called voluntary industry support and state support within resolutions in the national liquidation resolution regimes than in the single resolution mechanism. So if we were designing this regime, we would design it with more flexibility within the single resolution regime. So a key recommendation, it's one that we made, I think it's a recommendation we've made since the onset, since the time the BRD was being negotiated, was that the SRM really needs some form of financial stability, a systemic risk exemption, whatever you want to call it, to allow that 8% and that 5% limits to be removed, if necessary, to preserve financial stability risk in the euro. I think those limits were key to getting agreement across nations. They were, I think, probably a key tool for getting banks to generate MRL. But I think it is a fundamental weakness that we still face in the euro area, that I fear the SRB doesn't have enough flexibility in some cases, in some circumstances. Financial stability risk, complexity of resolution increases with the size and the cross-borderness of your banks. And the biggest banks, there is less flexibility. We also made a recommendation to address the liquidity in resolution. It's a complex issue. ELA, Emergency Liquidity Assistance, is still at the national level in the euro area. It's not at the ECB level. Clearly, there's a whole host of reasons and history behind that. We thought a solution that we recommended would be that to allow central bank liquidity to be provided to a bank in resolution by using the Single Resolution Fund as a guarantor. So we recommended that the Euro system accept a guarantee for the Single Resolution Fund to provide liquidity to a bank in resolution. And I think that would address one of the key missing parts of the resolution regime. As I mentioned, we reiterated our recommendation to actually have a European Deposit Insurance Scheme, EDIS, with full loss sharing. I know that's not politically seemingly expedient at the moment. As I said, the joy of working in the IMF is we're not constrained by politics. We can give our recommendation independently. In that context, we did recommend that we strengthen the national deposit guarantee schemes. So both increase the amount of funding in the national deposit guarantee schemes, the 0.8%, 0.5% in one country, but in most countries 0.8%. We think that needs to go up. And we also think that they need stronger backstop liquidity arrangements. So while we're not having risk sharing, we still have the national compartments of deposit guarantee schemes. We would raise more funding in those and provide better backstops to them. Then we had a whole heap of more technical recommendations. I don't think I'm going to speak to many of them in the interest of time. But I mean, again, to reiterate that the build-up in MREL was a major achievement in enhancing resolvability. I do think we have some questions around the US security law issues that need to be nailed down. This is a key finding out of the Credit Suisse case, and it's something that we know that it's been worked on internationally. That a lot of the European bank MREL has been issued in the US and in different group structures. So, how the US authorities will treat a bail-in of those securities, I think that we have some ongoing questions that need more clarity. We've seen the SRB really step up its planning. The SRB expectations for banks, we found, have improved the coherence and industry understanding of resolution planning. We've seen the acceleration of the work on internal readiness, the national handbooks, the playbooks for resolution tools, and the strengthening, I think, which is really important, of using transfer powers, not just relying upon a bail-in, standalone bail-in strategy, but the ability to flex to a strategy that every single bank failure is different. If you may need to transfer parts or all of the business to someone else, and having the ability and the capabilities to implement that is important. So many congratulations on that. Finally, I think I'm going to stop because probably the last one is, we would talk about the governance arrangements. The government's procedures, the amount of authorities that need to take a decision to implement resolution is quite complex, but it's been proven to work. However, we do think there is space to strengthen the SRB's autonomy. We probably would recommend that it's made an independent treaty, given a treaty, so that it has a more legal standing, and that we would reduce the amount of national discretions and differences in implementation that we still see across the membership. So greater use of the SRB's ability to, apply a regulation across the system and less use on national legislation. So with that, I think I would say, I think it's a very impressive project. It's had some successes that should be celebrated, and it faces some challenges which I would encourage the politicians to try and address going forward. Thank you.
Thank you very much, Mark. This is much appreciated. A way to summarize your nice words is maybe the emperor is not yet fully dressed. So thank you for sharing your thoughts on this. Maybe I'm in the hands of Luis Joao. Maybe just to show that I've done a bit of my work. A question for each of you to answer quickly, and the first is for you, Elisa, being here in these premises, not on the current use, but on the former use. I would like to ask you about the spirit of the risk reduction and risk sharing. So where this spirit was lost? Is there anything you regret of not putting in law the three banking pillars at the same time, so we would have an EDIS instead of first risk reduction, then risk sharing without any calendar? So this is the first question. The second, the question for you, Pedro, you have a big amount of experience before the SRB on dealing with crisis, and we've been watching also crisis, and normally the solution is not bail-in. The solution is a transfer or a breach, a sale. So I would like to have your quick thoughts on this, because I have the feeling that bail-in is very, very theoretical, while in practice things are sorted out in a different way. And then for you, Mark, we are used. IMF is quite blunt, and we appreciate being blunt. So a blunt question for you is, if this afternoon a big bank under the remit of the SRB fails, are we ready to resolve it or not? Thank you. So maybe Elisa, but please, this is a plea, try to be concise, if possible.
I will. I will. Okay, so on risk sharing and risk reduction, I think the reason why the third pillar was not developed was for lack of trust, mutual trust. And at that time, maybe it was justified. Nowadays, I don't think it makes any sense. And the idea that you should have a single market and consolidate banking structures cannot fly if the risk is not shared. So if going into details that I will not go, but certain countries believe that they would never need to use it, and that they are absolutely self-protected through some mechanisms of mutual support. It's also important to verify if that works in a moment of crisis or not. Here, I think, I could not say it in my speech, but I think here we went through, and the contribution and our contribution was very much based on a huge capacity, technical capacity of the national supervisors and resolution. In particular, of course, Pedro Machado, João Freitas, Luís Costa Ferreira. So the team of the national supervision and resolution has got to be strong and knowledgeable, so that in fact we get into an equilibrium across Europe, and we have really this, more similar way of managing things, and that we support the single resolution and single supervision. Otherwise, the touch with the national markets is lost.
Okay. Thank you very much. Pedro, please.
I think on your question regarding the transfer tools, I think the transfer tools are very critical to have success in resolution. I think and even I would say, you mentioned the case of bail-in. I think we should also consider bail-in in the perspective that it can also be combined with resolution tools. So I think this is the sort of flexibility that I think that the IMF also points in the findings of its sub-report. But what is essential in terms of the transfer tools is critical is the operational readiness, both from the side of, in this case it would be the SRB, and from the side of the bank. Because basically what you are doing in this short time of period is that you have to create a certain level of information that is acceptable for potential acquirers, and for that you have to have really, it's of the essence that the operational readiness in terms of marketing documentation, so what is needed to carry out due diligence in this short time frame, that you have this ready, that you are able to very quickly set up a virtual data room, so that the investors, and you generate a sort of confidence on the investors in terms of the level of information, not to mention, of course, in terms of the valuation. I think it's very critical to get the valuation data points right, because this is very critical for a decision that can be taken on that weekend. And then to have a sort of modular approach towards a transaction. You can have set in the resolution plan that you wanted to carry a sale of business by means of a share deal, but it turns out that the investors' appetite during that weekend is a totally different one, which will need that you have to carve out certain assets or certain liabilities, set up eventually a special vehicle, as it was in the case of Banifia set up, do an asset deal instead of a share deal. So you have to keep a sort of modular approach, and at the end be prepared for the fact that we might not get a sale through, we might not get investor appetite, and we'll have to set up a bridge bank. So I think this is really, the toolkit has to be, the essence is to be operational ready, readiness is of the most, and keeping flexible the solution.
Thank you very much. Mark, maybe your thoughts?
I feel like I should turn this question to the SRB, but I'm not going to. I think it's useful to compare where we came from. So in the global financial crisis in Europe, every systemic bank was bailed out, right? The shareholders ultimately kept value. Often, in some cases, the banks were nationalized fully, and so the shareholders lost money, but no other creditors did, right? So we were bailing out bank creditors for systemic banks in Europe. I think the European authorities have built a resolution regime which has a real prospect of not falling into that trap again. The preparedness that we have, the MREL, the capital liquidity in the system is very impressive, and it gives you, as a resolution authority, a range of options that you didn't have before. But I do think there are some challenges out there. Liquidity and resolution is absolutely crucial. I mean, the speed with which runs happen on banks has only grown over time. I think I can remember, was it Continental Illinois, where FDIC complained in the 80s about telephone deposits running too quickly, and in Northern Rock we complained about internet deposits running quicker than the branch deposits. You know, the speed of the runs that we saw on Credit Suisse and on the regional banks, the 24/7 access to deposits, social media, all those things make runs a lot more critical. Liquidity is crucial to stabilize a balance sheet. And so the two things I would focus on I am confident the European authorities will be able to resolve banks, systemic banks, in a way that doesn't involve bailing out them out before. But I'd feel more confident if we had an agreed arrangement to provide sufficient liquidity to run on a systemic bank in the euro area leading up to and through resolution. And I'd feel a little bit more comfortable if we had more clarity on the MREL that's been issued in the US market. The US market is a key funding market for the European banks, and there are still some questions around how the SEC will treat bail-in strategies. So I think those things need to be resolved, and then I'll sleep even better than I already do.
Thank you very much. Maybe we have time for, I know that you are thirsty of asking questions to the three panelists, so maybe we have time for a couple of questions. Please identify yourselves and to whom you are addressing your questions of the three panelists. Okay.
Thank you very much. It's a pleasure to listen to you. The journey is being very good. It's clear that regulation and supervision improved a lot. Today we are much better than we were 10 years ago, 20 years ago. Sometimes you go too deep. You start with the forest, the tree, the branch, now you are in the fruit. A balance is necessary, but my question is different. It's related with something that Pedro mentioned, that we have right now, obviously, new risks, and digital risk is very clear. So my question is for each of you. It's not a. Do you understand? I understand that we have that idea in our risk system. Digital cyber risk is a critical issue. Social media is very important. You mentioned the Credit Suisse and the digital and the speed of the money flow. It's absolutely amazing. You defined, the rulers defined the SEPA immediate transfers. That will start on October 5. That together with the cyber risk, my question is, are you aware of the difficulties, the risks that that rule could provoke to the system in a situation where when the money flows, it's very difficult to stop it? And if we put together this rule with the increasing cyber risk and crime, that will increase I would say, the risk of the situation. Are you aware of that?
Thank you very much. Maybe we can collect another question from the audience. No, you are more thirsty of coffee than wisdom from the panel. So maybe Pedro, you can
well, sure.
answer the gentleman.
I think the question by George, I think the question is a relevant one, but I think you have to factor it more in terms of the broader digitalization processes that are being put in place. And this concerns both what you have both on the side of the operation of banks, both in the side of the system landscape. We cannot, I mean, the digital innovation in terms of payments and the speed is so powerful that trying to address it through certain of the measures that we fight to contain maybe is like to try to stop the wind with the hands. I think what we have is to reinforce, as it has been reinforced after the Credit Suisse case, the monitoring of liquidity. As you know, that we have put in place a joint liquidity. As you know, the frequency with which liquidity was being reported was too really not providing an accurate picture in terms of the situation of liquidity. So I think now the frequency, and sometimes we hear some complaints from the banks that the frequency now is being too demanding in terms of the reporting. So I think what is of the essence, and eventually we have to try to discuss in terms of international standards things like liquidity coverage ratio and so forth. But apart from that, there is one thing that is very crucial in terms of the broader landscape, is sort of monitoring, as we have seen many banks doing it, monitoring constantly the sort of social networks, news that pop up in terms of the bank. So I think there is what is requires is that a much more robust liquidity management from the side of the banks as it is today. I think we have really, and I think we have to appreciate that we have to also enhance that part. In terms of the frequency of reporting, it has to be even much more granular. And I think there is a constant drive to constantly monitoring and trying to quash situations that can lead to extreme tail events. I mean, there is a study from, there are findings, there is a study from the ECB just published this month, an ECB paper on findings on the correlation between using of home banking and apps and the deposit volatility. I mean, the findings are there to see. It's very impressive in terms of the speed with which this has happened on the basis of past cases. So, I mean, I think we cannot act too much, but I mean, now in terms of the situation of payments, it's not really my turf because this belongs to other areas. This is not my turf, but this for the moment is what I would try to sort of craft in terms of general approach towards these extreme liquidity outflows that might be generated.
Thank you very much. Please join me in thanking the panelists for the excellent thoughts that they have provided.
Let's get from the thing.
Thank you very much to our moderator and to our panelists. I think you are all forgiven for exceeding your time.
We will now pause for a coffee break. Please join us again at 11:50 for our second panel.
decade of case law in the banking union. This discussion will be moderated by Mr. Gonçalo Castilho dos Santos.
Mr. Gonçalo Castilho dos Santos is the Secretary General and Head of the Legal Department at Banco de Portugal. And we are also delighted to welcome the following panelists: Mr. Carl Philip Wojcik, Mr. Carlos Costa Pina, and Ms. Ana Estrela de Oliveira.
Thank you.
Thank you for attending also this second panel. First, I would like to thank our Vice Governor, Máximo dos Santos, for this invitation. It's an honor to moderate this panel, and also to congratulate my colleagues from the Resolution Department for this so high-quality event. And of course, to thank our speakers. To this second panel, as you understand, the legal frontiers of banking resolution, a decade of case law in the banking union. So it's a law case panel. We'll try to embrace all the dimensions, and we'll have time, of course, so that the audience could raise some questions after this first round of interventions. First of all, I would like to present our distinguished speakers. Carl Philip Wojcik is currently an executive advisor to the European Commission's Executive Vice President Rafael Fito. Carl Philip was the General Counsel of the Single Resolution Board from 2020 until very recently. He is graduated in law from different universities, PhD, bar in Germany, qualified as bar, also with the experience of judge in Cologne, and joined the European Commission in early on the 2010s. He teaches EU law. He contributes to lots of publications and public debate, mainly in EU constitutional and judicial system, European monetary union, banking law, and private law. Thank you very much, Carl Philip. Also, we have with us Carlos Costa Pina. Carlos is currently partner at SRM Legal, but mainly he embraced experience both in public sector and private sector. He served as Secretary of State for Treasury and Finance. He was director of the Portuguese Securities Market Commission, member of the advisory board of the Portuguese Insurance Institute, and also legal advisor not only to the Minister of Finance, but also to the Prime Minister's office. Carlo was executive board member of Galp Energia, with experience in different real estate service companies, but mainly also regarding member of Fuelers Europe Brussels, and when member as board member, he oversees several areas like innovation and development, risk management, insurance, new energies, and so on. He is graduated in law from the University of Lisbon. He lectured economic and financial law for over 2 decades in the university. He recently holds a PhD in law, and I would like to stress that his thesis was about and is about the banking union and the paradigm of stability, financial crisis, and regulation. Thank you, Carlos, to be with us. Finally, but not least, Ana Estrela de Oliveira. Ana is currently an off-counsel in the corporate and MEA practice at Vieira de Almeida since 2000, very recently, but of course she is known as a doctorate in law from the University of Lisbon, where she is a tenured associate professor. Mainly in commercial law, company law, and civil law. Anna also is currently the president of the School Council, member of the Scientific Council, vice president of Research Center for Private Law. Anna has served as member of the Management Committee of the Portuguese Resolution Fund. She sits on several editorial boards, arbitrator, preparing legislative projects in Portugal and abroad, and finally author of numerous publications. Thank you very much, Anna, for combining all these as academic and also practice and lawyer. So we'll have a very exciting and stimulating panel in front of us. Carl Philip, shall we start?
Dear Gonzalo, thank you very much for your kind introductory words. Ladies and gentlemen, let me first thank you, Vice Governor, dear Luis, but also you, Joao and Joanna, for your kind invitation today to this exquisite conference with distinguished speakers and in front of a distinguished audience. It's really a great honor to be here. At the same time, it's also a real pleasure to see so many colleagues and friends. With them, I had the extraordinary privilege to build over the last years the banking union in the service of financial stability and ultimately for the welfare of all our societies. Today, my focus will be on the role which the law, and in particular the case law, has played over the last 10 years and that is already my first message today, in strengthening the banking union. My views will obviously draw on my experience as the former General Counsel of the Single Resolution Board. That means that they will necessarily reflect more of an inside, more of an institutional view, while still being my personal views, obviously. I will structure my presentation in two parts. In the first one, I want to share with you a couple of judgments and case law, which probably has had the most impact, I would say. And then in a second part, I would like to reflect with you on the impact of that case law, and in particular on the role of the courts on financial stability in the banking union and beyond. And first, I would like to give you a little bit panorama of context. Back in 2015, we've heard it already, the entire EU resolution framework, hundreds of complex legal provisions at the intersection of insolvency law, corporate law, supervisory law, administrative law, even constitutional law, was completely new, unapplied, untested. And you know, this framework gave resolution authorities newly created huge powers to directly interfere with rights of stakeholders. I think at the time the world was watching and the jury was out. When we now fast forward 10 years, that framework has been applied. We have heard about this already this morning quite a bit. And also we have built quite a stock of case law on EU resolution specifically. And I would say, if we count the numbers, we are at almost 500 cases in the courts. In more of 450 of these cases, it was the SRB which was being sued. So 450 cases, that's a lot. But that is, I would say, we like it or not, this is, I think, the normal fate of any resolution authority when the resolution authority is doing their job. Think only about the litigation aftermath of Credit Suisse. And here at the Bank of Portugal, I think colleagues think about BESH, then I think you will surely agree with me. And you will here at the bank also surely agree with me how operationally challenging and rewarding at the same time it is to ride these litigation waves which come after the resolution. These are litigation waves which bring the litigation, and I think this is also important to notice, not only to domestic courts or EU courts, but actually these waves, they find any shore in the world. They find UK courts, they find US courts, they go to arbitration tribunals all around the world. And as the former SRB General Counsel, I know what I'm saying, having managed together with my team, obviously, more than these 450 cases on behalf of the chair and the members of the SRB. And I'm very grateful for their constant support and the support also of all NRAs in defending the position of the SRB.
Now to some of the impactful judgments. First, you need to know that actually the litigation cases, the 450, in which the SRB was involved, they can be divided up in three big areas. The first area is linked to the resolution or non-resolution of banks, so it's what I would call the crisis-related cases. A second area is linked to disputes concerning the contributions which the banks have to pay into the emergency fund, into the single resolution fund. It's also obvious because a lot of money is at stake, so like with taxation, nobody is happy with what he has to pay. And a third area is basically all the rest, like access to documents, MREL decisions, data protection, and so on. The bulk of the litigation in terms of numbers comes from the first two areas. I will here today only or briefly focus on the very first one, so on the crisis-related cases. Because I think that from a horizontal perspective, the findings there are probably the most interesting ones for our purposes today. And here it's in particular the judgments of the EU courts, as I call them, so the General Court and the Court of Justice in Luxembourg, which are most pertinent and which have brought clarity on the following issues. So first of all, the EU courts have validated the pretty innovative, I would say, setup of the SRM governance with its multi-layer involvement of the SRB, the Commission, and the Council. That was pretty innovative at the time when it was set up. And specifically, the Court of Justice has clarified that in the context of resolution, it is the Commission endorsement decision of the resolution scheme, which is the act which deploys legal effects and against which discontented shareholder or creditor has to bring an action. Just to highlight the importance of that, because in the Banco Popular cases, which were more than 100, most of the cases were only brought against the SRB. So this judgment gives a lot of clarity. EU courts also looked very thoroughly and carefully into the conditions of resolution, into the resolution tools, and into the procedures. And I think I can already say that they showed overall deep understanding of the aspects of urgency and the need for speed when judging decisions taken in crisis. For instance, EU courts confirmed that the SRB could rely on valuations 1 and 2, which were only provisional at the time when the decision was taken, and that because of the urgency of the situation. This is a quote from one of the judgments. In the same vein, courts ruled that certain rights of defense, like the right to be heard, the right to access to the files, could also be limited in crisis situation due to financial stability considerations. Think about asking the bank whether they are okay to be put into resolution, right? I mean, I think this would be a self-fulfilling prophecy. So judges understood that. Judges also understood and provided detailed guidance, for instance, on how to use the sale of business tool. So they confirmed that, first of all, this transfer tool, which is a forced transfer, is legal. And then secondly, they validated also the way in which the sales process, in the case of Bancola, was run by the SRB together with the NRA. All of this should, however, not give you the impression that the EU courts were only permissive vis-à-vis the EU authorities. No, EU courts also considered very carefully the fundamental rights of shareholders, of creditors, and other stakeholders as part of the rule of law. Actually, EU courts are very clear that where resolution actions interfere into the right to property, such interference needs to be justified. And it needs to be justified thoroughly and case by case. They are also very clear that one of the most important pieces for the protection of fundamental rights of stakeholders in that situation is that the resolution action is economically neutral, as they say, and it does not deprive the bank or its insolvency estate of its economic value, if there is any, obviously. And in the SRM framework, this piece is ensured by the payment of compensation based on a so-called valuation 3 in case there are violations of the no creditor worse off principle. So this is a crucial cornerstone of the framework. Now, when looking at the valuation 3 in Banco Popular and the decision of the SRB not to pay compensation because there was no violation of the no creditor worse off principle, again the courts validated the approach and they gave very useful guidance on the methodology, how to run such a valuation, on the safeguards, on the role of the independent valuer in all of this. So you see there is a panorama of important findings, and I will stop here on the case law, and I would like now to move to the next part, reflecting with you on the impact of this case law and the role of the courts. And I think when we look back on the last 10 years, there are a couple of messages to be sent, a couple of conclusions which can be drawn. First, I think we have now, 10 years after the inception of the SRB, enough case law to say with confidence that EU courts have fundamentally validated the EU banking crisis framework, which was introduced and which was such a novelty. So the framework was found to be legal, first of all. In the cases when it really mattered, the actions taken by the authorities on the basis of this framework were also considered to be sound and legal. Dominique already mentioned this morning. Then, third, the guidance given by EU courts has shown the professional understanding of the judges for the need to act swiftly in situations of crisis and urgency to safeguard financial stability, and at the same time also safeguarding fundamental rights. And I would say that the confirmation of the SRB's action by EU courts overall has increased the credibility and the trust in the SRM's overall functioning. It has also increased the SRB's and the NRA's reputation, and it has, of course, also increased the reputation of the executives and the staff who have taken all these decisions. So, in this way, EU courts and their case law were instrumental to achieve the high respect which EU bank resolution framework enjoys also in foreign jurisdictions. This last point I've heard in a couple of, or not only a couple, I've heard this opinion many times when talking to non-EU interlocutors, be it investors, be it authorities. And I think particular in these geopolitical times, we should also not be shy to promote such a success. Another finding is that looking at the numbers, so 450, 500, and this is only the SRM, I cannot help but noting that for the banking union, and that I mean now is both the SRM and the SSM, and don't forget also the ECB is being sued, so there is another stock of cases there. I think that it is fair to say, as an observation, there is a process of judicialization going on in the banking union. Or to put it in different words, EU courts have become important and trusted players in the area of banking supervision and bank resolution in the EU. Why? Because differently to the national level, where stakeholders often shied away in the past from bringing the supervisor to court, in the banking union, stakeholders have chosen to exercise their fundamental right of judicial review against decisions of the ECB and the SRB. And I think that this trend is here to stay. And supervisory and resolution authorities, through their legal services, will have to establish a permanent dialogue with judicial authorities. Let me underline again, the fact that stakeholders go to court for judicial guidance and is a sign of confidence in the EU framework and also in the EU courts on the one hand. And it is also sometimes a nuisance as an authority because it takes time until there's a judgment and so on. Overall, it is enhancing the credibility and the trust in the framework and in the actions of the authorities. Finally, the vast case law of the banking union is also spilling over into other areas of EU policy. If we look at recent judgments of the court in other areas of EU policy, you will see that nowadays judgments are very often referring to judgments which the court has delivered on the field of the SRM. I have in mind, for instance, competition law judgments, I have in mind consumer protection, but also when it comes to procedural questions. So in case law, which is completely unlinked with the SRM, there is a lot of references. And I think this is remarkable because it shows what type of fundamental questions the courts had to answer in the first years of the existence of the SRM. It shows that the case law developed on the banking union has dealt with the frontiers of EU law. And in this way, this case law has become an important catalyst for the development of EU law more generally. So the EU banking union law, case law has become a catalyst for development of EU law generally. Let me conclude. The first 10 years of the existence of the SRM meant putting a new, complex, untested legal framework into action. This was uncharted territory. Next to the decisive actions of those responsible for the SRB and the wider SRM, it was the case law which has provided very precious legal clarity, has instilled credibility and trust in the system, and has basically therefore also delivered to financial stability and the remarkable resilience of the European banking sector over the last 10 years. And I'd like to stress that these very positive judicial outcomes would not have been possible without the highly professional work of those who prepare these decisions, those who then take these decisions, and those who defend them later on in court. And all of this, again, is based on the very close collaboration between the SRB, the NRAs, and the EU institutions in this mechanism. Pedro, you were mentioning this many times, and I think very rightly so. And in this vein, I would like to express my special gratitude to the team of the Banco de Portugal, who have been always exemplary in the way they were working in the SRB. Finally, I would like to express also my sincere gratitude and deep respect to the work of Professor Luís Moraes. In his capacity as the Vice Chair of the SRB Appeal Panel, he contributed, Dominique mentioned this already this morning, but I would like to repeat it, he contributed significantly to the legal certainty and to the case law on the SRM. He passed away far too early. Now, I look forward to my co-panelists' presentations and to our dialogue during the Q&A session. Thank you very much for your attention.
Thank you.
Good morning, ladies and gentlemen. It's a great pleasure to be here today, and thank you, Vice Governor, for the kind invitation to be here, and also to Gonçalo for this opportunity to share also my views on these topics. I also take the opportunity to present my compliments to my fellow colleagues of this panel, and I also would like to start to join my voice to the tribute to Professor Luís Moraes that we miss a lot, and I present my regards to the family that is present here today with us. So, the challenge today and the topic that I was challenged to discuss here today, it's about, I'd say, a magic triangle of three main aspects. How to protect the public interest, so what needs to be done for the public interest to be protected. How about to deal with the fundamental rights, and particularly with property rights, so what we need to respect. And finally, what is possible to do, considering the restrictions in terms of central financial capacity and financial solidarity. So the so-called question of lack of trust that was mentioned before in this panel. In the resolution issues, although we have a framework, and we have a lot of lawyers present here today that are well aware of this framework, I can say that all of us, we are welcome to the world of exceptionality and the world of ad hoc decisions, because when we are talking about resolutions, we are really talking about exceptionality and ad hoc decisions. And we are in a building with the doors closed, but a lot of windows open. Let me exemplify that. We close a door to the bailouts, but we have windows open to public support. We have the doors closed in terms of protection, the fundamental rights, and namely the property rights, but we have the windows open for bail-in and for the need to apply the resolution tools. We have a door closed in what concerns to the rule of law that must be respected, but we have windows open for the need of discretionarity of administrative agencies and also the need for a certain judicial restraint that Carl Philipp just mentioned before. On top of that, we have a problem. In the European Union, we have an international organization, but with no state, with no constitution, and let me say, maybe this can be debatable, with no European people, at least on the way we see the people in the sovereign organizations or in the sovereign countries. So we move, as Elisa Ferreira mentioned before in the last panel, from the internal market model based on mutual recognition and EU passport to a model of centralization. But this centralization has a certain contradiction, because we need to exercise discretionary powers at the level of agencies, but the EU law, coming from the Meroni doctrine, from a case law in the 50s of the last century, doesn't allow the use of discretionary delegated powers at the level of agencies, and discretionary powers is an exclusive of European Union institutions. So it is indeed a legal conundrum that we need to address. And on the side of resolution, we have also a divided centralization, because when we are talking about the failing or likely to fail criteria, I would say the maker of that assessment is the ECB, the taker of that assessment is the Single Resolution Board, but when we are talking about liability, and when we are talking about the authorities to be sued at the courts, is the SRB, the one that acts to give the explanations, and not the ECB that was the maker of the fourth failing or likely to fail assessment. So this creates indeed some, I would say, complications when it comes to apply the European Union law on this field. So, addressing the first topic about the public interest. Indeed, we are talking about a multidimensional characterization of the public interest, because we have to deal with investor protection, consumer protection, competition, market stability, price stability, fiscal or budgetary stability, and at the end of the day, or at the beginning, also with financial stability. But addressing financial stability, in reality, we don't have a dilemma on this. We have, indeed, a trilemma. So we don't have only resolution versus liquidation. We have resolution with no bailout. We have liquidation, and we also might need to have a really bailout using public funds and public support. So as Professor Schillig said, in I'd say a relevant characterization of this problem, we have the insignificant cases that are dealt with the insolvency framework. We have the easy resolution cases, but when it comes to the hard cases, we'll need to have, at the end of the day, public bailout, if public bailout is really needed to protect financial stability. So the way we protect public interest is really complex. So, and indeed, we have these windows open for not only the extraordinary public support, but also for the precautionary capitalization. And in a particular case in Italy, Banca di Monte dei Paschi di Siena, what we have, it was a so precautionary capitalization that it was given 3 times to Banco de Monte dei Paschi di Siena. And this was made 3 times since the bank was solvent. So even on the area of public support, the, I'd say, sacred rule of 1 time, less time support was not applied in this case. So 3 times was the benefit of public support in this case. And this case was different for the other ones that have already been mentioned, the case of Veneto Banca and Banca Popolare di Vicenza. In these cases, the banks were not solvent, but the decision was to recognize that we didn't have public interest in the resolution of these banks. So the solution was a national liquidation of these banks. But you can ask, this was a real liquidation? I would tend to say no. This was more a resolution-style liquidation, since the performing activity was sold to Intesa São Paulo. The non-performing activity was sold to asset management companies using the sale of assets tool, and only the rest, remaining part of the balance sheet, was bailed in. So this means that the legal frontiers of resolution are really fluid on this field. Let me now address the issue on fundamental rights or property rights. We have indeed a closed door for the protection of these rights, since we have a very important principle in the resolution, the principle of neutrality, no creditor worse off. But of course, we have the window open for the bail-in. So I will not address, I would say, the technicalities about the material protection of property rights or the procedural protection of property rights. I will also raise a quick question on this field, that is how to protect fundamental rights with the margin of appreciation that we need to recognize to the authorities when it comes to take decisions about resolution. And in parallel, we have, on top of the administrative discretionarity, also the judicial self-restraint. But what is a particularity here? This judicial self-restraint is not the classical one coming from the constitutional law and based on the separation of powers. This judicial self-restraint is based on what the German qualify as the Europarecht-Freundlichkeit, so the principle of openness of the European Union law to the European Union integration. And on the basis of that, in relation to this, also the conflict between the need to recognize discretionary powers, but at the same time, how to deal with the Meroni doctrine limits that doesn't allow to recognize discretionarity to the authorities. But fortunately, this year, February 2025, a very relevant case, I would say, the case of Volksbank, that in an important decision simply said that this power is a decision from the European Union Court, this power of appreciation or this margin of appreciation that was given by the Commission to the SRB shall be clearly limited, and its use shall be subject to an accurate fiscalization under objective criteria. Anyway, one thing is important. Although the Meroni doctrine closed the door to discretionarity of agencies, more recent decisions, and namely this one, expressly recognize the need for this margin of appreciation of SRB. So, finally, moving to the question of central financial capacity and the question of solidarity. A very known professor, Daniel Gross, said that, and I'm quoting, any safety net comprising deposit insurance and resolution implies a credit risk that ultimately must be lodged somewhere. In the Eurozone, it has so far remained at the national level. However, this is clearly not a stable setup. So, this is, I'd say, a very good synthesis about the problem that we have here, and that Dominique Labourie also said in this speech, quoting Mervyn King when he said, banks are global in life, but national in that. So that's the reason why we need really to move on the building the third pillar of the banking union. Different proposals have been made on this field. In US, besides the Federal Deposit Insurance, Federal Deposit Investment Company, we assisted to different proposals in order to address the need to have central funds to deal with the bailout situation, namely a systemic emergency insurance fund, is the proposal of Gordon and Muller. And also in Europe, we had, I would say, similar proposals. The one about the European Deposit Insurance and Resolution Authority, made by Schoenmaker and Daniel Gross. So, again, insisting on the need to the third pillar of the banking union. But unfortunately, we have been assisting during the latest years, I would say, a certain giving up about the build of the third pillar. And even talking about the CMDI proposals, Dominique Labourie also said that we need a fresh start. So what is underlying these words is that it's maybe better to forget the third pillar and try to rebuild the banking union only based on two pillars and forget the third one, since we'll rely, as Elisa Ferreira said, on the national DGS, the deposit guarantee schemes. What is the problem that we have here, and I'm concluding with this, is that with CMDI proposals, we have also recognized the need not only to deal with resolutions of big banks, the ones too big to fail, but also the SMEs, the small and medium banks. Because as a consequence of the very recent crisis in US and in Switzerland, this raised, well, in case of Switzerland, is not properly a small bank, but at the level of the United States, this creates indeed this problem. But the point again is the same. So how we can enlarge the task and the responsibility of the resolution authorities to be in charge also of the resolution, not only of too big to fail banks, but also the SMEs, but at the same time we don't have central fiscal capacity and we have to rely on the financial capacity of the national deposit guarantee scheme. So this is an unsolved problem that is, of course, creating a risk to the system. Thank you very much. This was the topics that I like to share with you. And of course, I will be available for questions at the Q&A after my third colleague. Thank you very much.
Obrigado, Carlos. Obrigado.
Hello, everyone. It's a great pleasure to be here and mainly to have the opportunity to discuss resolution from a legal perspective with all of you, I hope, in the end. Resolution has proven to be, as I think we all agree, a central piece of the constitutional puzzle rather than an exception to the Constitution, and this is something I think it's very important. More than 10 years have passed since this, what we may call a new era, has begun, and we have learned a lot during these 10 years, and most of all, we now know that the resolution is compatible with the constitutional system, which was something that was far from clear, as someone or everybody said 10 years ago. So I remember being at a conference in our university, in my university, the Faculty of Law of Lisbon University, almost 10 years ago with Luís Máximo dos Santos and other speakers, and we were discussing the constitutionality of the regime, and none of us knew what the positions of the courts would be. And today, constitutionality of the mechanism is well established, and I think we almost forget that this is a huge victory for all of us. We are still discussing, I'm well aware of it, the concrete application of general principles to concrete cases. We know there are still cases running before the courts, some of which are very problematic and will remain problematic for some time, but in the end, we accept that the rules regarding resolution are objectively challenging, are complicated, we'll talk about that a bit later on, but they are acceptable. And the truth is, this is the first victory we had during these 10 years. And this is also the first point I would like to make. The message from the case law is very, very clear. There is no violation of the Constitution, which does not mean, of course, we should overlook the problems and that are related to the concrete application of resolution measures, nor should we ignore the issues that still persist, which would almost be unrespectful for people. So everything had to be achieved, everything had to be construed by the legislator in first place, by the institutions, and above all, by the courts, or at least not destroyed by the courts, because they played here a very, very important piece in this puzzle. And this is also a very important aspect to bear in mind, this tension between the potential violence of the regime, on the one hand, and the balance and this restraint you were talking about, shown by the Portuguese case law, something very, very important. The truth is that resolution not only passed the constitutional test, but it did so with distinction. And ultimately, it was the recognition that it was a necessity, of course, and it was a lesser evil. We all know that's the main reason, but the new creditor worst of principle played here a very, very important role for the judges. And if we do have two alternatives, we may say we may have other smaller alternatives, we have two big alternatives. We should avoid the one that is more detrimental if we are able to protect the financial system without damaging too much people's right to property. And this is also very important to bear in mind. Portuguese courts exercised what I would call a very functional control. They had a very purpose-driven approach to the resolution regime. They were worried about the consequences of their decisions, which is not something that we, in company law, we are very familiar with. The exact opposite. Most times, courts don't worry so much about the impact of their decisions. Here in the resolution context, they were very worried about the impact of their decisions. We'd say they had to be, of course they did, but they were facing very complicated situations, very complicated decisions, and case law remained coherent in the protection of the legal system and the financial systems, both alike. So the construction of bank resolution as an institution is a very interesting case, and I would say a rare case, where the political, the legislative power, the administrative power, and the judicial power, the review by the courts, have come together to a result that we may consider successful. Overall, it was possible to build a functional mechanism that passed the test of constitutionality, and we didn't even need the intervention of the Constitutional Court. Only in 2025, with the Banif case, did we have the Constitutional Court ruling on this matter. The ordinary courts played here the crucial role, both lower courts and the higher courts, with the benefit of the system of the pilot process, but this allowed for uniform decisions and to very big stability in the system. Also, very importantly, of course, I do not ignore that we already had the decisions of the European Court of Human Rights years before, affirming, in the case of the resolution of Northern Rock, affirming the compatibility of bank resolutions with the European Convention of Human Rights, mainly to the right to property, and recognizing this margin of discretion of the states as far as it was in view of the public interest and proportionate, and this ex post judicial review would be guaranteed. So we didn't do it from scratch, but Portuguese courts had a very important role here, and only in 2025, as I was saying, the Constitutional Court came to confirm that there was no inconstitutionality here, and the new creditor worse off principle in the end worked as the safeguard for everybody involved. In the end, no one would be in a better off situation. So this is the recognition that the regime is harsh, but necessary and constitutionally legitimate. This is another very important point I would like to stress again. It relates to the discretionary powers of the administration. Over the past 10 years, we have been able to identify and to consolidate a significant margin of discretion of the administration. And this is something that even in highly sensitive areas, we shouldn't take for granted before decisions were taken. The margin of appreciation here allowed, it comes both ways. It allowed the resolution mechanism to benefit from the framework that was put in place, but also it allowed the administration to be an active part, to be a driving force in shaping the mechanism, because nothing was set in stone at the time. And it's not still nowadays. It is important to remember also that from the outset, this administrative action operated in a very, very particular, very delicate space. And there was a genuine risk of overstepping the boundaries of what is legally permitted and what would courts say afterwards. Because courts, everyone knew courts would come to scrutinize every decision that was being made. And there was a huge risk these decisions would be deemed not aligned with the Constitution, not aligned with the legal system. The best example would be what is probably the elephant in the room here, the retransmission cases. Essentially, these cases concern the redefinition of the perimeter of the resolution in the case of Novo Banco, and the possibility of retransmitting certain liabilities back to Banco Espírito Santo with effects retroactive to the date of resolutions. Portuguese case law has recognized that the Bank of Portugal can, even after resolution, correct the perimeter of transfer liabilities and retransmit certain obligations, certain claims to the original bank with this retroactive effect. And this is something that must be properly, very properly justified by the public interest, and especially in the light of the viability of the bank of transition, of this bridge bank, but the principle of proportionality being respected, there was the possibility the Bank of Portugal had the possibility and probably the duty to do so. So case law is, as you may see, is very, very prudent, and once again, I would say very purpose-driven, because retransmission is considered by the courts a necessary tool, and it's what allowed systemic risks indeed to be avoided and the public interest to be protected, and this was not obvious. Of course, this approach brings us to a classic tension we can't ignore. On the one hand, we have the regulatory flexibility that is required when everyone needs to act, as you were saying, very quickly, very effectively in a crisis. This is a time of crisis, you have to take decisions quickly. And on the other hand, we have the fundamental requirements for legal certainty and for the protection of trust within the system. This is indeed complicated. It's a real test that we expect not to repeat many times. We all understand how compelling the need is for the regulator to respond swiftly, to respond decisively in a time of crisis. But on the other hand, we do not ignore that there is a risk of undermining the legitimate expectations of creditors and investors and the confidence in the financial system from the other side. So this naturally raises the question whether this regulatory flexibility is compatible with the protection of trust, with the protection of legal stability, which are fundamental pillars of the system. And this is where the courts, I think, had their highest impact decisions after, of course, the resolution itself was taken for constitutional. In the context, what the courts have very well explained is that there is, in a time of crisis, there is no legally protected expectations to maintain a claim in a bridge bank. So the protection of creditors is above all compensatory, and this is okay in face of the Constitution, anchored in the new creditor worse off principle, of course. In other words, if a creditor finds themselves in a worse position than he would be in a liquidation scenario, in an alternative scenario, he is indeed entitled. His rights to property are not at stake. He has the right to property, but from a compensatory perspective, they do not have the right to the reversal of the retransmission itself, which would have had a huge impact in the system. So at this stage, I think it is fair to ask if it is appropriate, even if it's not offensive, to speak about the success of the resolution regime in Portugal, given that we still have many cases that are unsolved. Some parties have, of course, still in a situation that they need to be compensated. We do not ignore that. Question persists about how these principles are applied to concrete real-world situations, but the fundamental question that many people pose, and the courts answered very adequately, is whether this solution is not trading real rights for promises on paper. And the answer, and trust, of course, the rule of law is grounded in predictability. So if the regulator can retrospectively remove claims from the Novo Banco, many people would say there is a risk of undermining the confidence of investors and citizens in the financial system. The reason the courts had a very important role here, explaining to people this is not the case, because there is a very, very delicate balance between two competing interests: the flexibility needed to protect the system during the crisis, and the need for legal certainty, for legal proportionality, for the safeguard of rights. And the case law was very clear in doing so. They were very clear, especially stating that the resolution measures have ensured the stability of the financial system. They were able to maintain the confidence in functioning of the marketing. There was no disproportionality, and the decision-making of the administration also was able to preserve the confidence of the system in delicate areas. So on the one hand, we had situations where we had to act very quickly and come back a bit in the first decisions, but always with a view in a very important principle of the protection of the financial system. And it's not only the financial system, it's the whole economic system that was at stake. And this is what I think our case law understood very deeply, which once again is a great example for other cases. It's a case of high impact for everybody, for Portugal, for the European Union, and our case law had the ability to understand this in the end. And it was not case law didn't refuse control, didn't refuse boundaries. They were very clear at setting these boundaries. And they explained that these boundaries had been respected, that the right to property is protected in a different way, but in a time of crisis, there is no possibility of protecting the right to property in an ordinary way. Everybody would wish to protect the right to property in the ordinary way. If it's not possible, the administration had to do it in some other way. And that's what the courts in the end explained to all of us, I think in a very effective way. Thank you.
Thank you very much for your presentations, and thank you to help me and help us to recover some time for this panel. I will try to raise one question to both of you, mainly a previous or a present photo, I would say, from the situation, then looking forward, looking ahead. Starting with you, Carl Philip, drawing on your experience as General Counsel, what do you think it was the more complex aspects in terms of argumentation that you had to raise it and argue before the court? So what, in your experience, was the most complex? And in your presentation, you stressed that it was not a permissive jurisprudence from EU courts, and at some point you raised the issue that the economical neutrality was demanded by those courts. How do you see that? And looking ahead, in which issues or which areas do you see still some uncertainty? Where do you see some uncertainty?
Okay.
Please.
Thank you, Gonzalo, with the kind of a question which looks basically on the experience and then looking forward. Well, so you were asking what were the most difficult topics to explain to the judges. I mean, maybe saying that, let's be honest between us, nobody is born a resolution expert, not even judges. So, and even if you look at judges, many of them don't even like numbers or figures. Yeah? So there you already see a little bit the difficulties. So I think that generally speaking, a good litigator before a judge needs to be someone who actually is a translator, is a bridge builder between what the authority is doing and how the judges are looking at things and have to understand it. So that needs to be somebody who's really very well versed with the inner workings of the authority, needs to understand the topics on the one hand, but then has to be able to explain it to a totally different audience. In layman terms, obviously, or in simple terms, and I think that is the basic challenge. So to give you an example, I could give you many, but let's take, for instance, the calculation methodology for calculating the contributions to the SRF. There is a lot of text, but in the end it's just a mathematical formula. How would you explain then this mathematical formula? And also, to give you another example here, the fact that the contributions basically are set, there is a target set, and then if one bank pays more, the other bank pays less. So what we tried, and I think that works well, is if you try to explain pedagogically and use images. So we tried, and we used the image of a cake to to take a cake, it's, you know, and you have to divide it. And how do you basically bring the interconnections between the different pieces of the cake?
A metaphorical approach.
Yeah, kind of. This is one way, but of course you cannot always simplify so much. So to give another example of the Banco Popular.
Looking ahead also,
Yeah.
don't forget.
Yeah, I'm not forgetting. This will be short because everything has already been decided. No, I'm joking. But the judges were confronted with an argument which by the plaintiff saying, well, you could have used ELA, and if ELA had been, emergency liquidity assistance had been granted, we wouldn't be in resolution. Now, you need to explain ELA and the workings of ELA, which is, as you know, quite complex, to the judges. They, in the end, understood. So these are the challenges, I think, which we managed. Now, looking ahead, I think, as I said, the most fundamental issues are probably decided, but there are also certain powers which the SRB has not yet used. So, for instance, let's say the bridge bank tool has not been used. I'm sure that will be a litigation if it is used for the first time. The fund has not been used, so there will be litigation around it. Substantive impediments has not been used. There will be litigation around it. So, you see, there are certain topics, but in the bigger scheme of things, and I close with that, in the bigger scheme of things, these are important questions, but I think the bigger topics have, as we said today, already been dealt with, and I think that is the good news.
Thank you very much, Carlos, and sorry to put some pressure on you.
Thank you.
Carlos, during your presentation, you stressed the multi-dimension of public interests. Of course, you talk a lot of doors that are closed, windows that are open. So I'd like to ask you, where do you see these intersections between all these resolution framework and other areas of law? Because some of those windows that are still open probably are signals or manifestations, I would say, of intersections. So how do you see these intersections between the traditional, I would say, resolution framework and other areas of law? And looking ahead also, how do you agree that all this jurisprudence, nationally speaking, and at the European level, has indeed shaped in somehow the understanding of market participants, investors, in what concerns to the balance between their rights and so on? So I understood that in your presentation you were worried, stressing all that. What you could tell us? Sorry to put two questions in one.
Two questions in one, okay. First one, intersections between resolution framework and the other areas of law. One important intersection relates to competition law. From my point of view, frankly speaking, I think that when we are talking about a systemic crisis in which we need to address a resolution case, competition law is not an issue. Competition law is an issue, of course, for business as usual cases. But when we leave business as usual cases and we run into more complicated cases that threaten financial stability in a systemic way, of course, competition is not an issue to be addressed, because in these circumstances no one would be interested or concerned about entry or exit barriers in the functioning of the market. One other important intersection relates with insolvency law. And honestly, this is the most complicated one, because it's an area of law that the level of harmonization is lower. I think I would say that everything is to be done, not only on the substantial aspects of insolvency law, but also on the institutional approach. We have systems more based in an administrative approach, other ones in a judicial approach. So we need to have a common language in European Union on insolvency law too, so a lot of harmonization and uniformization on this field is to be done. The third one is about corporate law. On corporate law, we are in the world of the private interests, but when we move to a resolution case, we are in the world of the public interest. So we have corporate law being applied under the public interest criteria instead of the private interest criteria. But this cannot be a green way for all the decisions to be taken by the authorities. So there is a legitimacy at the beginning that need to be scrutinized about the need to take resolution measures, and there is also a legitimacy at the end of the process that needs to be scrutinized in order to assess if the no credit worst off criteria was really respected. So I would say that the transformation of the property rights in a right to compensation cannot be a green way for the authorities to take arbitrary decisions. Of course, discretionary decisions, but not arbitrary decisions.
And looking ahead.
Second question about the jurisprudence. I think that, and I'm really convinced about that. We are seeing at the level of the resolution law within the banking union, I'd say a similar approach to the one we have assisted from the beginning of the European Union law construction. Because the European Union law was really built also by the European Union courts, not only from the point of view of the legislators, but also from the point of view of the courts. And we are seeing the same at the resolution field. The question about judicial self-restraint that the courts respect and admit in order to give room of decision to the authorities, and also the way and the recognition of discretionary powers for agencies, the case of SRB, and not only to institutions, the case of Council, Commission, ECB, and so on, is also a manifestation of this law creation made by the court. And this is really important. Otherwise, we would have a problem in terms of the effectiveness of the decisions of the resolution authorities.
Thank you, Carlos.
Yeah.
Anna, I will use legitimacy approach that Carlos was stressing. You mentioned, Anna, that indeed one of the big achievements, I would say, is that resolution is not a constitutional exception, but we have still discussions about legitimacy, not so in a hard tone as it was 10 years ago, but we had. How do you assess this legitimacy topic? If you would like to share with us on that. And looking ahead, I would like to ask you, what lessons do you think that could be drawn from this line of case law these last 10 years, mainly on those uncertainty areas that Carl Philip was stressing? So what lessons to prepare, as Elisa said, to terraining times that will come, let us hope not, but how do you see these lessons on these uncertainty areas that we still in front of us?
I think everybody learned a lot during these 10 years, and the courts, it's something that's very interesting with the Portuguese courts and their perspective regarding resolution, which is not very common in Portuguese case law, because for instance, German case law is used, I may be saying something that's not true, but I have the idea that when I read sentences from German judges, for instance, they are very focused on a solution that is construed by themselves, not so dependent on the doctrine, on the literature, and our jurisprudence is much more depending on the literature, is much more depending on a building that is already built. And this building was completely lacking at the time they came. It became to some things were written, but in the end they had to construe the building themselves, and this is something that was probably better because they were able to allow the decisions. They were looking with fresh eyes, with their legal convictions, with their intentionality, and they were able to understand what was really at stake and not contaminated by hearsay in a certain way. And I think this is something that was interesting. We were able to pass both the constitutional and an operational test that was in place. So it's also a lesson for the future in the sense that we will have situations if crises occur. We are prepared to deal with them in a very different way because we have this experience. And we know that the courts, they were having their own tests because the administration was being judged, but judges deciding, they also know that a public scrutiny will exist afterwards. And this scrutiny is not necessarily nice when it comes from the people. So there were, I think, decisions that should be valued, especially because of that, because people would criticize the results of these proceedings before the courts, I think.
1 minute for legitimacy. I would like to hear from you. Legitimacy
of the administration. I'm very confident in saying that we learn that we have a high level of discretion of the administration, and the administration has the tools and this ex post court review that all decisions emphasize, starting from the European Court of Justice, the European Court of Human Rights, but also the European Court of Justice in 2022 decisions. They were very focused on the importance of the ex post control of the decisions, and this is something that allows us to build a very wide margin of discretion because we have the controls in place. I think I'm truly convinced of what I'm saying.
Thank you, Rana. So we have final minutes, but very important minutes, so we have time to receive questions, doubts, suggestions, critics from the audience. Is it the case?
Everything was clear.
I know that my questions were not easy, but please, if someone wants to comment or raise any question. No? So join me thanking very much to these fantastic speakers. Thank you very much. Thank you. Thank you. Thank you.
Okay. Let us start. Okay, so thank you very much for the participants in this panel for their valuable insights. As a resolution expert with a background in law, this discussion was very close to my heart. And before we close the morning session, we would like to take a special moment in honor to Mr. Luís Silva Moraes.
We welcome Vice Governor Luís Máximo dos Santos to deliver a few words in memoriam of Professor Luís Silva Moraes.
Minhas senhoras e meus senhores, ladies and gentlemen, the words I am about to address to you are a tribute and a modest and well-deserved homage to Professor Luís Silva Moraes who left us so prematurely and unexpectedly in September 2024, just over a year ago. All the languages of the world are suitable to honor those who leave us a legacy worth remembering. English is undoubtedly one of them, but I ask you to allow me to address you from now on in Portuguese, the mother tongue of Professor Luís Moraes, and above all, the language that contains the word saudade, a bearer of a singularity and richness of meaning that cannot be found in other languages. And it is, after all, of saudade that we are speaking of. Only one information to say that our foreign colleagues have the translation into Portuguese of my words. O professor Luís Moraes deixou-nos uma vasta e notável obra, reconhecida nacional e internacionalmente, sobre direito da concorrência, direito da regulação, direito dos seguros, integração económica e direito europeu, em especial na vertente regulatória, financeira e da União Bancária. A sua formação de base foi feita na Faculdade de Direito da Universidade de Lisboa, onde o conheci há perto de 40 anos e nos tornámos amigos. Aí se doutorou com a tese Empresas Comuns, Joint Ventures, no Direito Comunitário da Concorrência, publicada em 2006, e aí lecionou durante dezenas de anos. Exerceu a docência universitária em vários contextos, sendo professor titular da Cátedra Jean Monnet em Direito Bancário e Financeiro da União Europeia na mesma faculdade. A sua área de investigação primordial começou por ser a do direito da concorrência, mas a sua vontade de investigar e conhecer sempre mais, a par do exercício desde cedo e sempre muito ativo, de uma atividade profissional para além dos muros da universidade, levá-lo-iam a espraiar-se por outros domínios do saber, com especial destaque para o direito da regulação financeira. A evocação da obra e do legado do professor Luís Moraes podia, pois, ser feita em muitos fóruns, e já o foi, aliás, em alguns. Nesta conferência, essa evocação impunha-se particularmente, desde logo pela circunstância de, à data do seu falecimento, ser o vice-presidente da Câmara de Recurso, Appeal Panel, do Conselho Único de Resolução, como o Dominique já aqui sublinhou. O professor Luís Moraes foi, assim, o primeiro português a desempenhar funções numa estrutura do Conselho Único de Resolução, embora num órgão independente do mesmo. Iniciou as suas funções na Câmara de Recurso do Conselho Único de Resolução logo em 2015, precisamente a data fundacional que hoje aqui evocamos, primeiro como membro suplente, depois como membro efetivo e a partir de 2018 como vice-presidente. Quando a triste notícia a todos nos surpreendeu, estava em curso o seu segundo mandato, que iria até ao final de 2026. Antes de 2015, prestou serviços de consultoria ao Banco de Portugal, no contexto da medida de resolução que este aplicou ao Banco Espírito Santo, e creio que foi aí que se manifestou o seu interesse pela problemática da resolução bancária. Sou testemunha, de vários modos, do entusiasmo que devotava ao tema, em termos teóricos e práticos, cuja complexidade lhe deixava sempre mais interrogações e vontade de contribuir para encontrar novos caminhos, designadamente no sempre complexo plano da articulação de poderes entre o Conselho Único de Resolução e as autoridades nacionais de resolução e o lugar destas no contexto institucional de cada sistema financeiro. Mais do que eu possa dizer, e já ouvimos hoje aqui declarações do Carl Filipe a esse propósito e do Dominique, importa sublinhar o que a Câmara de Recursos escreveu. O professor Luís Moraes, passo a citar, será lembrado pela sua excepcional competência jurídica, que colocou ao serviço da União Bancária, assim contribuindo para o seu sucesso, tendo sido um verdadeiro europeísta. Em 2010, fundou e presidiu ao Centro de Investigação, Regulação e Supervisão Financeira. Nessa qualidade, promoveu variadíssimos eventos, com destaque para as conferências anuais, que todos os anos traziam a Lisboa personalidades do maior relevo europeu e mundial e em que muitos dos que aqui se encontram participaram e de que seguramente guardam ótimas memórias de grandes momentos de debate e de enriquecimento mútuo. Desde o início da sua carreira, foi advogado, tendo designadamente representado o Estado português junto ao Tribunal de Justiça e do Tribunal-Geral da União Europeia. Além das já mencionadas, foi chamado a desempenhar funções do maior relevo, como sejam as de membro da Comissão Diretiva do então Instituto de Seguros de Portugal, hoje a Autoridade de Supervisão dos Seguros e Fundos de Pensões, de cuja Comissão de Fiscalização, aliás, veio bem mais tarde a ser presidente. Foi também vice-presidente da secção especializada de apoio às reprivatizações. Mas o propósito destas minhas palavras não é, claro está, o de evidenciar em toda a sua completude uma vida profissional tão rica e diversificada como foi a do professor Luís Moraes. Entre outros elementos, as muitas dezenas de monografias e artigos científicos que publicou estão à disposição de todos e falam por si. Discreto por temperamento, creio que acreditava, sobretudo, no poder revelador do seu trabalho. Hoje, neste dia evocativo dos 10 anos do Mecanismo Único de Resolução, não fora o que aconteceu, provavelmente estaria nesta conferência, quisemos merecidamente homenagear a sua pessoa e a sua obra. E muito em particular, expressar o nosso reconhecimento, gratidão e solidariedade à sua mulher, Cristina Moraes, e aos seus filhos Luís Guilherme e Margarida, que nos honram com a sua presença. Para simbolizar tudo isso, peço-vos que nos juntemos numa singela salva de palmas.
Thank you very much. After such a rewarding morning session, we will now break for lunch.
We will look forward for welcoming you back at 2:35 for our afternoon session. Have a nice lunch.
Thank you.
Welcome back. We hope you had a pleasant lunch break. We now resume our program with a keynote address by Mr. Wolfgang Münchau. Mr. Münchau is co-founder and director of Eurointelligence. He writes a weekly column on European affairs, syndicated to El País, Corriere della Sera, and Handelsblatt. He was a Financial Times columnist from 2003 until 2020, and co-founder and editor-in-chief of Financial Times Deutschland.
For many years, Mr. Münchau has been a clear and sometimes provocative voice on the European economic debate, widely recognized for his sharp analysis of the European monetary and political developments. His perspective will help us reflect on the current challenges facing the European economy, as well as the potential risks and threats to financial stability. Mr. Münchau has expressed a wish to take questions after his intervention, so we will open a Q&A session after his talk. Welcome us in joining Mr. Münchau to the stage.
Well, thank you for the introduction. I get this a lot from commentators or from friends who say that, I read you a lot, I don't always agree with you. This is sort of the most common thing. So I wish to thank Luis and the Portugal Central Bank for the kind invitation. I'm not an expert on anything you're discussing here today, so I will not be speaking about technical aspects of bank resolutions. I was a big advocate of the things, and I believe this was one of the things the EU got right during the Eurozone crisis, and I was not somebody who wrote much about things the EU got right at the time, but the establishment of this regime was was important, and as we saw in the discussion this morning, we've come a long way in those 10 years, and also congratulations on your 10th birthday. I would like to talk about the global risk, and this is what I do for a living. I look at global risks, and external risks, the risks that happen before they hit the banks. They will eventually hit the banks, but they build up mostly outside the. Certainly, most of the risks that I'm talking about, all of the risks I'm talking about, built up outside the European banking system. In the introduction, it was mentioned I co-founded Euro Intelligence, which is my agency, and when we started in 2006, we looked at the subprime risks that built up in that period. And I remember writing at the time that this is a ruse, this is potentially dangerous. I was not even aware of the deep connections with European investors at the time, the holdings of European banks, but it was clear to me already back then that this was a large credit bubble that would burst. Then later in the years 2010 to 2015, the focus was on the Eurozone sovereign debt crisis. And since 2020, we are looking at a much more complex set of crises, which are geopolitical as well as financial. And this is where we are today. I just read this morning about the collapse of a US car supplier company called First Brand Group. Car supply companies collapse everywhere. They collapse in Germany in great numbers at the moment. But this group there's a lot of private debt. And it is sort of a mega, I think 10 billion in private debt. And it is a big problem for the US private debt market. There are a lot of signs in the United States that the credit of overvaluation in the credit markets. We are not quite in the sort of subprime territory yet, but this is something I'm watching out for. Credit stress that is building up in the United States. We also know that the stock market valuations, and I do not pretend to understand them, they are at historic highs. If you look at the Case-Shiller index, which is probably the more reliable long-term index of relative stock market valuation, it is at its highest level ever. This is an inflation-adjusted index. It is at its highest level ever. That doesn't mean it will crash. It just means it's the highest level ever. It's higher than 29. It's higher than the dot-com bubble, which was the previous height. And each time when it reached those heights in the past, the market would crash. So this is a possibility. It is quite possible. I wrote about it in a column this morning that this sort of a bubble can turn out into a super bubble. That it could crash significantly later because of supportive policies by the Trump administration. But these valuations do not bear relationship with earnings. So there is something fundamentally wrong. So there are financial risks building up. The thing that worries me the most, and it's probably not on most people's radar screen, is the Trump administration's intended use of stablecoins. This, to me, will have a very significant impact on the rest of the world. This is not just a crypto asset. I personally find the use of Bitcoin. I find Bitcoins relatively benign as a force. It's another stable asset. It's by definition a stable asset in terms of its quantity. Whether it's stable in dollar value, that always remains to be seen, or euro value, that remains to be seen. But it's certainly stable in terms of supply. In that sense, very much like gold, except that it is not an official reserve asset, and you know that some central banks are already at least studying whether to include Bitcoin as a reserve asset. The stable coins are of a very different variety. They are a derivative asset. They are a money market account, essentially. The US dollar stable coin will be backed by US-based companies, financial companies, that it will be backed supposedly one-to-one with US Treasury securities, and they will basically turn those US Treasury securities into money to be used in online transactions and other transactions. So if we are not careful in Europe, we could well be in a situation where this becomes our money. because it is a more convenient source of financial transaction than our own money online, or our credit cards or our debit cards with their charges and their expiry dates and all the problems we're running into with the banking sector. This is a danger, and this is also the reason why the ECB is so keen on developing a digital euro. I fear only that the digital euro will be a crippled currency compared to the stablecoin, and that the stablecoin, in the sort of Gresham's law, bad money driving out good money, in that sense, turning into the sort of the transaction currency of choice. That is a scenario, and I know it's a scenario that some of my friends in Frankfurt are deeply concerned about, and so am I, that the stablecoin could turn into this sort of proxy currency. And it is essentially a way for the United States to raise its borrowing and shift the cost onto other people. And I think there is a pattern of this that we're seeing in US policy at the moment. I'm not trying to criticize anyone, I'm just making the observation. The tariffs are a tax on the rest of the world. They're raising $300 billion in money to the US administration. And when people said that Donald Trump always chickens out, it sounded quite nice, but the reality is he didn't chicken out. The tariffs he's raised are now higher than what they were on the so-called Liberation Day on April the 2nd. The tariffs will accumulate about 300 to 400 billion in annual revenues. They are a critical part of debt sustainability in the United States. What he called the One Big Beautiful Bill, which is the official name of the budget in the United States. It's not just a name that people gave it. It's actually, if you look at the congressional, it does actually have this name on it. It's the budget bill, the medium-term budget bill, would, without it, be probably the most reckless fiscal document ever published by anyone. It would be a document of massive indebtedness, premised on unrealistic growth assumption, and leading to a certain debt explosion. The 300 billion will plug a lot of that. It's still premised on the high growth rates of the past continuing indefinitely into the future. It's still premised on inflation being moderate. It's still premised on a number of very optimistic assumptions and on the ability by the Federal Reserve to cut interest rates as well as maintain low inflation at the same time. I'm not sure that these assumptions are realistic, though we have to say the assumptions we make in Europe are not more realistic either, but the difference being it's a massive scale. So what is happening is he is taxing the rest of the world. I like the description by Adam Posen from the Peterson Institute. He said the US used to provide insurance cover for the rest of the world by running large trade deficits, sort of insurance cover against geopolitical shocks. So it gave its allies stability, financial and economic stability, and it's now the opposite. It's now the exact opposite. He's actually charging them. He's charging Europe for its security. The reason the European Commission could not retaliate against the US tariffs, and they admitted so quite frankly, was the fact that you cannot run a trade war against the country that protects you for security. This is not possible. So they were constrained in their action against the United States. And we have the charge in the tariff, and the stablecoin will be the next one, but it will be of a significantly higher proportion because it involves borrowing and debt. And this is where it becomes critical. With the tariff, we have the choice. We can choose not to export. American customers can choose not to import. But with the stablecoins, if the stablecoins turn into a global, initially successful financial instruments, backed by ever-rising US debt. And imagine what would happen if a collapse of the system were to happen. The system would collapse not on them, it would collapse on us, on the users of those stablecoins. Those monies would become worthless. This is the kind of crisis that I foresee, and where I would say a massive risky exposure is building up that we are currently not prepared for. Now, the best insurance policy against this would have been, and I really have to talk in the form of a conditional tense, the best insurance policy would have been to turn the euro into a stronger global currency. This is not only a matter for the ECB. I don't think the ECB is at all to blame for this, but it is a matter for creating, a matter of creating a deep capital market in Europe, a matter of creating a sovereign debt instrument, which is what a deep capital market would require in order to function well. I think I've been saying this. I think I was invited here at the 20th anniversary of the euro in 2019. I think I was speaking here, and I think I said the same thing. So if you heard it before, so please forgive me, but the lack of a sovereign debt asset, the lack of a capital markets union, virtually whenever we discuss Europe, we always come back to this. This is always the thing, if there's something wrong in Europe, ultimately this is what it is, because this is what constrains our action as a geopolitical player. This is what constrains our action to absorb economic and financial shocks of a large scale. When Trump came to power, there was a significant shift in attitudes towards Europe. A lot of American companies were suddenly starting to be interested in investing in Europe. They wanted to diversify. Europe seemed a safe bet. But they discovered that Europe is not a good place to invest because our economies are by and large not as dynamic as they need to be. And we see this. I saw this morning interview with the chief executive of Palantir, the software company, who founded the company together with Peter Thiel, and they are basically saying, look, we can't invest in Germany because you are too slow. You are too steeped in old-fashioned ideas of economic policy. Your growth is too slow. Your technology base is 20th century. You're not participating in the innovations of the 21st century. That's basically what this is. And the Capital Markets Union would have solved us this problem because it would have stopped the misallocation of capital that happened. And I've just done a study on the German economy where the problem is misallocation of capital through the banking system. And it's not some criminal activity. It is basically when you have a large state-owned banking system with a very significant control of politicians, you invariably end up with channeling funds into industries that would, under a free capital market, not receive those funds. We're seeing, the joke is in Germany, if it doesn't get invested or innovated by Volkswagen, it doesn't get innovated. Because ultimately the car industry in the mechanical engineering sector is completely critical. It's critical also for the research infrastructure that Germany has, like the Fraunhofer Institute, Max Planck Institutes, the university institutes. It's a big infrastructure, but the car industry is a very central player in all these industries. Germany could not diversify away from this. And this is why the decline of industry is not feathered by the rise of other industries. Now, the rest of Europe is very dependent on Germany. I spent this year quite a bit of time in Poland, where there was also a lot of interest in my analysis of Germany. And the Polish industry is completely dependent on Germany. They are the suppliers of the German industry. They also did not diversify away. So we have a sort of a cluster risk, as it is as the financial economic financial terms, a cluster risk, a risk that we are focused on very few industry that are now at risk. And the car industry, we all know, is at risk not from cheaper competition. It is at risk from new technologies that are more advanced. And in the area where the competition will play out will be in software. The self-driving car, for example, is one important aspect where Europe is already lagging 10 years behind the competition in the United States and in China. And in several areas virtually in all areas of high tech, whether it's military, whether it's software, whether it's consumer electronics, quantum computing, we have been lagging behind the US and China, not developing the growth that we needed for this. So this is sort of the world in which these risks that I'm talking about, these financial risks that are coming to us from the United States, will become, as they did in 2006, when we started our little company, we are again in a situation where we are suddenly confronted with risks that we partially don't understand, or that we don't discuss. The cryptocurrency is very cryptic, I have to say. This is not something, it's not easy to explain the deleterious potential effects of stablecoins on the European economy. Just as it was not easy to explain 20 years ago why subprime mortgages matter to Europeans. And in the end they did, through through channels that were not easily seen and understood in the public debate. The second risk that I see, no less, and I already mentioned it in the context of the United States, is the rise in sovereign debt. I'm generally not worried about levels of debt or even debt to GDP ratios alone as simple metrics. What the Eurozone crisis taught me in particular, is to look at a wider range of indicators. For example, if I look what happens in France, and I compare that with what happens in Italy, I'm more alarmed by what happens in France, even though Italy has a higher debt to GDP ratio. But the differences in Italy is that there is a broad consensus in the country that fiscal discipline is the thing to do. There's a cross-party consensus in favor of fiscal rules. Italy, 20 years ago, under the finance minister Padoa-Schioppa, introduced internal fiscal procedures, the kind that we have today, that make it very difficult for governments to overspend on fiscal policy. These are the kind of fiscal procedures that Germany, for example, never introduced. Germany had these massive rules, these debt brake and these sort of balance rules. But Germany didn't have the micro rules, the kind of implementational rules. So when the debt brake was reformed earlier this year, they are now basically on a situation where they spend like there is no tomorrow. There is nothing that constrains them, no procedure. There are investments that there are this current spending putting into being abused and put into an investment fund. This kind of stuff couldn't happen in Italy because there are very clear separations between these various categories of investments and spending and the categories of discretionary and non-discretionary spending. It's not just about your bottom line. It is about a lot of the things, a lot of the hard to see things, and that is where I worry. The debt sustainability assumptions in Germany are based on the hope that potential growth would increase threefold. That's 300%. That's the condition under which German debt is vaguely sustainable. Now, if the potential growth, which I don't think will change if there aren't in the absence of structural reforms, so we're going to see a debt explosion in Germany alone, where this is the country with the lowest debt. This was the kind of the insurance country for the Eurozone. Everyone had high debt, but Germany had we measure our 10-year yields in terms of spreads. We don't even say what a spread is. It's the gap between the German and the national rate. But in a short number of years, Germany's debt to GDP will be 80%. And if there isn't a change in either a new debt rule or a change in procedures, Germany will converge towards France and not the other way around. And so we are ending up in a Eurozone in which we're all pretty much the same. Now, this is convergence. 6 years ago, I was complaining about the lack of convergence. I never thought we would converge that way, so I'm completely surprised by that. I would have to say I was shocked when they found a trick to reform the debt brake. I got to admit, I didn't see that coming. But they were desperate. They needed the money. It's just basically like Trump. He needs the money, so he does what he does. And we're living in a world where politicians, need the money, so they get the money. It's a different environment, but it would mean that that we are in a situation, given the sovereign bank nexus that is still maintained. We haven't solved that particular issue. That banks are still holding a lot of the sovereign debt of Eurozone member states. That is a big financial risk to us, and we would obviously, we don't need to figure out what a default of a large sovereign, European sovereign would mean for the European and the global financial sector. This would be the kind of event we always try to avoid, and naturally we have mechanisms in place now. We have one here, the SRM. We have the ECB's TPI instrument. So we will probably avoid calamities or structural ruptures, but the deployment of these instruments come at a cost. And if we were to bail out, say, a large European economy because it failed to control the fiscal deficit for political reasons, I mean, what happens to France is not, you can't really blame the rest of the world on the rise in the French deficit. You can't just say this is because of Putin or because of some unforeseen shock. This is really a question of political consensus that has broken down over fiscal deficits. This government there are political parties, establishment political parties, that openly question the 3% clause of the Maastricht Treaty, that believe France is perfectly sustainable 4 or 5% deficits per year. And while we all have 4 or 5% deficits during a pandemic, we had higher deficits. The idea that a country with a structural growth rate of under 1% can maintain deficits of that order is completely, it's innumerate. It basically means if that's the political consensus, then you wonder whether this is sustainable and whether we are eventually going to much bigger debt burdens. And what the Germans are now discovering, having thought that the debt is free, that they suddenly get money to spend, they actually realize that a significant amount of what they plan to spend is now taken up by debt servicing costs, which they didn't have before, because the action or the rise in deficits has led to an increase in long-term yields, and it significantly reduces the amount of net money that is available. And you don't have to be, a PhD economist to know that there is no such thing as a free lunch in economics, that there are, ways that are better than others, but the idea that you can gain money, that you can just get, that there's free money out there is totally delusional. And there is a price to be paid. And that is for the Eurozone, in my view, a massive financial stability risk that we are building up, along with the United States, Japan. We're all at it. So the entire Western world is at it. It's interesting that Russia is not doing that. And I think that should give us some pause for thought. I mean, Putin doesn't have the ability to raise debt. He exploits natural resources. He pulls down on industrial companies and tells them to produce arms. We don't have the ability to do that. But China has a high debt level, but a much different debt service capacity than we do, and certainly a situation in which it can act if it wants to. It certainly has retained political control over its financial fortunes, something that in Europe is becoming less the case, where as we see in France, as we see in Germany, there are no political majorities for policies of fiscal restraint anymore in Germany. It's going to the extreme that Germany is now funding the entirety of its military expansion, which is not a one-off. This is not like a war bond, but the entirety of the military expansion is funded by debt. And I'm always joking. The question is whether the bond market vigilantes will get us before Putin does. And that's the danger when you build up a military strategy on debt, because the whole idea of a military strategy is that it is well-funded, that it is there, that it is credible. If your military strategy depends on the bond markets, that's not something I would think, from a pure security policy perspective, I would say that is not optimal. An associate issue with this is contingent debt that we're building up in many European countries. A number, just for Germany alone, I quote Germany so much because it's so dramatic there. The contingent debt went up by almost 100% in the last year alone, percentage points in the last year alone, to about 450% of GDP, according to calculation by a German professor from Freiburg who does nothing else but calculate contingent debt. One can take methodological issues with it, but this is basically the debt we owe to pensioners, to people on various old age care schemes and health schemes and things. So this is debt that is built up in the system as foreseeable and legislated for. So the latest pension reform has not been accounted for it, and it will increase it further. Now, the point will come where they will either default on their pensioners or default on somebody else. There is a risk. It's not necessarily a financial risk, it could be political risk. But when you build up these contingent liabilities, you've got to think this is something, this is ultimately a form of default. Might not be a financial default, might not involve anyone here in this room, but it's certainly something we have to keep in the back of the mind, that it depends on political majorities at the time how this conflict will be resolved. And let me, as a final point, I have 3 minutes left, make the point is that a lot of the financial risks that we have in Europe are related, they are not of the classic kind, they're related to the fall in structural economic growth and potential economic growth. We have been sort of telling ourselves that, okay, we had the pandemic, we had Putin's war in Russia and Ukraine, we had Trump's tariffs, we had bad luck, and the economic growth will recover to where it was before. If I look at what happens in European industry, if I look at what happens in China, I don't think that's going to happen. I think we are in a period of lower structural growth, and this period requires reforms, not just financial reforms, not just reforms to make our social systems sustainable. That too, I'm not saying we don't need them, but these are reforms about how we operate, how we run our economies. It's a reform of our, it's a competitiveness reforms, but this is not just about cost, this is about capital markets. We're back to the capital markets union. We're back to regulation. We're back to IT regulation. We thought 6 years ago, 7 years ago, that we had degrees of freedom in regulating tech companies. We have discovered that we don't, because we don't have a tech industry of significance. Of the 50 largest tech companies, only 4 are European. And the only genuine new one is actually right at the bottom of that list at place number 49 or 50, which is Spotify from Sweden. Most of the other 3 are outgrowths from older companies like ASML, which came from Philips, SAP, which is as old as I am, a software company from Germany, there is a French company. So we have a few, but we are not right up there. But we are the world champions in regulation. So there's a number of things we Europeans have been doing for a long time, where we have formed a consensus, which we haven't questioned. We're not talking about tech regulation very much in Europe, but it is part of and we're not talking about capital markets union very much, and we're not talking about the completion of the banking union very much, except maybe here in this room. So these are the financial risks. This is where I see the risk accumulating of a vulnerable Europe and stuff building up outside of Europe that is potentially quite threatening. And thank you very much for listening. Or as someone would say, thank you for your attention to this matter. Any questions? Yes, there's a question over there. Oh.
Thank you for your keynote. At the beginning of your speech on your first part, you talked about a few new risks and the risk transfer from the US to Europe regarding stable coins, and you even used the conditional perfect tense to say that some trains have already departed in what concerns European regulation. What do you think that European regulators and policymakers can do now to address that issue? And in your answer, if there is a dichotomy between financial or stability overall and innovation and promoting innovation.
I didn't catch the last point. I catched your first one.
If there is a dichotomy between among financial innovation or promoting innovation and safeguarding stability.
You're talking about financial innovation.
Innovation, financial,
right,
mostly
okay.
for us. Yeah.
Well, what we could do, I mean, the simplest thing we can do is what the ECB wants to do, which is to launch a digital Europe without encumbrance of regulation. So let a digital Europe, and I would actually go further. I would actually, the digital euro they had planned, or they are planning, doesn't directly involve the banking sector, so you don't have to have an account, but it's still routed through the banking sector. So it's not something that is, I would not do this. I would have a digital Europe issued by the ECB to the people directly. I would not have any limits on it. I think that's the most important thing. At the moment, they are discussing transaction limits, both in size and in number. And I think that will kill the project. It will kill the effect the digital euro will have as a weapon against the stablecoin, because the stablecoin will have no such limits. Now, we could theoretically regulate the stablecoin, but try to regulate somebody else's currency, especially with Trump, given the political weight he will bear on this. And he will simply threaten us to withdraw our security. So I think it will basically be difficult, and we're seeing this already in Brussels. The Commission quietly dropping cases it would have brought otherwise against large US tech companies. I do not see any chance that we can regulate this, but I can see chance that we can become more resilient. So that would be the first thing. I would definitely have a digital currency. That is the simplest thing we can do in order to help us. On the trade-off between stability and innovation, whether it's financial or in other areas of our economy, we Europeans tend towards placing a high value on stability. It's a political choice. We are more risk averse than others. This is in our nature. We're also getting older faster than others. So this is a factor that also weighs in favor. And it's something I don't think is that would need to be addressed. I mean, it's like saying the electorate has to change. I'd say you're wrong, but what can I say? So I would certainly, at the very least, I think there are always choices between the very best and nothing. And at the very least, I would make the laws that I have more consistent. I think if you read the Draghi report on the tech regulation, now, if it was up to me, I would tear the whole thing up, not the Draghi report, the tech regulation, and basically say start from scratch. But it's not up to me, mercifully, not up to me. Therefore, we have to do it differently. And the different ways to do it is to clean it up, because there are a lot of technical inconsistencies. Countries implement, for example, the GDPR directive. Countries implement it. I know it as a small business person myself, having to deal with banks and investors from different European countries, and I see how they implement it. Each one implements it differently. For some reason, Spanish banks implement GDPR in an almost fascist way, in a way that nobody else does. I don't know what is it with Spanish banks, but there's something that they have internally. It's probably a domestic implementation law that is different in Spain than it would be in other countries. Other countries like Poland and the Baltic republics, whenever I visit these countries, they never complain about bureaucracy as much as they do in Germany. So a lot of it is to do with how we implement European laws. And I think we can start with cleaning this up and making these laws work. And I think that's something you can expect of legislation, that it works, that it is clean, that everybody understands it, and that's not the case. These are actually bad laws in the way they were from a pure sort of technical perspective. Whether you agree with them or not is a completely different matter. I actually don't think we should regulate AI. We should actually encourage it, but before we regulate it. And I think we didn't have the highway code before we had the car. And we had a car, and then we didn't know whether we drive on the left side or on the right side, and then came some regulation that decided. And then things went up from there. And the same should be, we Europeans aren't like that. I understand that. We try to regulate things, and we pass laws, but we haven't. The problem with the AI law is not a good law, apart from the fact that it innovates. So that would be my two recommendations. There's another question over there.
Now I think it's working. First of all, thanks for the keynote. My question is, well, for resolution authorities, preparedness is absolutely key. And in that sense, it would be particularly valuable for us to hear your view on this. Well, as you mentioned...
I didn't hear on the first what you was saying, my view on exactly what?
So preparedness for us is absolutely key for resolution authorities. And throughout your intervention, you already highlighted a number of financial risks that exist in Europe. But if you had to point out the most likely trigger of the next financial crisis and the form it could take, could you tell us what we should be prepared for in that sense?
It's a good question, very hard to answer. In 2006, I would never have, if people asked me the question, I knew it was unsustainable already in late 2006, 2007 it became very clear when you looked at the US mortgage industry. But no, I would not have answered the question, it will happen through the collapse of Lehman Brothers and through the fact that there would be the money markets would freeze up. I didn't see that coming. But I thought there would be some contagion. I knew there were people had exposures that would happen. So, and I think a lot of the problems you will have addressed these days. So I think the European banking sector is probably structurally in a much healthier position today than it was in 2008. I would certainly, in view of the risks relating to debt, I would certainly ensure that there is no direct or strong indirect exposure to stablecoins, or institutions that hold them, so I would certainly include very adverse scenarios on stablecoin into my stress testing. That's probably something that I would do, and I mean very adverse scenarios, not just let's just have a little bit of stress in the market. The kind of the stuff that we normally don't put in the adverse scenario in our stress tests. And our stress tests tend to be, still within reasonable scenarios. They're still probable scenarios. The adverse scenario in our stress test is not a really negative. It's not the nuclear bomb type scenario. It is the, it's the slightly negative from the baseline. So that's what I would certainly do. I would also ensure that banks have a reasonable geographical risk. I would certainly look more at geographical exposures to different regions, and not only to China. And so I would also make sure that there isn't an excess geographical exposure to the United States and to other things. So I would ensure balance more. I would weight this more strongly, because anyone who has extreme exposures to anyone is significantly more vulnerable to stress that could arise. So it's basically a resilience question that I would do. I do not, however, know how this works in practice from a bank regulatory. Because, as I said, I'm not an expert on this. How to do this in practice? You all know more about this than I do. I can just tell you where the risks are, but in a global sense, I would try to alert people to this risk, and I would certainly talk about this risk, because these are not, one of the problems at the time in 2008, we didn't talk about these risks, and we didn't understand them. And there is stuff now happening in the world. Again, I'm not somebody who cries wolf despite my name. I don't normally do that, because I didn't see any financial risk coming for a very long time. We did the last financial sort of scream was the Eurozone crisis. We did see that coming, but there wasn't, we didn't see any, we didn't worry about the stock markets. Yeah, the stock must go up and down, but we didn't see this sort of extreme thing. There wasn't a credit bubble in the last, in the last decade. A lot of the things that would happen for a very dangerous financial situation did not occur. There was stuff I disagreed with, like, I thought central banks were excessive in their use of QE in that period, and it had a cost. But that was, that came, we saw what the cost was and what the price was to reflect it. And I think central banks would probably have learned from that period. That to me was the biggest risk in that period. I'd see a different situation today. There is the combination of geopolitical and finance. I think this is the unique thing that we didn't have back then. The risk of 2006 was purely financial. It was a classic bubble. It's not like that. It's, the stable coin is a geopolitical thing. It's a geopolitical instrument. And the war funding through sovereign debt, this is new. And it's not a risk that we understand so well. So I would certainly, the best, as always, as any financial risk manager knows, is to diversify and to ensure that would be, the same, I think the same for banks. Another question.
Thank you very much. My name is Edgar Caetano. I'm a journalist here. We heard the Portuguese Central Bank governor this morning talking about how we need more trust among the member states in order to advance in the banking union, with what's missing of it, of course. Namely the deposit guarantee at a European level. How do you make sense of the fact that we're still talking about this 10 years later, that we haven't been able to move forward with this deposit guarantee scheme? Is this, for you, a symptom of this lack of trust in your eyes? And also, I'd like to ask you about how a case like Unicredit and Commerzbank, what does that tell you about whether or not we're actually moving forward with a European banking union? Thank you.
Yeah, excellent questions. I view the Commerzbank situation as a clear indication that certainly Germany is not ready for a banking union. And I think I mentioned it over lunch. I had a meeting with liberals, German liberals, the Liberal Party. They didn't make it into the parliament, but I had a whole evening with all their top people like 10 years ago. And I asked them the hypothetical question, what would one of them was the economics minister. And I asked him, what would you do if, the French were to buy Deutsche Bank? And he said he would stop this. And, so in Germany, you can be as liberal as you want. You're not, the banks are nothing to do with this. The banks are basically, part of the national infrastructure. And the idea that Commerzbank is being bought by an Italian, I remember the comment by Hans Werner Sinn, a conservative German economist. You probably know him well from the Eurozone crisis. His point about Commerzbank, I had not heard this before, but I mean, this is because my imagination is not as developed as that of some of my German friends. He said this is the way the Italians get hold of the German deposit insurance. Through that was basically the conspiracy theory, that this is just an indirect way of just taking our money. And this is the kind of, when you have that kind of comment in, published in newspapers, being discussed in public, I can tell you they're not ready for deposit insurance, and it's mistrust, absolutely mistrust. And mistrust of others. They think that they have this wonderful banking system, which is the irony of the situation. Because what I expect to happen is, I will actually see that the German state-owned banking sector could come under a lot of pressure when the decline of German industry continues, as I expect it will. And there is massive exposure by the state banking system to industry, because they're told by the politicians to preferentially fund German industry. It's very difficult to get the money for a company upstart in Germany, but easy if you're a widget maker, and if you're already an established company. So we will see financial stress, and then we will see how valuable the German system is. And I think the They have deposit insurance systems, but for large parts of the system, it's very much a promise, not really a legislated system. So I don't see it coming. I mean, it wasn't, the governor didn't just pick up a new idea. We discussed it 10 years ago. Everybody discussed it 10 years ago. Everybody talked about the three pillars of the banking union, and we heard today maybe we can do it with 2 pillars, and probably we'll have to make do with 2 pillars. I think in the end, if you had a resolution mechanism that worked really well, that would already be a very, very big deal. We have a situation, despite the progress we made, the European banking sector today is less European than it was at the start of monetary union. I remember in the early days of the monetary union, I lived in Brussels, and in fact I lived in 3 countries at the time with my family, in Germany, Brussels, and in Italy. And we had an account of an American bank in Europe, which had retail offices, and they allowed cross-border retail banking. So I could, in Brussels, go to the terminal and manage my German bank account. And this was absolutely wonderful. And later I met the head of European affairs at this bank, and I said to him, "No, this is fantastic, you're the only bank that does that." And he said, "Yeah, it doesn't work, we're closing it down." And that was the end of that. Today, it's much more difficult. The cross-border, when I want to send money from Germany to Italy, it happens on 1 or 3 occasions that this money doesn't get transferred. And it doesn't get transferred because somebody in the German bank sees a risk in the transfer, an unspecified risk, to the extent that they don't even inform me about this. The money just doesn't arrive. They think it's just some kind of an illegal transaction that is not explained, and it basically just disappears as a transaction. Now that wouldn't have happened 20 years ago. So in many respects, and I know you will probably have a different perspective of this, but from a retail user's perspective, the European banking system is significantly more fragmented. So we have a lot more work to do, and to get to this position. I still think that the route through is through a fiscal union, and that these things have to happen at the level of the fiscal union rather than at the level of mutual guarantees. I think the recovery fund has destroyed a lot of goodwill, and certainly in the donor countries like the Netherlands and Germany, because it is across the way it was funded and the way it was secured. It's because it's secured on future membership contributions. It's essentially a state-to-state transfer. The whole idea of a fiscal union is to do away with the idea that this country pays money to that country. The whole idea of a fiscal union is we're doing this together. We have a joint issuance. And yes, there may be more taxpayers in that country than there are in that country, but at least with a progressive tax system, the rich people in all the jurisdictions pay more, and the poor people in all the jurisdictions pay less, which you don't have when you have state-to-state transfers. And so the classic example of a rich person in Italy and a poor person in Germany. These people exist, and these people actually have voting power. So we have kind of come to the limits of what we can do with the present system. So the further integration requires a leap in integration, which I don't see happening right now. But I don't want to rule this out. But it is still needed. Just because it's difficult and because people don't want to talk about it now, doesn't obviate the need for it. One more question. I'll take as many questions for as long. The organizers need to tell me that we need to stop here. So,
good evening. Thank you very much for the keynote. I found that your discourse goes a little bit against what we have been discussing in the morning, in the sense of the stablecoin and the digital euro. You just mentioned that the stablecoin is a dangerous thing. We need to be careful of it because it's too free. At the same time, you are proposing that we could combat this by giving the digital euro the same sort of freedom. But we are supervisors, and we have been telling ourselves that the crisis from 2008 has happened because the supervisors didn't interact with the market as much as maybe they should have. So in your perspective, where would you draw the line? So where would you look for to allow the digital euro to actually be a viable alternative to the stablecoin, but at the same time have some sort of constraint on how it can be used in terms of liabilities and whatnot? How can a supervisor begin to even think about this and handle this?
Yeah, I think you're raising important questions. There are, could stability risk imply, because if, a euro is obviously it's something that exists outside the banking system, and I understand that a lot of the regulation is concerned for that very reason. That suddenly you build up, you push the banks out of the system, and you have a sort of a direct transactional base. I would prefer that to the idea of a complete sort of chaos and breakdown of the currencies. I think our fractional reserve system that we've had for a very, very long time will almost surely develop in this century, and it will probably be reforming itself out of recognition by the end of the century. The banks will play a different role, probably a smaller role than they play in the past, even in Europe. And these digital currencies will play a role. You will lose control. But the question is, the loss of control you would have with a dominant foreign stablecoin is of a different order of magnitude than the loss of control you have with your own digital currencies. It's still your own currencies. You still have regulatory control. You still control the issuance. It's not something that is. It's not a free for all. It's still ultimately, a liability of the central bank. So it's not. I don't see the. I don't see this. I really struggle to see why this. The pressure, by the way, for the regulation doesn't come from the central bankers. It comes from the European Parliament. This is where most of the legislation, where most of the concerns arise, because that's where people said, yeah, we have concerns about fraud, we have concerns about money laundering, and these issues obviously need to be arisen. I certainly asked the ECB whether they can debank me if I have an digital euro, whether they can just decide I shouldn't have them, and they assured me they wouldn't be able to do that, except for police. Police can do that, but not the central bank. So because it will be an issue of trust. Do we trust the digital euro? And I think that is the bigger issue, that you create something, that you have something in your wallet that you think, is this actually something I want to rely on, or do I want to rely on American assets, which I may trust them more because the US dollar of the role. I think that's these are the issues that I would highlight. I think, no more questions? I think this is it. Well, thank you very much.
Thank you so much, Mr. Munchau, for sharing your perspective, but notably for being open for questions for this eager audience. And now we move to our third and final panel of today, which will focus on the future, shaping the next decade of the SRM, achievements, gaps, and strategic ambitions. The discussion will be moderated by Mr. João Freitas.
Mr. João Freitas is the head of the Resolution Department at Banco de Portugal, aka our amazing boss, as well as Secretary General of both the Portuguese Resolution Fund and the Portuguese Deposit Guarantee Fund. Mr. João Freitas will be joined by a distinguished group of panelists comprising Ms. Karen Braun-Munzinger, Mr. Fernando Restoy, Mr. Álvaro López Barceló, and Ms. Geraldine Thierry.
I think you should be here. What's the order?
Thank you, Joana and Alexandre. I have to say, I did not tell them to say this, but congratulations for your performance in hosting this conference. I'm a bit worried that you might be tempted to start a new career after this. I hope not. So, good afternoon, ladies and gentlemen. We have a challenging task ahead of us. We have 90 minutes sharp to complete our panel. And before I begin our discussion, I would like to say that it's really a pleasure for me to stand here to celebrate the 10th anniversary of the SRM. 10 years ago, in September 2015, I remember that we had just suspended the first sale attempt of Novo Banco. So Novo Banco was still a bridge institution. And we did not know yet that by December we would be resolving a second bank in Portugal. So 10 years passed. It's a relief to see that financial stability was preserved and that we did what we had to do, and I believe we did it right. So it's also a pleasure to see how the framework has matured since then. Having said this, in the morning we reflected on the achievements of the SRM and on the legal foundations of the framework. The challenge now is to look forward. We will discuss what remains to be done, what risks looming in the horizon, what are the strategic priorities for the SRM, and it was very fortunate. Of course, it was intentional to have Mr. Munschau before this panel, because the intention is that he would set the scene for our discussion. And indeed, we spoke a lot about risks, about uncertainty, and we thought it would be the nice way to kick off the discussion that we have in the next 90 minutes. We are very fortunate to have 4 very knowledgeable speakers with us, and we will have again, just like in the morning, a presentation style panel. Each speaker will have 15 minutes to share their remarks, which I will be controlling this time. And then we will move to questions and answers, first from me as moderator and then from the audience. Hopefully we will have the time. Now, in terms of our guests, we have Karen Braun-Munzinger. She's member of the board at the SRB, responsible for resolution policy development and coordination. She brings to this panel extensive experience from key institutions at both the national and European level, and the list is quite impressive. It includes the Bank of England, the UK Treasury, the European Central Bank, and the Deutsche Bundesbank, all before joining the SRB more recently. We will then hear from Fernando Restoy. Fernando is chair of the Financial Stability Institute since 2017. He previously served as deputy governor of Banco de España, vice chair of the Spanish Securities and Markets Commission, and chair of the Spanish Resolution Authority, FROB. He was also a member of the ECB Supervisory Board, among other relevant positions. Our third speaker will be Álvaro López Barceló. Álvaro is chair of the Spanish Resolution Authority, FROB, and represents Spain in the plenary session of the Single Resolution Board. He previously served as Director General of the Treasury and Financial Policy of Spain and held senior roles in Spain's economic administration and at the European Commission. Finally, we will listen to Géraldine Thierry. Géraldine is an executive director at the National Bank of Belgium. She's responsible not only for resolution, but also for statistics, microdata, and data governance. She represents Belgium in the plenary session of the Single Resolution Board and serves on the boards of Belgium's statistical authorities as well. She combines her central banking role with an active academic career and is a full member of the Royal Academy of Belgium. So, Karen, we'll start with you. I believe you will be discussing and presenting the SRM strategy for the next few years, what we call the SRM Vision 2028. And you'll show how we want to deliver readiness through operationalization and a new focus on testing as well. The floor is yours, Kat.
Thank you. Dear João, dear Luis, dear colleagues, it's a real pleasure to be here today. Many have said it, but it is really true for this kind of event. And with being able to reflect with my fellow panelists on where we're heading with resolution. So I think inspired by the day, I am going to be talking about the SRM vision, which is at the heart of where we're taking things forward, but I'm going to go a little bit beyond that in the context of overall thinking on resolvability. Apologies, and I'll try not to cough into the mic as well. So, but first, let me come back to where we stand, where we are starting this discussion. And it's really, so it's both as a board member at the SRB, but really predominantly from having been at the UK Treasury during the global financial crisis. Really, from my personal experience, it's amazing how far we've come. You know, I have very vivid memories of being there in the finance ministry, and we had to deal with big banks or small banks, and we just had nothing. We had no tools, we had very little information, very little data, and very little framework about how to deal with bank resolution in a structured way without taxpayer involvement. And knowing that we now have the framework, knowing that the lawyers tell us it's constitutional. I hadn't been worried before today, but I'm glad that over the last 10 years that's also been confirmed. It's a really good place to be. We heard from a number of colleagues throughout the day. The governor told us about the banks being more resilient, about resolvability having been built. We heard about not having to be ashamed to be Europeans, about building that trust. No taxpayer money, Dominique told us. And overall having seen a decade of success. I share the celebration, but at the same time I also want to say, let's take that positive value of knowing that we've made that progress over the 10 years. But even if politicians waved a magic wand and solved all the legislative topics that we've been discussing, even if all the legal issues were solved and the lawyers had nothing left to talk about, I would still tell you we need to work. We need to be ambitious about delivering an operational crisis readiness over the next decade to come in working together to ensure that we're ready. So that's, because being ready for crisis, I quite often hear people say, well, but look, we've done quite a bit. There's capital in the banks, we've done resolution plans, now we can stop. But it's not something you put onto a shelf and admire, and I think anybody who's been part of a crisis, and I know we have colleagues here who have that very sharp awareness, will know it's much more about exercising a muscle. It doesn't help you to have been good at running in your youth. You need to keep doing it if you want to be able to perform on the day. Or to use sort of a musical phrase, if I stop practice for 1 day, I notice 2 days, my friends notice 3 days, the public notices, and after all, we have an orchestra, not single pianists who need to be able to work together. So what does that mean? We do need to draw on that real progress. So banks and resolution authorities having put a lot of energy into planning, into key capacities and training people, we see this in the resolvability assessments. We have seen resources being built up, and we need to continue to have an eye to make sure that those resources remain with us. I understand it's a staggering number of 2.67 trillion euro MREL, if this can be true. I thought that was amazing. And we've also seen relationships being built up between us, between the people in this room, in the industry, with our international partners. We're in the last stages of refining our expectations and resolution readiness. We've just published guidance on testing. If you haven't looked at it yet, please do. I think it's quite helpful. And this really lays that foundation for the next stage, as we set out in the Single Resolution Mechanism Strategy 2028. And Pedro said it, it's very much about the M. It's the mechanism together having developed that strategy. We're shifting to really prioritize practice, operationalization, preparedness in order to deliver on our mandate going forward. And this also chimes with my own experience of crises, of dry runs. You can't think your way through everything. You can't plan your way through everything. You have to practice, because the complexity of the systems that we're looking at means that we need to look at the interaction about getting better, about getting key insights and learnings in order to be able to continue to progress. So to be concrete, to make sure that resolution tools are really usable, we need to work on banks and authorities being able to execute bail-in swiftly and effectively. Mark was mentioning it earlier. That also means continued work on the framework, but there's plenty of practical topics which we can practice about data, about execution. We need to make sure that liquidity support mechanisms are in place and ready to be deployed. We need to build the technical, legal, and organizational capabilities to manage complex cases under real-life pressure. And key to this is the testing of capacity. You know, colleagues of mine at the bathroom put it as, you know, it's really testing, testing, testing for the years to come. That means desktop exercises, drills, simulations. Within that, from the SRM vision, tools are far from the only element that can and must be practiced. We're looking at capacities across our expectation for banks. We're also looking at authorities themselves practicing communication and working together. Elements range from information provision, operational readiness, for example, to interact with financial market infrastructures, over communication and governance, to valuation readiness and separability. So when you look at this, our testing guidance sets out expectations about doing it in a structured way, so that you don't only test the elements you already know you're going to be good at, or you only test the elements you think you have weaknesses at. No, we set priorities for what's most important, and then over the next 3 years, banks will step through in a structured way a multi-annual work program to make sure that all aspects are tested over time, but not all the time, and not to the same level of intensity depending on the importance for the resolution framework. We do know from previous such exercises that there will be learnings for us, for the banks, for third parties. So the approach also focuses on identifying those learnings and making sure that we can take action, that banks can take action. Authorities, too, are also challenging themselves to ensure crisis readiness as we carry out dry runs in different settings. And I know we've worked with many of you in the room on these already, and we have to continue on the path within the banking union and beyond. Now, this work doesn't only test systems. It can also build relationships and trusts, which are essential. We see that, for example, during the tripartite exercise, where we continue to work with our partners in the US and in the UK. But I really see it every day in the single resolution mechanism and in our European structures. Working together, discussing together in the right way builds trust. It's not automatic. It's not enough. I mean, it's nice to be in a room together, but you're not going to get to a more trusted perspective just by doing an exercise, just by being together. You really have to make that active choice. And I think one of the really nice things about working within the European mechanism is I know that we've all made that active choice that we want to work for Europe, we want to get better together. And so whenever we use these exercises, they can help us to deepen that. And it's really, you know, we've heard quite a lot about risks, and this is one of the things that gives me hope. You know, I see that when we work together in a practical way in the European level, we can really move things. We are also stepping up on on-site inspections. We're looking at deep dives with banks on operational continuity, governance, and liquidity and resolution. To help us deliver, we are prioritizing work on digital tools and data so that we can support that resolution execution and effective work on readiness, working closely with our partners in the SRM and beyond. This isn't only consistent with the simplification agenda, it actively contributes to it. So at a time of volatility, clearly we need to be able to deliver on our mandate, and by focusing on practical, risk-relevant aspects of resolvability, by focusing on the implementation, on the outcome rather than the output, we can limit bureaucracy and concentrate on what matters, reducing, for example, planning-related deliverables. The scale of the banking union allows us to benefit from best practice and experience here, and by ensuring a credible exit, we have facilitated space for innovation and the right approach to risk-taking in a going concern. This operational resilience is particularly important because we live in a period of new emerging risks. And I promise this word was already in here before we heard the speech just now. It's clear that we live in challenging times. Our work can give us confidence that we know how to tackle difficult problems and that we know how to make sure that we work our way through. But we have to build that readiness now for more complex and volatile situations. We see that banks can fail, not because of their capital levels, not because of a classic banking crisis, but because they lose access to their systems because of geopolitical risks. And authorities, and we collectively, have to be able to respond and be able to deliver under difficult circumstances, whether those are large-scale cyber incidents or geopolitical in nature, or indeed when financial and non-financial risks interact. So we can't lose sight of the classic banking risks either. We also see that the financial system is changing, with banks and non-banks alike delivering financial services in different ways. The implementation of DORA, the Digital Operational Resilience Act, is a good example of how the framework is already adapting. Not only does it enhance the industry's preparedness for operational risk, but it also complements resolution planning by ensuring the continuity of critical services and reporting even in extreme scenarios. We're taking that emerging risk environment very seriously. Whether that means being ready for high-speed resolution, I'm not sure we're still going to have a resolution weekend in years to come, or by looking at different types of critical functions as banks and non-banks change, focusing on operationalization and being ready to respond. And being clear on what our end goal is. So really, how much disruption is okay? What are we trying to deliver with the safety that we provide here? That includes being ready to resolve banks which issue stablecoins, as we've just seen European banks announce that they're getting ready to do. To deliver on crisis resilience and on simplification, there's one other area that I do have to also pick up on as an operational agency, as we really focus on being practical and working with what we have. We do also continue to make the case for completing the banking union and removing barriers to integration. Because without a fully mutualized deposit insurance scheme, you heard it earlier, we have issues with equal protection for all depositors. And without a credible framework for a liquidity backstop, the banking union remains incomplete, leaving us with a patchwork that could still fragment. Completing the banking union isn't just a technical goal, it's a political and economic necessity, so it has to be part of what we work towards over time as we build confidence that European structures work, that they benefit all of us, they benefit the industry, they benefit our economies. So, to sum up, and hopefully delivering in time, so we have time to discuss. We live in interesting times, even though I gather the proverb there isn't actually a Chinese proverb on this, but I think it's true that crisis readiness is more important than ever. The SRM vision really delivers on being ready for those times by focusing on crisis resilience, by focusing on operational readiness for authorities, for banks in a practical and structured way. We need to focus on implementation while adapting to deal with volatile environments as we see non-financial risks emerge, as we see the operationalization challenge potentially get more complicated. Working together, we know that we can deliver better outcomes in shocks, ensuring the financial system remains robust and fit for purpose. We have to continue on this path, deepening on operational capabilities across authorities and the industry, ready for all types of risks and a changing financial sector. As the last decade showed us, we are strongest on this when we work together, sharing experiences and finding good solutions. So many thanks again, Joao, Luis, colleagues, for this wonderful day, demonstrating the richness of debate and engagement, and I look forward to being able to dig more into these topics with you in a minute. Thank you.
Thank you, Karen. Now it's your turn, Fernando. We have seen the achievements of the SRB in the first decade. I believe you will say and you will demonstrate how authorities need to leverage on those achievements to address also the shortcomings that still exist in our framework. The floor is yours.
Okay, many thanks, Joao, for introduction. Thanks a lot to Banco de Portugal for a very kind invitation to participate in this event, celebrating, because we have something to celebrate, the 10th anniversary of the Single Resolution Mechanism. That's actually an important milestone in the European construction project. So we all know that the Single Resolution Mechanism, as part of the Banking Union project, actually was created with an initially defensive motivation. This was one of the instruments to be used in order to break this destabilizing link between sovereign and financial risk that in the middle of the European debt crisis was actually threatening the very continuation of the European and economic and monetary union. But of course also true, you look at the documentation prepared by the Commission that accompany the legislative pieces that were ultimately approved by the European co-legislators, and you look at even the Boreas clauses of the legislative pieces, you will see some references to the contribution that the banking union could actually have to foster further banking integration, actually, in the European Union. Of course, we can discuss a lot. It's a matter for discussion, the extent to which the single resolution mechanism has contributed, actually, to these two objectives. We'll talk about it in a minute. But what is clear is that at the end, your own assessment is that, well, I mean, the progress has been suboptimal, even limited. I believe it is because actually we have self-imposed ourselves certain number of constraints that have actually made it impossible actually to take full advantage of what a fully effective banking union could actually have. As I said, I will come back to that. In any case, in the short term, what is clear, what has happened over the last 10 years is that the Single Resolution Board in particular has become a fully effective resolution authority. The progress has been absolutely just outstanding, taking into account obviously the relatively short period of time with which the Single Resolution Board had to be operational. And it's particularly outstanding, the progress made in terms of resolution planning. I think Karen referred to that. I think it's quite remarkable that basically the European industry have basically achieved the very ambitious MREL targets by now. I think it's around 28% of the total risk exposure, which is quite an ambitious target. It's also true, actually, the resolution plans have been actually gaining maturity with a number of provisions, sort of guaranteeing operational continuity, communication, issues about collateral, valuations, separability of those banks which are subject to sale of business type of transaction. And also I think it's quite remarkable that the Single Resolution Fund has achieved its target volume, which is 1%, as you know, of covered deposits. But now moving to the challenges ahead, probably a good reference could be actually the lessons extracted from the banking turmoil. I mean, in the group that Dominique chaired at the Financial Stability Board, the Resolution Steering Group, I mean, it was quite important, quite useful, the selection or the identification of the lessons to be extracted from this very important episode. Important episode because actually you have actual crisis in different jurisdictions, in a context in which the new resolution framework was in principle fully operational in most jurisdictions around the globe. And of course, to the extent that the European Union was probably the jurisdiction in which the international standards were more faithfully sort of applied, it's logical to think that those lessons extracted from the turmoil are particularly relevant for the European Union. For the sake of time, let's just focus on two of the main lessons that were extracted from the turmoil. The first one was the so-called optionality in resolution. The second one is about making sure that you have sufficient funding to properly implement resolution strategies. Well, in the first case, you talk about optionality. Of course, progress has been limited so far in most jurisdictions around the globe. In the case of the banking union, well, we have this preferred resolution strategy that has been combined with alternative resolution strategy that will be activated in case the former one is not feasible for whatever reason. I think it's clear that given the complex institutional framework in Europe, the application of this concept of optionality is particularly challenging. For instance, just to prepare for sale of business transaction, if it has to be cross-border, you will have obviously to take into account different legislative framework in all the jurisdictions which are involved, apart from obviously the European legislation. And of course, all the issues about no creator wars of principle also are particularly complex in the case of the banking union. In any case, I believe, of course, the main shortcoming of the framework in Europe is really funding. I think the banking turmoil clearly illustrated the need of having sufficiently large and sufficiently balanced sources of funding for resolution. Well, what happens in Europe is that we don't have, I don't think we have a balance, actually, sort of combination of sources of funding. As you all know, legislators have decided to severely constrain access to industry-contributed funds to support resolution. And of course, you know that effectively government support is banned within the banking union. The consequence of that is that basically the predominant source of funding is just internal resources, so MREL. So what has happened basically is that these loss absorbency sort of requirements are significantly more stringent in the European Union or in the banking union than in other jurisdictions in which they have more flexible access to external sources of funding. And this is, of course, an issue, an important issue, because that affects, obviously, the competitiveness of the banking industry. They have to satisfy more stringent requirements. You have more banks having to satisfy loss absorbency requirements, and also those absorbency requirements for large institutions are actually more stringent than international standard, the so-called TLAC. So it's not only about that, it's also because actually this sort of lack of flexibility to have external funding for resolution basically may affect actually the effectiveness of the resolution actions, particularly for those banks that for whatever reason you find out in the resolution point that there is no sufficient loss absorbency capacity. So that of course could create an important financial stability issue. So we have actually to keep all these things in mind. Of course, I should mention, even if I only mention, an important flaw of the regime in Europe, which is the absence of a liquidity and resolution facility. What we have now is something which is incredibly limited. Even if we manage actually to endorse or to approve in all jurisdictions the new ESM treaty, still actually firepower to provide liquidity in resolution will be certainly too limited. So the CMDI is a good step forward, actually, to try actually to address this challenging funding issue. The original proposal of the European Commission was very clear in that respect. The idea was actually to somewhat introduce more flexibility for banks in resolution having access to industry-contributed funds. First, the national deposit guarantee schemes, and second, the single resolution fund. In the first case, the formula that was actually proposed by the European Commission, in line with what several experts actually had already been proposed in the past, is actually just to remove this, I will say, somewhat polemic super preference of deposit insurance claims in liquidation. So to the extent that you're working on the least cost constraint, of course, by removing the super preference of deposit insurance claims in liquidation, of course, you will have more room for maneuver for deposit insurance funds actually to support particularly transfer transactions. So that was the idea. As for the single resolution fund, well, I think it was quite smart, the European Commission thinking that a good way to make it more flexible access to the single resolution fund is just by putting in place the so-called bridging function. So basically that the contribution by the deposit insurance fund will count towards meeting the 8% minimum bail-in requirement to having access to the single resolution fund. So that's basically the package. Certainly will have implied more possibilities actually to have external funding resolution, and certainly will actually work in the direction of providing for more balanced arrangements to fund resolution actions. Well, what we know is that the European co-legislators are currently working on this. The news is that the political compromise is actually moving somewhat away from the original European Commission proposal. Apparently, from what has been published, the super preference of deposit insurance claims in liquidation is going to remain there, although apparently the least cost constraint will be interpreted in a more flexible way. And on the top of that, the bridging function, it is it is respected, but apparently there could be some obligations here and there, some conditions that will have to be checked in the resolution process for the bridge function actually to be really activated. So let's see what happens. Of course, there is no point now to discuss actually the details on the legal text that we don't know. But pretty much hope that the original idea of the European Commission to have more flexible access to external funding, this is going to remain, and importantly that this is not going to be at the expense of introducing too much complexity over an already complex resolution process that has to be finalized in a matter of hours typically. So let me finish here, Joao, with maybe a few remarks about the contribution of the SRM or banking union to the competitiveness of the European industry. I mean, of course, you are familiar with the Draghi report, has been mentioned several times today. The Draghi report makes it very clear it's important, it's almost urgent for European leaders to think of ways actually to adjust the policy framework, particularly regulatory framework, in order to make it more conducive to growth and competitiveness. And the main recommendation in the Draghi report, I think, at least as the way I read it, is that try to attach the right priority to foster further integration actually in Europe, to be able actually or to put the conditions in place for all economic agents in Europe to be able actually to take full advantage of all the potential benefits associated to a single market. If you associate this, if you actually translate or project this into the financial industry, what you're talking about basically is to foster further integration of the financial system, which means obviously capital markets union, and means of course having actually more banking integration in the European Union. Of course, you all know very good what Wolfgang Buschau said before, but we are far away from actually an integrated banking market in Europe. It's not only that, as he said it very clearly, it's that things are probably even worse. At the very least, they have not improved since the creation of the banking union. Certainly, we have not had meaningful cross-border mergers between banks in the whole European Union, and there has not been no increase in cross-border deposit or lending activity. That's the situation. Banks remain, by and large, focused on specific jurisdictions, and there is not much integration. And this is really disappointing in the current context, because of technology. This is obviously increasing the scope for the realization of economies of scale, and that's so a good way actually for European banks to be able actually to take advantage of those economies of scale is to be able actually to increase, and the logical way to increase is by moving within the European Union zone. So this is not happening. But also from the point of view of the stability of the economic and monetary union, we know that this pan-European integration of the banking industry could actually facilitate more cross-border diversification and national risks. And this is something that indeed could actually foster much more stability in the European economic and monetary union. So we are not there. Why is that? Of course, there are a number of reasons for this. Of course, I start by mentioning, obviously, the political obstacles for further banking integration. That is very important. That is very important. We have plenty of cases, including my own country, on how you have an excessive interventionist governments actually sort of providing obstacles actually for more banking integration in the industry. But not only that, of course, there are other structural sort of factors and somewhat weakens the business case of pan-European expansion of different banks in Europe. But regulation also plays a role, and we know this, and plays a role through ring-fencing practices. Ring-fencing basically reduces the incentives for pan-Europeization of the industry, for the expansion of banks away from the national borders to take over, to open actually businesses in other jurisdictions within the European Union, because it reduces actually the ability to take advantage of the efficiency that could be created by centralized management of the group's resources. But what happens at the ring fencing is something which is extremely linked to the incompleteness of the banking union. Ring-fencing exists because in the current situation, because we have actually national deposit guarantee schemes, because we have actually large scope for the crisis of banks, or national banks, even significant banks, at the end of the day to imply cost for domestic agents. Could be actually the banks contributing to a national deposit guarantee scheme, or could eventually be, as we have seen, by the way, sort of taxpayers in a particular jurisdiction. So in that context, if at the end of the day the costs are going to be borne by national jurisdictions, I mean, officials in that jurisdiction, of course, has a very good, actually, sort of reason to try to prevent the crisis of the subsidiaries, of national subsidiaries of foreign banks. That's what they are, and this is what they are doing. Actually, they are protecting the national subsidiaries, then, and also ensuring that they are able to deal with the crisis of those subsidiaries, and therefore this obviously sort of creating this ring fencing, which is providing important obstacles, actually, for the further integration of the banking industry in Europe.
Fernando, just a quick reminder on time.
I finish in 1 minute. So that's the situation. So when I see all this discussion about how to promote competitiveness of European banking industry, and what I see just basically few proposals to get rid of some binding technical standards, just to reduce a little bit actually the reporting requirements for banks. I mean, this is fine. I'm sure that we can do a lot of that, but we are basically forgetting the right priority. This, I mean, the competitiveness you can actually get out of those type of measures, I mean, it's just absolutely limited. If you compare it with the benefits associated to a fully functioning banking union, with a common deposit guarantee scheme, with a fully effective resolution mechanism able actually to mobilize, mutualize funds if this is required in order to protect financial stability, how this fully functioning banking union could actually promote further integration of the industry, thereby also facilitating the competitiveness of our industry. So I think we are sort of not attaching the right priorities in this particular debate. And I'm of course quite disappointed by the very fact that in all this discussion about competitiveness, the banking union issue has actually left the table. I mean, there's basically no additional proposals, no debate on how to actually improve, complete the banking union in the current context. Thank you.
Thank you. Thank you, Fernando. Just a side note, it was actually very interesting to see how accurately you referred to resolution funds as industry contributed funds, right? You could not imagine the discussions we had in Portugal over the years about the nature of these funds and about whether or not they are taxpayers' money. But that would be a panel on its own. So just, but it's interesting to see how accurate you refer to these funds. Next, we will have Álvaro. Álvaro will discuss crisis readiness for the next banking crisis. You will basically leverage on the lessons we learned from past crises to show how important they are in order to prepare ourselves for future crises, and also discuss the importance of testing, considering that crises are fortunately not that very often. Testing is very important to ensure preparedness. Thank you.
Well, muito obrigado, João, and Banco de Portugal for the invitation. It is my pleasure to participate in this panel with the colleagues, and as you said, João, I would like to take you through our thoughts on resolution preparedness for the next banking crisis, and as you can see, I'll use a few slides. Okay, my first point, next slide, or should I use this? Yeah. Okay, my first point is rapid and abrupt crisis might be the new normal. The resolution cases in the last few years and also recent banking crises in the US and in Switzerland show how quickly situations can deteriorate. And we, resolution authorities, but also the banks, face increasingly compressed timelines, highlighting the need for continuous preparedness and rapid decision making. Planning remains essential, no doubt about it, to build, for example, to build institutional capabilities, but practical experience shows that we very often diverge from initial plans. So we should, as we are doing, move beyond planning and try to make sure that the resolution tools are truly executable and crisis-proof, crisis-ready. Okay, what are the lessons we would draw from recent crisis episodes for the resolution function? Well, first point, as we all know, and it has already been said, liquidity in resolution remains an issue. In recent crises, the speed of deposit outflows driven by social media and digitalization has exposed vulnerabilities in liquidity management during resolution. We have the SRF and the common backstop perhaps one day, but these two may not be sufficient for large-scale crises or for larger institutions within the banking union. So, as we know, central banks are the essential liquidity providers. So we need to make progress with EU-level discussions on guarantees, on access conditions if we want to ensure effective support when needed. Second, we may want to rely even more on the sale of business tool. This tool has proven to be the most effective and credible one, even for larger institutions under certain conditions. It enables a rapid restoration of financial stability. It also provides post-resolution liquidity. True, there is a challenge of finding a buyer. That's something that can be outside the control of resolution authorities, and it can limit its applicability, but still it should become, in our view, a key option within the resolution toolbox, and authorities and banks must be prepared to implement this option when needed and feasible. Third, well, be prepared for deviating from the preferred resolution strategy. Fernando was mentioning it, referring to optionality. We've seen that resolution tool ultimately used can differ from initial plans. Indeed, the unpredictable and changing nature of banking crises requires authorities to adapt quickly and deviate from predefined strategies. So flexibility and agility are therefore necessary if we want to respond effectively under pressure and if we want to tailor the resolution approach to the specific circumstances of each case. And this makes the introduction of variant resolution strategies especially advisable, and as we are actually working on. And last, watch out for the impact of small entities. Recent cases have shown that even relatively small banks can destabilize the broader financial system. So we should continue reassessing systemic importance and be very careful as well when it comes to LSIs, to less significant institutions. The CMDI reform in some way tries to capture that, by trying to expand the scope of resolution, though it has already only been achieved moderately. Okay, let's now turn to some practical implications of all this for resolution planning. Most of these, if not all, is already being done by the SRB together with national resolution authorities under our new strategy, Vision 2028. An obvious one we're already working on is expand the toolbox. Authorities should be equipped with a broad set of tools, including combinations of them. Second, focus on operationalization. It's essential to have comprehensive implementation frameworks including handbooks, operational step documents for all resolution tools, and clearly outlining the roles of the different stakeholders, the decision-making processes, and so on. But documentation alone does not guarantee readiness. It is essential also to test these frameworks through simulations and dry runs, and I'll come back to that in a minute. Third, close cooperation with supervisors is of the utmost importance. We all know about the conflicts of interest to be avoided between the supervisory and the resolution function, but of course, due to the acceleration in the development of banking crises, there must be a fluid exchange of information and perhaps an earlier involvement of resolution authorities by supervisors when there are signs of crisis emerging. And last point, strengthening international coordination. Resolution must incorporate robust cross-border frameworks and communication channels to ensure alignment and timely decision-making in different jurisdictions. Even in cases where the presence of a subsidiary might seem small, international coordination is necessary. And we've seen this with the Credit Suisse branch in Spain very recently. So early engagement and alignment among the different authorities are key to managing cross-jurisdictional complexities. Okay, let's now delve into the role of testing and simulation. Simulation exercises under SRM Vision 2028 are going to be essential, and they allow us to test decision-making, identify operational gaps, and improve coordination across stakeholders. What's our experience at FROB with dry runs? Well, we've participated in several dry runs, both SRB-led and also internal exercises, testing key aspects of resolution execution. Well, SRB-led dry runs have focused, at least the ones we've participated in, the implementation of tools, bail-in, the sale of business tool, and also the use of the single resolution fund. And at national level, we've also undertaken two major dry runs in very recently, the one called HANO, where we've jointly with the supervisor, with the Bank of Spain, and with the deposit guarantee scheme, we've focused on formalizing crisis management practices and establishing a coordinated framework for resolving LSIs when funding from the DGS is required for resolution. Okay, last slide. I want to spend just a minute on our views on dry runs and on-site inspections. How can we design more comprehensive dry runs? In our view, we think we should evolve towards more complete and realistic simulations. This is not a simple task. It is appropriate to begin with targeted exercises, focusing on specific aspects of resolution, but the next step could be to simulate more complex scenarios that closely resemble real crisis scenarios. And ideally, these exercises should involve more and more the financial institutions themselves, providing essential insights into their internal processes, data availability, and decision making. And a word on on-site inspections. Dry runs have proven to be particularly useful. This is a tool that is well suited to the needs of the resolution field. And in addition, we are now exploring the use of on-site inspections, as Karen mentioned as well. This is traditionally a supervisory tool, but it can be very valuable and useful as well for the resolution sphere. We may want to keep in mind the simplification agenda and remain, this exercise remain limited in scope and test aspects that cannot be assessed externally. And also we may want to take note of the experience of supervisors with on-site inspections, in the sense that the interaction between the teams devoted to the on-site inspections and the JSTs in the case of supervision, but IRTs in the case of resolution, should closely coordinate, and we should probably leverage the expertise and the existing knowledge that exists in IRTs when undertaking these exercises. Okay, let's stop that there, and thank you for your attention.
Thank you, Alvaro, for highlighting how experience and testing can prepare us better for future crises, and also for addressing the new avenues for our work, including on-site inspections and dry runs. Now over to you, Geraldine. Geraldine will discuss how to build robustness in the age of novel threats. We've heard before how today's environment is volatile, and we've heard also in the speech before by Mr. Munchau that's probably impossible to predict how the next crisis will unfold and what will trigger the next crisis. So I think you have an interesting proposition in terms of how to build robustness, right?
Okay, thank you very much, Joao, and thank you very much for the organization of this day, which I find dramatically interesting. The question before us is not simply how to respond to crisis, but how to build a system that can withstand them, absorb the shocks, and emerge stronger. And indeed, we could rephrase the questions as how to build robust system. But what do I mean by robustness? And to answer that question, and also because I'm the last one to speak, and I guess you are a bit tired, so I will take you somewhere else and allow me to make a detour by the realm of biology. So let's take a step back from the financial world. You will understand why, and we will go for a moment to the biological world. So you might ask, of course, why biology? Perhaps because there are many analogies, interesting, that can be drawn between biological systems and financial markets. But here, for the questions that are interesting us today, that is how we prepare for emerging threats, I'd like to draw on a more specific contribution from a French biologist whose name is Olivier Hamon. And he has, in recent years, developed a very compelling concept, that of robustness. Is robustness like resilience, you may ask? Not really. Actually, Olivier Hamon draws a clear distinction between resilience and robustness. For him, resilience is about bouncing back after a shock or crisis, recovering and adapting once something has gone wrong. In contrast, robustness is about putting in place the diversity and the flexibility needed to avoid the shock, or the systemic shock at least, in the first place. So rather than focusing on recovery, robustness means building systems that remain stable and viable despite fluctuations, so that crises are less likely to occur, or at least to become systemic. So robustness is not about optimized perfection, it's not about optimized performance, but it's about achieving stability amidst uncertainty. And we've seen today with the several interventions of the colleagues that uncertainty is high. We will come back on it. Robustness is built on three main pillars. First, diversity. Diversity of approaches, diversity of structures, diversity of actors. Second, redundancy. Redundancy, that is parallel system, safety margins. And third, error tolerance, tolerance for error. That is accepting and integrating local failure can arrive, and integrating them in order to prevent the global collapse. So why is robustness necessary today? And why I think it should be the strategic orientation that we should take. As Karen mentioned, we must maintain ambitions. And if robustness is necessary today, it's become, as it has been rightly said by the colleague here, but also by Mr. Munchau,
and earlier in the day, we are entering a world where uncertainty is high, and I think Alvaro has well shown how rapid and abrupt crisis can become the new normal. Indeed, this is the world we are entering. And the risk we face, cyber attacks, geopolitical shocks that can be created also by stablecoins, climate disasters, are not entirely new, but their frequency, their interconnectedness, their severity is really dramatically increased. So these risks are no longer isolated incidents. They are systemic threats that can disrupt financial markets, undermine confidence, threaten the stability of our entire economies. And as you said, in Europe, we like stability. So I won't repeat it here, all the examples that were given. I think Pedro mentioned this morning the ATB cases, Microsoft Access disruption that shows that indeed we are exposed, or banks can be exposed to strategic dependencies. Consider the sabotage of the subsea cables, for instance. These are a very good example of a single point of failure that can have global consequences. The geopolitical shocks, such as the sanction imposed on Sberbank that were mentioned by several, by Pedro, also by Alvaro, that demonstrate how quickly financial institutions can become entangled within international tensions. Climate risk are no longer distant threats anymore. Stable coins and the consequences, as reminded by Mr. Munchau, are sources of major geopolitical risk. So, of course, some risks can be anticipated, but others cannot. And this is what you said in the Q&A response, as Nassim Taleb already really well analyzed. They are black swans. So these cannot be very much anticipated. They are defining our linear models. Linear model where we often focus on a very few well-defined segments of risks. And so Nassim Taleb, as the biologist Olivier Hamon, advocate for building systems and habits to go beyond resilience, aiming to avoid fragility in a world that is shaped by uncertainty. So in this world of uncertainty, I think resolution authorities play a key role in increasing the robustness of the banking landscape. And actually, I think they are really a very good illustration, because it embodies the idea that a healthy system must be able to lose some of its part without collapsing, leveraging diversity, redundancy, and tolerance for error. So I will try to develop these 3 points. So first, just as the biologist Olivier Hamon describes robust biological systems as those that do not aim to eliminate all errors, but rather to absorb them to prevent their spread, the prudential and resolution framework in banking follows a similar philosophy. So let me maybe give you an example. If you take the human body, you will see you will see that when you are a human, you take just your temperature. Actually, rather than operating optimally and constantly at an optimal temperature of 40 Celsius degree, our body maintains a lower, a good enough temperature of 37 Celsius degrees. So this safety margin allows the body to absorb the fluctuation, but not to collapse. If we had always a 40 Celsius degree temperature, it would be fatal. But in some cases, and for a short time, you are indeed in a situation where you accept to have a margin to function at a suboptimal level in order to have this fluctuation. And so it's a bit the same philosophy in the prudential world. Instead of striving for a system where no banks ever fails, the framework accepts that failures are inevitable and provides structured mechanisms to manage them in an orderly way, thus avoiding the systemic crisis. Of course, when you recognize that error can occur and will occur, robustness relies on compartmentalization of the risk. And here again, you can have a nice biological analogy. In the human body, billions of cells act as individual compartments, each separated by a membrane. So if a single cell fails, because of viral infection or cell death, whatever, the problem remains localized. In the prudential or resolution framework for banks, the same principle is applied, actually. Resolution tools are designed to limit contagion by isolating problematic assets and activities. Let's take the example of a resolution where we can have sale of assets, for instance, or toxic assets where can be transferred to an asset management vehicle. Second principle, so this was for tolerance to error. Second principle, redundancy. Redundancy and safety margins are essential for ensuring robustness. For example, humans have 2 kidneys, even though only one is necessary for the vital function of filtering blood. And this redundancy allows a person to survive even if one kidney is damaged. In this way, the presence of the second kidney acts as a safety margin. Actually, it's the same in our resolution world. Planning for merging and backup resources, like the Single Resolution Fund, the MREL, may have a cost in normal times. And Carl Philippe has rightly mentioned and reminded us the huge amount of cases that sued SRB with regard to SRF because it was costly for a bank. But actually, the Single Resolution Fund or the MREL or whatever margin are actually they do enable the system to absorb extreme shocks. In that sense, as Claudia Buch rightly mentioned to Le Monde recently, we should not relax the rules. And I quote her, "Rolling back regulation or weakening supervision would be a mistake." And I would add to this that it would hamper the robustness that we have been building for years. Robustness also requires a diversity of solutions. And here again, we can make a good analogy. Flexibility in problem solving, and it has been said a lot of time today, means having a range of resolution strategies available, and this diversity allows for an adaptive response to each problem that arises, preventing the total collapse of the system. So here we can say in the resolution world, where while of course we have preferred resolution strategies that establish presumptive paths, we must as authorities also be able to deviate from these presumptive paths. And I think it's Fernando that reminded how optionality was important. So considering the inherent fragility of the financial system, it's the role of a resolution authority to build robustness. However, because there is a however, resolution authorities are not superheroes. And we've seen also in your talk, Mr. Minshaw, how the nature of the risks has changed recently. And so the question is to say, we must be honest as resolution authorities about what we can do and what we cannot do. The current resolution framework is well equipped for classical crisis, liquidity, solvability crisis. We have tools, we have powers, we have requirements that have been tested, that have been refined, but the question, are these tools sufficient in the face of novel threats? Consider a cyber crisis. You don't resolve a cyber attack with a bail-in. A bridge bank may be the best tool in our arsenal, but if the data is compromised, the bridge banks start on a shaky ground. Operational continuity becomes a prerequisite for resolution. Without it, our tools may be ineffective. So, while resolution authorities definitely contribute to increasing the robustness of financial systems, they are not necessarily equipped to prevent all risk. And we must be transparent about what resolution authorities can do and cannot do, and this transparency should inform our risk appetite. Banks are by nature, by transforming short-term liabilities into long-term assets, they are risk takers. And they have buffers, they are prepared for disruption, but no institution can prepare for every possible scenario. The key question is what risk should be prepared by the private sector and which one must be managed by the public safety net, and in particular by resolution authorities. This question should lead us to refine our expectations for banks, for instance. If we take the example, in a world with the new trust, operational continuity in resolution is no longer a luxury. It's a necessity. We can also talk about liquidity in resolution that you mentioned, and you too. These are, as new threats emerge, we may need to revisit and reinforce these expectations in comparison with others. The financial safety net, so the supervisor, the resolution authorities, must be prepared to act both in going concern and in gone concern. But can resolution authorities truly address all residual risk? If not, what remain unaddressed? These are the questions that we, as resolution authorities, must confront. Given the rise of new risk, should we consider creating a dedicated cyber resolution authority? Or should we expand the mandate of existing authorities with personnel who has an expertise in cyber or operational risk management? These are questions to address in times of peace. As you said, it's when the weather is nice that we can definitely question it to this morning, Elisa, and not in the midst of a crisis. Ultimately, and I will finish here, fragility is inherent to the financial system. It cannot be eliminated. As resolution authorities, our role is to embed robustness and to ensure that the failure of one institution does not destabilize the entire system. We cannot anticipate every black swan, of course, but we can prepare. And by building systems that function under extreme uncertainty, by laying the groundwork for robustness in times of peace, we strengthen the systems in times of crisis. Thank you very much.
Thank you, Geraldine, for sharing this interesting approach, and thank you to all the four speakers for their very thought-provoking presentations. It is now time for questions. I will start myself with a few questions, the first round, and then we will have the time for a Q&A to answer questions from the audience. I'll start with you, Karen. So it's very clear, it was made clear throughout the conference that a lot of progress has been achieved by the SRM. Looking forward, what do you say would be the additional steps we need to consider to further strengthen our credibility? We've heard that, for example, in reality, in spite of having used resolution tools, bail-in was not exactly used, and so there might be challenges around bail-in operationalization. We also heard from Mark Dobler's presentation some concerns about the ability to bail in bonds issued in other jurisdictions, namely. So how do you think we can evolve in these areas?
Absolutely. So looking at the bail-in, so the general question, what else do we need to do, is quite a big one, right? And we heard a number of impulses here. But if I start with the question on bail-in execution, what Credit Suisse showed us was that there was actually a lot of readiness of host authorities, a lot of readiness to move ahead with resolution, but that there were specific questions around reducing uncertainty around being able to execute bail-in, particularly in contexts where US security law is involved. I think that's been a known issue for some time. Work is progressing. It's something that's a real priority for us, together with the international counterparts in the SEC and in other authorities, to make progress on that. And and there are different strands. So one of them, Dominique was mentioning the work through the Financial Stability Board earlier. This is a really key platform for us where we can coordinate with other authorities, also in other bail-in issuing jurisdictions, to ensure that we can give more clarity around how we make sure this works on the day. We are, of course, also bilaterally and multilaterally discussing this in more practical circumstances, and this is a good example of an area where we're also using testing, where we're also using practical exercises. So we had a very helpful deep dive with the bank, with the US authorities, with their own colleagues, to really dig into specific elements of the bail-in approach here. So it's an area where there isn't the one simple solution, but something where we really feel we're making progress, so that we can continue to provide more and more clarity over time and secure resolvability. Maybe just to add a couple of more general comments, I wanted to underline and pick up on, I think Alvaro made that point earlier. It's really, when we look at tools, it isn't that there is the one perfect tool, you know, and if only we had a transfer tool or a bail-in tool, you know, then we would be certain of success. Rather, it's also about our ability to be combining tools. So even in circumstances where we talk about transfer, we talk about sale, we need the bail-in tool to be functional as a really important contributing to the overall resolution strategy. So what I would say in terms of the second broad theme for resolvability, the testing, the practical execution, we've already discussed quite a lot. Authorities' ability to be flexible and adapt solutions, combination of tools, optionality, and looking at variant strategies is one of the elements we have in terms of insurance strategies, about being able to find the best solution on the day. You know, when you look at the British colleagues, they said for Silicon Valley Bank UK, they had, I think they said four workable scenarios by the Sunday evening, and this really helps make sure that we deliver on the types of objectives we heard from our legal colleagues earlier. And the third element in that context is also with this international theme. We really have to find ways of continuing to work together with international partners. And when we were in Asia early in the year, we really all faced the same challenges and the same desire to look at simulations together, to look at practical work together. But the complexity scales up with scale. So if you were involved with the Nordic Baltic exercises, there were almost 450 people, and quotation marks, just for the Nordic area with the European institutions. So how can we also make sure that our practical ability, our use of technology, to be underpinning doing good exercises together, to be able to execute it, that it has to keep scale with a level of ambition about, yes, indeed, doing more and more complex simulations over time, but also ones which are workable and which allow us to learn along the way. Yes, and it would be very tempting to start talking about innovation and banking as a service, but I will stop here so the other panelists also get a chance.
Fernando, I will change the topic now. So right now there's an important political drive around simplification to foster competitiveness and growth in Europe. In your view, what direction could the resolution framework take in this discussion to support these new policy objectives?
Yeah, I think you are right that we are all aware of the political drive in that direction that you are describing well, but also on the industry actually being quite outspoken about that. I hear basically two main sort of requests by the industry, which are complementary. First, to try to sort of achieve more simplicity in the resolution planning, resolution requirements more generally. And second, which is probably more important, is that they would like actually to have some requirements to be certainly alleviated, in particular MREL requirements. So there are out there some suggestions, some ideas or initiatives. You may have been maybe familiar with them. The first one, for instance, is just playing with resolution plans, maybe to make them less detailed or maybe less frequent or things of that sort. As regards actually sort of the stringency of the MREL requirements, I mean, there's other proposals out there, like, for instance, trying to align the MREL requirements with the calibration of TLAC. That will imply for USIP certainly a reduction of the loss absorbency requirements, right? Well, of course, those proposals have to be taken seriously because, I mean, as I said before, it's clear that the European resolution framework is certainly more complex and more stringent for the banks than the one prevailing in other jurisdictions. Sometimes, of course, there are very important policy justifications why this is the case. But I think it makes a lot of sense to try actually to see whether there are some unwarranted side effects on the banking industry that could be alleviated, and still preserving the overall objectives of the resolution policies. That said, I'm afraid that those two requests by the industry to achieve more simplicity and actually lower sort of MREL requirements is something which is very hard actually to deliver without sort of adjusting some of the deep political compromises that are at the root of the current resolution framework in Europe. Are we we safe here?
This might be cyber risk, I don't know.
What did I say then? No, I think it's fine. Let me just finish this idea, right?
It's when we started to talk about simplifications.
Right. So the point is basically it's hard actually, just because at the end of the day, political leaders decided actually just to keep sort of national deposit guarantee schemes and didn't go all the way to build a single common guarantee scheme. Second, they decided to preserve national insolvency regimes. They decided to severely restrict access to industry contributed funds, even if they are considered taxes or not. That's a different thing, right? And fourth, very important, they decided not to actually put in place the possibility of obtaining some government support in extreme circumstances. If you put all those things together, you end up with two important things and two important conclusions. The first one is that the process, the whole system is quite complex, certainly more complex in other jurisdictions. And second, you have a disproportionate reliance on internal funds in order to fund actually resolution. That implies, of course, that you have actually to have more stringent type of loss absorbency requirements. So unless actually you go back to the drawing table of the European resolution framework and try to revise some of those actually political compromises, it's very hard actually to deliver on those two elements, simplicity and stringency. Right? By the way, if you do that, you modify those political compromises, you could end up with a much more effective and efficient sort of framework that could support bank integration, as we said before, and certainly the competitiveness of the industry. But you have to go back to the drawing table. I don't think there are easy, straightforward, low-hanging fruits that you could actually employ.
Thank you. Alvaro, turning now back to you. So you addressed in your presentation recent banking crisis. And we've discussed already in previous panels as well that we have been seeing a shift in a way in terms of the nature and causes of financial instability, and probably going forward this shift will be even more visible. Would you be able to develop a bit further on how the crises we've seen in Switzerland and the United States compare to previous cases we had in the past? So in terms of crisis dynamics, namely in terms of the pace of deposits outflows, which was very impressive, and what implications these new dynamics have for our role and for our preparedness?
Yeah, indeed, we may be seeing an evolution in the nature and causes of financial instability. This can be addressed from many points of view. In my case, I'll focus on the speed dimension and what it means for us, resolution authorities. To some extent, we're no longer dealing with a slow-burning, solvency-driven crisis. Today's events unfold rapidly, unexpectedly, very often, also influenced by the loss of confidence and digitalization in general, but social media, instant payments, online banking have all fundamentally changed the dynamics. They amplify market reactions. They accelerate deposit outflows, and this is compressing the timeline from early signs of distress to non-viability. So this has implications. This presents new challenges for resolution authorities. Well, one could say that this has always been the case, and that the resolution frameworks already anticipate the need for swift action. And that is true, but the reality is that that resolution authorities have now less time to prepare. The traditional window for planning is now shrinking. So authorities, we should, or we may want to make sure that the resolution strategies are not only well designed, but are truly executable under real-time pressure. And this means having access to timely and granular data, undertaking, as we've discussed, regular simulations and dry runs, and also maintaining, as I said before,
close coordination with supervisors to detect any early warning signs and act decisively. It also means that the legal and administrative barriers to the implementation of a swift resolution should be removed. One example of this could be procurement in resolution. Perhaps we should revisit procurement regulation and make sure that there are the right or the needed exemptions from the general rules when it comes to resolution. Another example could be the EU framework for screening foreign direct investments in some cases. If we use the sale of business tool and the buyer comes from a different jurisdiction, this can also be an obstacle. And there are other examples this morning in one of the panels, competition law was also mentioned and so on. A last point, these new dynamics of resolution also exacerbate the liquidity in resolution problem that we've all addressed. In the Popular Bank and in the Sberbank cases, the capacity of the buyer to inject liquidity immediately was critical to stabilize the situation. And the Swiss authorities made 200 billion Swiss francs available. The Federal Reserve also provided liquidity support. And at EU level, we've made progress. The SRF, now 80 billion euros available. We've reached the target level, and then we have the common backstop. But these combined resources may not be sufficient. So to be very clear about that, we are the euro area, the only major jurisdiction that has not solved this issue. And central banks are the key, but of course they request and they need the necessary guarantees, and we have to take forward the discussions on access conditions and other parameters of this issue. Well, in summary, we are moving from a slow-burning, solvency-driven crisis to fast-moving, liquidity and confidence-driven events, and all very much shaped by digitalization. Our response frameworks, our resolution frameworks should evolve and adapt accordingly.
Thank you, and apologies for the sunlight. It seems that our panel is definitely under attack.
Okay.
Let's
I'm the lucky one.
Let's see what surprise we have for you, Geraldine. So Geraldine, I mentioned in your introduction that you have both responsibilities on resolution and on statistics and at the National Bank of Belgium. Considering your responsibilities, what role would you see for data governance and integrated reporting in making the SRM better prepared for new sources of uncertainty?
Yes, maybe I can answer by starting by saying that I fully support an integrating framework for the reporting. I think it's both useful for banks but also for the authorities. And I see at least three major advantages to such integrated reporting. First, I think it provides a single source of truth. And we've been speaking the whole day about how important it was to have trust, and I think this single source of truth is one element, because you will have all relevant data which is centralized, which is reliable, which is instantly accessible. So this means that in a crisis, decisions can be made quickly and based on accurate information rather than on fragmented data, which is particularly important in resolution times. Second, and we've been speaking a lot about crisis preparedness, I also think that integrated reported data allow for better risk monitoring and a better preparedness to crisis. Because by having a holistic view, the SRM can detect emerging risk early, whether they are financial, operational, or external risks. And this enables proactive responses rather than reactive ones. And one can think, for instance, to the progress that have been made by data science in outlier detection, for instance. So this can be really, I think, tools that allows us to be more proactive and anticipate maybe better some signal of crisis. It enables also a scenario analysis, scenario testing, so that SRM can simulate the impact of various shocks. The third advantage, and this is last but not least, is that single reports foster a better collaboration. Because both internally, but also with external stakeholders, everyone works from the same information. This reduces miscommunication. This contributes to building trust, as I said a bit before, and which this is really essential in crisis time. So I think good data management and single reporting are not just a technical upgrade. I think it's the strategic asset that can make the SRM more capable of facing the uncertainties of our time. This, however, again, I come back with an however, this is never easy. This does not fully exhaust the question of access to the data in resolution. And here we come back to the question of infrastructure, because beyond integrated reporting, it's essential that banks have an infrastructure that guarantee the recovery of the system of data, also in case of cyber attacks, for instance, as otherwise resolving bank and restarting operations may become very complicated.
Thank you. So it's now time to answer some questions from the audience. We have exactly 5 minutes of our time.
Maybe people are very tired.
So let's see if there are questions. We have one question there.
Again, I'm sorry.
Nomad, go ahead.
2 comments and 1 question. The first comment is for the banks, which I'm a new executive of commercial banking in Portugal, so banks have to be much more involved on this type of discussion publicly, and we should question more than listen, and this is a self-criticism for ourselves. Second comment to Fernando Restoy, I fully agree with you. I think, yeah, if I understood you well, that the competitiveness of the banking sector is much more related with macro issues such as the completion of the banking union, the capital market union, the red taping, etc., than with micro issues. So I fully agree with you. It's my opinion. However, I ask you all not forget that the micro issues are also important. So too much regulation, buffers that are not competitive, duplication of efforts, red taping again on the details. These are less important than the factors that you mentioned, but they cannot be forgotten. A question. There was a say some years ago, competition is global, resolution is national. Is this true today or not anymore? Sorry, there was a say. There was a say that was basically the following: competition is global, resolution is national. Is this true today, or this is not true anymore? Thank you.
Fernando, I think the question was directed to you first, but of course any one of you can address the question as well.
Okay. Yeah, I like the way you put it, the first part of your comment. It's not that it's not legitimate to try to see ways to improve not only the effectiveness but the efficiency of the whole actually regulatory framework. By the way, in doing that, let's not just focus on regulation. Let's look at regulation, let's look at supervision, let's look at resolution in a sort of comprehensive way, so that you could actually sort of establish some sort of adjustments here and there that at the end of the day could actually end up with a more efficient regulatory framework. The second interesting question, of course, is the core of this discussion, right? Of course, this is the very actually motivation of the banking union project, to try basically just to try to eliminate actually the national nature of banks' risk. That's actually also the very foundation of the banking union, right? To denationalize this. We have gone relatively far in relation to this, but not quite. Because as I said before, we don't have a deposit guarantee scheme, so that means obviously that it's very hard actually to think that without actually common funds actually to address the failure of different European banks, that at the end of the day you can just sort of survive to pure European framework. I mean, it's clear that there is still a scope for the cost of the crisis to be borne by national authorities or national agents. And I'm afraid in the current situation, without a deposit guarantee scheme, without a fully effective resolution mechanism, with access to fully mutualized funds in case of need, without that, it's still somewhat true what you were just describing, right? And this is unfortunate. That's why I think if something needs to be done in Europe, it's actually just to try to follow the roadmap that we eventually put in place, which is try to complete the banking union with the 3 steps and try to improve as well, actually, the functioning of single resolution mechanism.
Your microphone is...
So you're not hearing anything.
Did you hear?
Yeah, I think so. Of course, jump in.
Just one, if I might, just one element to complement. So, of course, direct effects can be felt quite locally and nationally, and there's a reason why, for example, when we talk about dry runs, when we talk about these various exercises, we also involve finance ministers, because quite quickly, somebody will be in front of a camera. But I think it's really important to remember that we are no longer in this scenario where it's national in the sense of the taxpayer. And this is, so if you think, for example, about large international banks, the primary line of defense are the resources that bank has built up, which enable us to have resources available in resolution. And those creditors, that will certainly be pain, but that pain will not be felt by a single country, but rather by those entities. And this comes a little bit from the, well, you will never do it anyway, where I would be really confident and say, no, we've gone past that. And I think the level of acceptance for taxpayer bailouts is no higher than it was before, and certainly, also question mark whether there would be, even the capacity depending on the size of the bank. So, can there be local effects? Absolutely. But there is a collective interest in single point of entry, in coordinated resolution outcomes for all parties potentially affected by their banks that go well beyond the home state, which is why, in the EU, as Fernando said, we have the banking union exactly for that reason. But we also have TLAC, we also have lost resources, and we have international resolution strategies also for that reason, so that it doesn't become about the national, but it becomes about the generally mutually beneficial solution. But I see that didn't, but we can continue the conversation over cocktail. Happy to discuss further.
I don't think we have time for more questions, so it's now time to close. Let me just finish with a short thought, a contribution from myself. Considering what we have been discussing about the volatility of current times, the new dynamics of crisis, what I believe is the key tool for resolution authorities going forward. And considering that Geraldine went into biology, I'll also use a quote by Charles Darwin. It's not exactly by him, I believe. It's not clear if he really said this, but this is consistent with his work. It is that it is not the strongest species that survive, nor the most intelligent. It's the one most adaptable to change. Exactly. And I do believe that adaptability is the key tool that we need, especially now. But of course, adaptability does not come by chance. It implies mastering our work, be prepared through planning, through testing, and so that's the final thought from me. And now it's time to thank our panelists for the interesting contributions. Thank you.
Thank you.
Thank you so much to all our panelists for such a great discussion. According to the agenda, we would have a short coffee break now, but since we are running a little bit behind schedule and we are almost in the end of our conference, we will jump right into our next keynote address, which will be delivered by Ms. Maria Luisa Albuquerque, European Commissioner for Financial Services and the Savings and Investments Union, Ms. Albuquerque has a long and experienced career in both the public and private sector. She served as Portugal's Minister of Finance from 2013 to 2015, a challenging period during which the country went through an economic adjustment program and faced the failure of Banco Espírito Santo.
Prior to her position as finance minister, Ms. Albuquerque had several senior positions in the public sector, including head of issuing and markets at the Portuguese Treasury and Debt Management Agency. We are very pleased to hear her perspective on the achievement of this first decade of the SRM, but also on the challenges that lie ahead. Unfortunately, Ms. Maria Luisa Albuquerque was not able to join us in person today, but she has kindly recorded a message for this occasion, so let's hear it.
Ladies and gentlemen, it is an honor to speak to you to mark the 10th anniversary of the Single Resolution Mechanism, a cornerstone of our banking union. I wish I could have joined you in Lisbon. It is important that we mark these milestones and recognize how much work has gone into getting us to where we are now. 10 years may not seem like a long time when compared to the long life of financial institutions and markets. Yet in those years, we have laid down important foundations, faced some unexpected challenges, and achieved real, measurable improvements. And we have also seen the framework tested in real-life situations, including in Portugal. Today, I think it would be useful to take the time to reflect upon where we came from and where we are today, including our focus for the future. The banking union was created as a response to the financial and sovereign debt crisis. At that point, European banks' portfolios featured significant shares of non-performing loans and excessive sovereign exposures. We also had no tools for managing bank failures in an orderly way, which often meant that taxpayers had to be called upon to bail out the banks. As a former finance minister during these challenging times, I experienced firsthand the difficulties in addressing these situations. In the wake of the sovereign debt crisis, several Portuguese banks needed public support to stabilize their balance sheets. Their capital positions were fragile, and authorities had to handle failures using national resources. Similar situations occurred elsewhere, in Spain, Ireland, and Greece notably. 10 years on, the picture is very different, including in the country I know best. Thanks to the establishment of the Single Supervisory Mechanism and the Single Resolution Mechanism, the development of the Single Rulebook, and the efforts put in by national authorities and by banks, we have made significant strides. European banks are now better capitalized, and their liquidity and funding structures are stronger. Between 2015 and 2025, the average quarter run ratio of significant institutions in the banking union has risen from around 12% to 16%, and average total capital ratios are now around 20%. The liquidity coverage and net stable funding ratios are comfortably above the minimum requirements. These are reassuring figures. They show us that our banks are resilient and able to support themselves in times of crisis. A significant amount of work has also been put into cleaning banks' balance sheets. In the banking union, the ratio of non-performing loans has decreased sharply, from 7.5% to less than 2% over the same period. There has also been some progress on reducing euro area banks' exposure to sovereign risk. Government bonds now represent a smaller share of euro area banks' holdings than a decade ago, and the domestic concentration has also declined. All of this meant that European banks were well placed to withstand the external shocks of the recent past, from the COVID-19 pandemic to the war in Ukraine and the 2023 banking turmoil in the US and Switzerland. Beyond the increased resilience of European banks, meaningful progress has also been made on the resolution side of the equation. This ensures that if a bank were to fail, authorities are sufficiently prepared to handle their resolution in a way that protects financial stability, taxpayers' money, and preserves confidence in the financial system. The Single Resolution Board has been in operation since 2015. Together with the national resolution authorities, resolution plans have been put in place for each banking group, and a lot of work has been done on increasing preparedness on both the side of the banks and the authorities. Banks have been increasing their loss absorption capacity steadily. As of end 2024, the minimum requirement for own funds and eligible liability resources of significant institutions in the banking union were around 34% of total risk exposure amount on average. The Single Resolution Fund has met its target level and now holds around 80 billion euros, ready to be deployed as needed. The national deposit guarantee schemes have together already collected 55 billion euros. All of this means that when trouble emerges, whether from macroeconomic shocks or geopolitical risk, European banks and authorities are far more prepared than ever before. This is proof that the banking union delivers tangible results, strengthening national systems while enhancing stability for the euro area as a whole. However, we have not finished all that we have set out to do. I am committed to ensuring that the progress continues and that the EU financial system becomes ever more resilient. Cross-border mergers in the banking union remain rare. I know that there are many reasons why this is the case. Legal barriers, lack of trust between authorities, fiscal asymmetries, national ring fencing, domestic biases, the list goes on. Even the cross-border provision of banking services remains limited. In the end, it is European citizens and businesses who lose out. They deserve to experience the real, tangible benefits that a true single market for banking can deliver. I acknowledge that any discussion on next steps towards a more integrated banking market must consider the concerns expressed by host authorities and must define safeguards that strike the right balance between integration and financial stability. But the fact is that a true single market for banking would allow us to become more competitive as an economy. Strong banks operating on a cross-border basis have the potential to deliver better and cheaper banking services and more affordable financing. This would bring tangible benefits to citizens and businesses, but it would also be a considerable step towards improving the competitiveness of European banks and indeed of the European economy. At the same time, developing a robust deposit insurance framework must consider the context and challenges that we are facing today. This would help maintain depositor confidence across member states, reinforcing both financial stability and market integration. President von der Leyen mandated me to further develop the banking union and identify a way forward on the European Deposit Insurance Scheme. We will continue to work hard to deliver on this mandate. The EU banking sector and the regulatory framework have seen significant developments in the past 10 years, and any new approach on EDIS will need to reflect this. Next year, the Commission will publish a report assessing the overall situation of the banking system in the single market, including the evaluation of the banking sector's competitiveness and how we can further develop the banking union. As we celebrate this milestone in Lisbon, let us not be complacent. Our continent faces immense investment needs, and without taking the next step in integration, we will not be able to meet them, nor to stand on equal footing with the world's largest economies. We need the buy-in of all member states to move this project forward so that we can continue to invest in ourselves, in our shared future, and in the generations to come. The last decade has shown that when member states, EU institutions and banks work together under a harmonized, credible framework, we make Europe safer, more stable and more competitive. The next decade must be about making this framework even more integrated. We are focused on breaking down remaining barriers, ensuring resolution is truly effective no matter where a bank is located or where it fails. We will continue to reduce fragmentation to give Europe a banking sector that supports growth, innovation, and stability in all member states equally. As we celebrate this 10th anniversary, I want to congratulate you all for your dedication and achievements. Together, we have made Europe's banks stronger and taken an important step towards deeper economic integration. But this is not the end of the journey. It is the foundation for what comes next. Let us build on this success to shape a more resilient, more integrated, and more confident Europe for the future. Thank you.
To close today's conference, we invite Mr. Luís Máximo dos Santos to deliver the concluding remarks. Mr. Luís Máximo dos Santos has been Vice Governor of Banco de Portugal since 2017 and a member of its Board of Directors since 2016. He is also the chair of both the Portuguese Deposit Guarantee Fund and the Portuguese Resolution Fund.
We would like to thank once again to all our speakers, participants, panelists for joining us today. The coffee break was skipped but not cancelled, so after Mr. Luís Máximo dos Santos delivers his final words, we will join, and please join us in the coffee break. On behalf of Banco de Portugal, it has been an honor to host you. Please.
Ladies and gentlemen, distinguished guests, dear colleagues and friends, as we move towards the close of today's conference, allow me to share a few final observations. This event is part of the celebrations marking the 10th anniversary of the Single Resolution Mechanism, taking place throughout 2025, with the main highlight being the conference hosted by the Single Resolution Board on 15 October in Brussels. This anniversary is more than a symbolic milestone. It is an opportunity to underscore the importance of banking resolution as a vital pillar of the banking union, and to acknowledge the remarkable journey of cooperation, innovation, and perseverance that has defined the SRM over its first decade. At the same time, it is also a valuable occasion to identify areas where improvements are still needed and to set priorities for future action. For me personally, today carries an additional layer of significance. As one of the longest-serving members at the plenary session of the Single Resolution Board, I have had the privilege of witnessing firsthand the development and consolidation of the Single Resolution Mechanism. Not so long ago, banking resolution was still, in many respects, uncharted territory. The prospects of a European mechanism for the orderly resolution of failing banks seemed little more than an ambitious aspiration. Over the past decade, however, we have seen this vision evolve into a fully fledged operational framework with established authority, robust tools, and a proven track record. We began by preparing resolution plans for every bank, and in the meantime have made significant progress on resolvability, moving from abstract plans and idealized strategies into tangible capabilities supported by testing and refined through systematic review and practical exercises. We directed and oversaw the successful build-up of loss-absorbing capacity across the banking union, an endeavor that was far from simple, especially for smaller and medium-sized institutions, but one that has provided a much stronger foundation to our framework. We have established the Single Resolution Fund, which is now capitalized with around 80 billion euro and is full mutualized. More recently, we have also navigated the demanding and complex debate on the review of the crisis management and deposit insurance framework, which, despite its challenges, has led to an agreement that represents a step forward in the refinement of our regime. And, crucially, we have faced real resolution cases that test our ability to act under pressure and demonstrate that bank failures can indeed be managed in an orderly manner if the right tools are in place. To celebrate this anniversary, we were fortunate to hear from an outstanding group of speakers and panelists. I am grateful that they have agreed to share their knowledge, insights, and experiences, providing us with a rich reflection on the past decade and on the future banking resolution. Their participation here today is itself a testimony to the importance of the single resolution mechanism in Europe's financial landscape. Today's discussions offer a rich overview of what has been achieved in the past decade, the legal underpinnings of our regime, and the challenge ahead. The first exchanges reminded us that a resolution is deeply embedded in the broader pursuit of financial stability, resilience, and integration in Europe, while also pointing out persisting gaps and areas for improvement in our framework. The second part of the debate focused on the legal dimension of banking resolution. Over the past decade, the courts have played an active role in consolidating the framework, providing credibility and legal certainty through their case law. This interaction between policy, practice, and judicial scrutiny has been decisive in ensuring the legitimacy of resolution and in reinforcing confidence in our regime. Finally, attention turned to the road ahead. Increasing readiness through testing and operationalization was identified as a central priority, alongside adapting the CMDI review and preparing for new sources of uncertainty such as cyber risk and geopolitical tensions. This forward-looking debate captured the dual spirit of this anniversary, celebrating what has been accomplished while keeping our eyes firmly on the future and on the work that still lies ahead. Throughout the day, we also had the privilege of hearing from other distinguished guests. Dominique Laborex provided very important insights about the evolution of the SRM, also sharing its proposition for a stronger, more capable, and more efficient mechanism. Wolfgang Manschau provided food for thought regarding the economic and political landscapes and caution about existing challenges and threats in the Eurozone, including stablecoins. Commissioner Maria-Luísa Albuquerque, unfortunately unable to join us in person, shared her views about the progress achieved in the first decade of the SRM, while also pointing out next priorities for the continuing reinforcement of financial stability. In reflecting on today's discussions and on these past 10 years, I believe that three final thoughts stand out. First, that the SRM, despite some shortcomings, is a genuine success story of European integration. The progress achieved in this first decade shows that when member states and European institutions work together with determination and purpose, it is possible to build an entire framework and to make it effective in addressing financial crises and safeguarding financial stability. The SRM embodies the idea that shared challenges require shared solutions, and that through unit and joint effort, Europe can achieve important milestones. Second, that the past decade has given us reasons for confidence, but it has also shown that the progress achieved so far is not enough. The framework is far from being flawless, the work is far from being completed, and the challenges ahead are substantial. The next 10 years will surely demand the same spirit of collaboration and resilience that has brought us this far. Deepening the banking union must remain a priority if we want it to be truly equipped for the challenges that lie ahead. Completing its third pillar will continue to be essential to ensure that citizens across Europe can place the same level of trust in the protection of their deposits, regardless of where their bank is located. Only then will the banking union live up to its promise of fairness, confidence, and cohesion, and only then can we achieve the level of integration in the European banking markets that we have been aspiring to and that is necessary to the growth and resilience of the European economy. The recent review of the crisis management and deposit insurance framework has represented progress in refining our regime. Yet, it is fair to acknowledge that more could have been achieved. Important advances were made, but the final outcome fell short of the ambition that many of us believed necessary. This should not, however, weaken our resolve. On the contrary, it should reinforce our determination to keep pushing for the reforms still required so that the framework is fully fit for purpose. The third thought that, in my view, stands out is that the future of the SRM depends, above all, on the people who make it work. The dedicated professionals at the SRB and at national authorities, including here at Banco de Portugal, which was called to take resolution action even before the creation of the SRM, and also for that reason has been specially dedicated to this mission. It is the daily commitment of the people who serve within the single resolution mechanism that gives credibility and substance to our framework. As I already mentioned before publicly, it is a pleasure to all the staff of Banco de Portugal to verify that 2 Portuguese banks are now in the top of the European rankings of resolvability, in spite of all tremendous difficulties in the beginning of the journey. The past decade has been a story of progress and cooperation for the banking union, in contrast, I would say, to other areas of the European project, where integration and unity have not always kept pace with the demands of today's world. Let us continue this journey together, knowing that the next 10 years will be no less challenging, but confident that they can be just as successful. Robust crisis management has perhaps never been as important as it is likely to be in the years ahead. In fact, we are and will remain navigating stormy waters, geopolitical uncertainty, and aggravated tensions that will continue to increase global fragmentation and volatility. Cyber risk, the increasing digitalization and interconnectedness of the financial system, the expansion of financial frontiers through the emergence of digital assets and new market players, and the new risks associated with climate change. And we must have the humility to admit that some of the risks we face today may not be sufficiently identified. Readiness to act will therefore to be the central driver for the SRM in its next chapter. Not by coincidence, this is reflected in the strategic ambition set out in this SRM vision that was approved recently. This strategy marks a shift of focus from resolution planning to a more dedicated effort on operationalization, resolution testing, and crisis readiness to ensure that each plan and preferred resolution strategy for each bank can be implemented at short notice, making the mechanism even more crisis ready. This impetus on crisis readiness is as important in periods of market disturbance or stress as it is in periods of stability. In one of their works on the global financial crisis and its lessons, Ben Bernanke, Henry Paulson, and Timothy Geithner warned that measures that seem necessary in the aftermath of a crisis will appear onerous and excessive as the memory of the crisis fades. Let us not fall into that trap. Simplification of rules and procedures is indeed necessary to make our framework more credible and efficient, but we must bear in mind that weaker rules and regulations can have a much higher cost on society than the costs of eventual excessive regulation. The key, of course, lies in calibration, in striking the right balance between simplicity and resilience, between efficiency and prudence. Finally, let me highlight that a robust crisis management arrangement is a powerful tool to create confidence. Confidence that financial stability will be preserved even if banks fails, that depositors are protected, that financial markets can continue to function even under stress, and that shareholders and creditors can credibly absorb losses if a bank fails without endangering financial stability. All this is instrumental in building trust among economic agents and European citizens. And such trust, in turn, helps reduce volatility, mitigate moral hazard, and strengthen market discipline, making markets more efficient, better equipped to finance innovation, and ultimately better able to serve the European economy and its citizens. Therefore, a strong and well-designed banking crisis management mechanism favors the competitiveness of the European Union. To conclude, I want to extend my gratitude to all of you who were able to join us today, distinguished speakers, panelists, colleagues and friends who have contributed to the richness of our discussions and to the success of this conference. Thank you.